Heck of a squeeze this morning as we squeeze our way up to the 708, 7. We are trading over 700. Unbelievable. Unbelievable. I'll get my plans together for today. Yeah, 708, 7. Yesterday I called out the 704 profit target. So she definitely already is at that profit target. She hit that post market when she hit that 704. You see the market took right off to where I had anticipated according to my diagram here. Unbelievable. Yet very believable.
Pairing.
This is incredible. Still under 698. 704 put 7026 7026 7026 700 698.7 This is unbelievable. Dr. JB, good morning, buddy. I'd like to see maybe a pullback, Dr. JB, to the 20-day, to that 706 area. See if we get a pullback to the 706 to provide an entry for the call. Hope everything is good with you, Dr. JB. It's so good to hear from you, buddy. Thank you so much for joining in. Stopping by to say hi. Wow, kick is growing. Kick is growing. That's all organic too. You got an energy. That's the pullback I was looking for right there, Dr. JB. That's the pullback right there to the 706. Yasa. That was that pullback to that 706 area. I might just have to take the stream on the road with me from the mobile aspect. Just want me going out of town. You know what I'm saying? Yeah, I just need to figure out all that. How to do all of that. How I can stream on Instagram. I know I can stream on Instagram with glasses. I don't know. Kick I can stream on with the phone. I don't know about YouTube. We'll have to see. But that'll, be some good content. All right, team, here we go. Friday, Jesse Swanson is in the building. I'm ready to see what this market does today on this Friday, best day of the week, Yamu Jumua. Here we go. Bismillah. Jared Lewis, Dr. J's in the building. What a remarkable climb. The market has literally climbed all the way into the 700s. Grateful day. Good morning. Thank you all for tuning in. See what the market unfolds today. Just been massively bullish. Massively bullish. As you can see, we have been massively bullish. Every pullback has only just been some profit taking from the bulls. Will cause the market price to come down just a little bit. We just lost the kick live, the kick stream. Why did we lose the kick stream? Oh well. Why did we lose? Looks like we're back. Looks like we got it back. And of course, you guys know my co-host, Shaka, the On My Nerves cat. Can't forget him.
Reports that if there is president perhaps would consider going to Pakistan to do that. But my point is, it's not done yet.
No, but you
certainly moving in the right direction.
True, but you could have the biggest construction projects in history. All the countries that had their infrastructure hurt or destroyed in the Gulf, they have enough money to rebuild it. And it's going to be a free-for-all. It's going to be a grab like you wouldn't believe. It's going to spur the economy.
Yeah.
You heard Larry Fink talk about he's ready to go over there and raise money. David, infrastructure is going to be so important. And then let's remember, we were a few weeks ago, we were saying, all right, the companies that are in private credit are in a huge amount of trouble. You've got to feel more bullish about things that were really frail, because you're going to see your deals done.
You absolutely do. Now, I would point out, when we talked about private credit, I feel as though we acknowledged it wasn't a credit issue that was exacerbating the fears of investors in these funds. It was more, the future credit problem, saying, well, I want to get out now, and the inability to be able to redeem as much as you wanted.
David,
a liquidity issue.
Right, but there was a lot of, let's just take that off the top. That's the reality.
And they've had a great week. I mean, Blue Owl, though, still can't quite crack 10, but many of these alternative asset managers' names have had a very strong week. Year to date, though, that stock is still down 34%.
We also have to remember that there were two issues. There was the gating issue, but then there's we looked at their portfolios, and they seem to be disruptible. And we know that the man who's being with Susie Wiles right now, they exist to disrupt. They are just crushing. So if a lot of the companies that went private have software that may have no value.
That continues to be a key concern.
Still an issue. So
and how you actually differentiate between those software companies that really are embedded in the enterprise and won't be pushed out.
No.
In fact, that are operating on private data sets that have mission critical functionality, that are obviously deterministic as opposed to what they would say is the large language models probabilistic, which you can't be oftentimes, because you pile on probability after probability and eventually you get a really bad answer.
Right.
But all that being said, you're right. There's still a lot that is at risk.
Yes.
One would expect.
And I think that we're going to go back to talking about how many cuts we're going to make. But if you're talking about technology, you're going to talk about, okay, OpenAI and Anthropic, what are they going to go after next? Are they going to go after software that is onboarding? Are they going to go after software that is HR, software that is the silo of pharma? Are they going to go after drugs? I mean, what they choose to go after, they will win.
Right, but there is a belief that Anthropic will not go after cyber, for example. You were just talking about CrowdStrike being a beneficiary, despite the fact that they have a model so powerful they wouldn't release it, and clearly something that a lot of companies would want to have to defend.
Well, here's a stock that I think that we mentioned only peripherally, but CrowdStrike works with them about how to deal with these things, and CrowdStrike's part of that project. And CrowdStrike, David, was at 566, and it's 429. I'd buy that.
Yeah,
I would, but I don't want to buy Atlassian. I know you're itching to buy Atlassian.
Well, let's take a look. Let's take a look at the IGV, just to put in perspective again the week that it has had, because it's been a very strong one.
What a squeeze!
Very strong one. Look at that. I mean, it
was just a plain out squeeze.
That's just 4 such sessions at this point, and another 2+% today.
Well, David,
15+%.
You know what we should have been
Still,
talking
many
about?
of these stocks are down 30 or 40% for the year,
oh
even
God,
with
yes.
this.
That's why I say, if you think that there's going to be a real build out, if you go to the Prologis conference call, the build out, they were not promotional this quarter, PLD, but oh my God, it's a great conference call. The stock was up 4.
Right.
They've got the build out data center. They've got finally rates are ticking up. That they can be a factor. Obviously, CoreWeave just a huge factor. But David, was it a big week for the Ellisons?
It was a big week for the Ellisons.
For both of them.
For David as well.
And why is that? That slate of movies?
Well, David Ellison from Paramount is talking about 30 movies a year.
I know.
As he tries to win the support of theater owners, for example, for the transaction to acquire Warner Brothers. There is still the prospect, by the way, that the California State Attorney General could at the very least try to slow this thing down. It doesn't appear to me, based on what I've heard, that ultimately they would be successful in stopping it. But yeah, 30 movies a year. P-Sky shares have had a decent move, but they're hanging in there around 11.50, 11.60. Remember, we had that, they lowered the overall price of those who are buying equity in Paramount that will then be used to fund the transaction to acquire Warner Brothers, and they're also giving warrants to existing P-Sky holders. That
Right.
has value. That helps send the stock price up. So you're right. Not to mention the guy who's putting in most of the, or a lot of the equity, Larry Ellison, got a
Right.
lot richer this
He's
week.
very rich.
Take a look at shares of Oracle this week.
No, it's
and
really-
Jim, give me your sense as to whether this thing, I mean, it's up
Yes.
32%.
Well, there was
more
a
than
cheap
30.
shot about how well their building is going, but they've got grand ambitions, and I think that again, they can borrow for less. If you can borrow for less, you can build up more things. Like, CoreWeave
Jim,
might be able
look
to
at
get
that
under
move.
9.
When is I mean, that's
Well,
not
David-
a small company.
okay,
it's a
David.
$500 billion market value again.
David,
it's up
there was a
30% in a
belief.
week.
Look, there was a belief when it got to 345 that they're going to take over the world, and then it got to almost to its 52-week low. So people say, you know what, I can buy it. It's got a lot of room. And then, David, they're buying the home builders because again, rates are going to.
Moving
Well,
on from Oracle
rates,
already? I
the
think
people
that's so
buying
extraordinary.
Toll.
The home
I'm
builders?
sorry.
What do you want to talk about the home builders for? That's
I'm sorry.
boring.
Well, David, you're right. Making money is boring.
Is it really? You going to make money in the home builders? Tell me why.
You are.
Why?
Because I told you that Warsh is going to cut rates dramatically. He's got the wind at his back. Warsh is now Warsh can go in and say, listen, you laggards, let's just start cutting rates. And it's going to. And he doesn't really talk like
He doesn't speak like that?
No. But that's Mr. Frost speaks like that. But David, look at those. You see Toll Brothers?
Yes, I
These
see.
things are. Lennar was it could go 50 points higher. David, rates are coming down. I'm not saying happy days are here again, but I am saying that the real takeaway from the Fed is, wow, we've got air cover. We have air cover.
No,
We can cut rates.
it's a salient point. I just like to give you a hard time sometimes.
I never mind that.
No, I know you don't. You
No.
wouldn't be sitting here if you did.
No, but David,
Or
let's
I
go
would have
back-
been removed from my
will you
position
stop
here.
it? JP Morgan. I'm going back to it. Yes,
Back to the
Ted
bank,
Pick, I'm
sure.
going back
All right, I want to come back to one
Morgan
other
Stanley.
name in a second, but tell me more about
Ted
JP
Pick,
Morgan.
we
What?
never talk about
It didn't have a great week.
No,
It
but
didn't report a great quarter.
Because it's a laggard. No. What it did was gave a conference call that was one giant screed. It was a screed. This regulation's bad. This regulation's bad. I don't like this regulation. Then you go listen to Jane Fraser. And she says, we had an amazing quarter. This grew 16. This grew 30. I like this one. This can get even better. It was like a call from a company that is on the move.
And for those of you that see that movement on the 5 minute, that's exactly why we waiting for the larger time frame. You'd got faked out, you'd have got baited in that movement because it was setting itself up as a lower high with a shooting star rejection with price trading underneath it. But it doesn't matter because the price has to close underneath it. And we always say the first 5 minutes, very volatile. The first 15 minutes have the ability to trick you. Give the market some time. Even at the very least, I said you want to refer to the 15-minute candle because that will be exactly what you think you see here will be here definitively. Knowing that we will have the end of this candle closing in less than 2 minutes. Nothing but patience. It is patience that pays. Getting a shooting star here would be confirmation. Then getting price trading below the 706. That would be continuation as it would then put pressure on all of this morning's bulls, putting them in an uncomfortable position to cover that takes place underneath 706.
When they were seeking Anadarko and
Anadarko?
Occidental came in and they're like, out.
Well, I mean, there was
But
a raise, and then it tricked Oxy to come into a high price.
But it doesn't.
And then Worth just
It doesn't happen often.
No,
You
it doesn't.
assume that if a company wants something, they really want it, and they're going to hang around. What,
Yes.
of course, they're saying is we're disciplined financially,
Right.
and once it no longer made economic sense, we were out. But you heard Sarandos earlier
Ben in
talking
the
about
building.
their muscles that they have now created around M&A. Maybe they come back for something else, Jim.
Well, I think they have to look. I think they have to. When you don't flex the
Not
muscles,
that
you do
much
nothing.
out there.
No, there
Certainly,
isn't.
Comcast has got to probably figure out something for NBCU at some
I
point.
have no idea. Hey, listen,
It's
I
under
think
scale. Peacock.
I think
You don't care. I'm just saying that.
I have to go.
I'm not
no,
looking for
no,
you
I
to give
used
me
work there.
affirmation.
I used
I
to
know.
work there, okay?
Yes, you
Phil
did.
LeBeau had a piece this morning that was a clinic about the airlines.
Yes.
I would buy United. United's going to have an unbelievable quarter.
Well, Phil
I spent-
LeBeau has been reporting on a potential lack of jet fuel in Europe and what that
Well,
could
that's
do.
no longer an issue. That it killed the stock. It killed them. I think you can buy them. It's not going to be an issue, jet fuel. I mentioned Boeing. It's up 6. It may be already too late. I don't know. I happen to think David Kelly Ortberg, not talked about.
The CEO of Boeing, Kelly Ortberg, yes, what about him?
I think he's the hitter that they needed. I think he's exacting. I think he's the signal, not the noise.
Tesla has had a very strong week, Jim.
Yes.
And I can't give you any one particular news event, but you can see it's up over 13%. Stock is still down 12% for the year, but it's right around that $1.5 trillion level now.
They had that no accident in of the driver hands-free.
Yeah.
In Austin.
Yeah.
I intend to.
You have this chip that we
this is
talked
gonna
about the
happen.
other day. It was not completely clear whether it was for full self-driving or it was actually for other parts of the business, such as Optimus. I think Elon sort of clarified that a bit.
Well, Jensen
and then,
still says that's the biggest use.
and
that
then,
folks.
then there is, and we're going to I talk about it every day because I think we need to, SpaceX, which will be the largest IPO perhaps
You're so
ever.
right.
And it's coming soon. Still on track at this point.
What are you
We're very
hearing
much anxious to see the
about
S1,
retail?
which may be available in, let's call it, a number of weeks.
We shouldn't use the term retail. He likes users to win. People who use the product. How do you demonstrate fealty to SpaceX?
Well,
to get a
Starlink
share?
customers would be the one retail way to do
Man,
it.
I've got so much
There are not a
Starlink,
lot
I'm
of
not in
people
stocks.
who are
I'm Mr. Starlink.
customers of their rocket ship company, given that they're
You ever
taking
go to one
payloads
of
to
his
space.
launches?
I have not been to a launch. It's something
so
on my bucket list.
triumphant. But I think that David,
Given that one day we're going to have hundreds of launches a year, if not
Right.
even more than that, between SpaceX and Blue Origin,
going up all
I would
the time.
expect that I will be able to make it to a launch at some point.
But David, we could devote a show to Anthropic, to OpenAI, to SpaceX, and wouldn't be wrong to do that.
No, we wouldn't be wrong at all.
These are one time you did
Transformative
GM,
businesses
Ford.
and going to be enormously important for our capital markets. And won't it be nice when we can put charts up with them? Just talk about the
Bogus
charts.
charts. There's like ownership that is.
Did you just say the word bogus?
Yeah, I shouldn't.
No,
That was
listen,
way out
you
of
cannot. A private
Way
company,
out
you
of line.
cannot get an appropriate read on the
that's what I'm
price.
saying.
You
Because
can't.
OpenAI seems to go up and down.
can't.
Anthropic
It's
are
not
double
possible.
fund.
It's not
But
like the shares are trading, so I
but-
don't know what those are either.
But I think that if you don't address these pretty much every day, you're missing the fourth industrial revolution. They're fully embracing.
Latest news on SpaceX is they're moving, potentially allowing employees to get vested sooner, so they'll be in a position to they move up the vesting schedule for employee shares before the IPO. I think that's a Bloomberg story.
Would you say this is the most exciting time in your life when it comes?
And as I stated, you see exactly at the 945 candle, we did not have continuation. We actually had a reversal of that position. But again, even though we tap dance below the 706, we have to see a close below the 706. Other than that, that is a trap as well. Real tricky on both sides. Options are still expiring today on Friday. Huge gap with a possible, gap cover coming down to the 703 area. But nonetheless, the market is up right now, and it is a battle back and forth. Really just a little bit of sideways action and chop. If you go ahead and look over here at the 2-minute chart, you can really see the sideways action that is really going on. The 5-minute chart will definitely have you dancing real antsy, and we want to be real calm. We want to look for the obvious trade and take our time and allow these charts to form. So now you want to go one step further, and now we want to look at the 30-minute chart. You want to wait until 10 o'clock to see what this 30-minute candle is going to be, and then see if we have a continuation or a breakdown from whatever the 30-minute candle is going to be and is going to represent. But right now, definitely want to be cautious, want to be careful, want to have your cuppa, because the market is still very strong. What people are anticipating, for those of you who might not know, shout out Bao, shout out Alex, shout out MIC. This is a play from Alex, right out of Alex's playbook. It's called the first red day. First red day typically is going to be huge, and it was the anticipation of the first red day which caused this gap up, because yesterday's daily candle put in a hangman, and with the market trading below the bottom of the hangman, that turns the whole sentiment into a bearish reversal sentiment, okay, as we are in a bullish, okay, sentiment right now. You see this control buying algo that we're in, all right, and it's been that way all month long. All right, so this is just anticipation for what is commonly known as the first red day, when you have a series of green days in a row. 1, 2, 3, 4 green days in a row. Typically that first red day will be a very nice flush. Additionally, we have tapering here at the top of that controlled buying algo. Let's show that as well. Okay, this is that controlled buying algo that we're currently in. As we came out of that controlled selling algo, let me change the way it looks to make it easier for your eyes. There it is right there. As we came out of that controlled selling algo, we're now currently in this controlled buying algo, and we've been tapering here at the top of it. So I won't be surprised to see if we do get a little bit of a pullback. But if we do get one, it'll be a very nice one. And that's what a lot of short bias people were anticipating on. And it actually cost them this morning with that very severe gap up that we're experiencing on this Friday. That's what caused it. And the short red day is a very, very profitable trade. The short red day will typically turn into an all-day fader. It's a vicious move. Vicious move by the Bulls. Vicious move by the Bulls. To try to bait in some early bears, some eager bears. Because remember I called that 706 area, and it's right there at that 706 area where the Bulls stepped right back in. So if you were an eager bear, an early bear, if you didn't allow the candle to close, you got smoked. Be patient. Again, we want to look for the easy trades. That's why I said now, after seeing what I saw on the 15-minute chart, I now said what? We want to wait until 10 o'clock. You have to wait and see what the 30-minute chart, what that gives us, what type of candle is formed. And then we'll be able to see and make a determination. So patience is the only thing that's required right now.
That we have had during the course of this week. We're back in 3.
Two minutes to 10 o'clock. 2 minutes at 10 o'clock. Wait on that 10 o'clock candle. Let's see what that looks like. We'll be able to add that to the mix. Leaving up pre-market will actually help today, because there is no market action to go off of, because all of this move happened post and pre-market. So this is yesterday's trading activity. Took place below 703 with $5 higher than that right now. So in actuality, we do need pre-market just to give us a little bit of a basis, a little bit of a census, to see that the market was even higher, okay, pre-market. And in fact, looking at that, okay, we have now put in a double bottom and attempting to break into new highs or beat the pre-market high. Let's go ahead and identify the pre-market high. That's the pre-market high. It's acceptable. Low right there. Low enough. See the pullback. So that's the framework we're working in. Good morning, Brother Ali. Assalamu alaikum, Brother Ali. So this is the framework that we have right now, and we're at the 10 o'clock candle. Let us see what the 10 o'clock is.
Good Friday morning. Welcome to Squawk on the Street. I'm Sarah Eisen with David Faber, live at Post 9 as always of the New York Stock Exchange. Carl has the morning off. Coming up this hour, we will talk about the jump for the major averages from the Iran war lows and more strength this morning on this news out of the Strait of Hormuz. Plus, much more on Netflix results in the quarter as the stock pulls back hard after earnings missed and Chairman Reed Hastings announces he will leave the board in June, down more than 9%. And it's another Supreme Court opinion day. We are awaiting a potential decision this hour on President Trump's authority to fire Fed Governor Lisa Cook. Of course, we'll bring that to you, any headlines, as soon as we get them, if we get them. But David, I wanted to kick it off with the consumer, as we often do, because we now know how tax returns are looking and tax refunds are looking, and they are up. And this was expected because of the changes in the One Big Beautiful Bill and the fact that money is going to get returned to people. So we do have some numbers and some charts. So here's look 2026. It's the top line, and you can see we're tracking a lot higher than we have been in recent years. So they're up 14% year over year at this point. You know, how that compares to expectations, Morgan Stanley actually expected a lot more, 15 to 25% increase. They're the ones we took the chart from. But the average refund is up 11%. So that's $346 per return. About 75% of refunds are normally paid out by now. So that gives you a good sense of where we're tracking. It should be good. It should be stimulative for the economy. The only but here is oil prices are higher and gas prices are higher. So the question, I think, for economists and investors is how much of this bump gets offset by those higher gas prices.
Although they don't seem to have been hurting consumers that much in terms of their ability to want to spend, not to mention, of course, as we'll get to in a moment, a dramatic plunge in oil prices today, Sarah.
Well, you asked about the gas prices, right?
Yeah.
And I wanted to zoom in a little bit because I said that they were off the highs and they've been coming down a little bit.
Yesterday. You
Yesterday.
didn't like when I challenged you on that, did you?
Well, just look in the last month, and I think you have to. Overall, we're a lot higher, of course, but look at the last month.
Well,
and this
Besson
really
had said we were down, and then I sort of
We're down. We're down a little bit. We're off the highs, But yes, we're still above $4 a gallon.
Yeah,
so
although
that's
that may change soon if this recent plunge holds.
It should come down more because it should it reacts, to the price of oil with a little bit of a lag. So that definitely should happen. I would just say that. New York Post. I don't know if you saw the cover of the Post today.
I don't actually see the hard copy of the Post very often.
Many
I didn't even know they
returns.
still had it.
So their workers rejoice as Trump's tax law bumps tax refunds 11% to average $3,462.
Very nice. I usually go for the back. I'm a big sports.
The back.
Yeah, that's the
one.
sports section.
Yeah, but they have such good covers.
Which they're known for.
They're
Knicks game 1 tomorrow, Sarah, just so you know.
What is?
Knicks, the opening of the playoffs tomorrow.
Oh, good.
Yeah.
Did not know that.
Yeah, it's going to be great.
I'm sure my children know that.
Yeah.
We're kind of in baseball mode with the kids, not the professionals.
All right. So they obviously highlight that as well. What does it all mean? Actually, what I'd love to get from you is a sense in terms of this plunge in oil prices. And we saw rates coming down a bit. Home builders, for example, Jim pointed out the stocks are already up today. Does it make it easier for an incoming Fed chair? Should
Absolutely.
we soon get him to lower rates?
Absolutely. I think that the Fed chair could have made the case to lower rates even with the price of oil high, because the core inflation has been a little bit softer than expected. And you could make an argument that you can look through the headline and look through the volatile food and energy prices, especially geopolitical oil shocks. But this makes it even easier. You know, even Treasury Secretary Bessent this week said you can understand the Fed wait and see attitude to see how the higher oil prices filter through the economy. And there are still questions. I mean, it doesn't mean it's, you know, not going to have an impact more broadly. Diesel prices, fertilizer prices, industrial prices that run on this stuff, electricity prices. So that's sort of the case for wait and see. But second half of the year, rates come down, oil comes down. That definitely opens the door for potential cuts.
Yeah.
But we go on, Fed stops talking today. This is the blackout. We'll get a few Fed speakers today, and then, you know, they're in quiet period ahead of their next meeting. But nobody anticipates anything before the end of the year. So first, Kevin Warsh has to get confirmed. That's kind of an if, when, and then if oil prices come down, that should moderate the CPI numbers.
Yeah. Well, as for oil, the price of it is coming down and coming down sharply right now. Take a look at that. WTI down as much as over 11%, along with Brent crude. This is a result of Iran's foreign minister this morning in a post on social media saying the Strait of Hormuz will completely open to commercial traffic, at least for the extent that the ceasefire between Israel and Lebanon remains in effect. President Trump coming out and echoing that point as well in his own posts on social media. Let's get to Pippa Stevens for more on this dramatic move this morning. Pippa.
Hey, David. So I think it's really important here that we focus on the full post from Iran's foreign minister, because he said that while the strait is declared completely open for the remaining period of the ceasefire, he also mentioned a coordinated route as announced by the regime, which doesn't sound like it is fully open. And CIBC's Private Wealth, Rebecca Babin, noted that this market has been trading the headlines, the speed of the headlines, and not the certainty of flows, and that this move feels optimistic, especially as the market reprices the idea of reopening faster than it actually can reopen and the flows will resume. And President Trump also said on Truth Social just now that the blockade will continue, which again does not suggest a normalization of flows. Now, both WTI and Brent are below $90 and less than $20 above where they were prior to the war breaking out. We're also seeing big drops in product prices with gasoline and diesel futures tanking. European diesel is now at its lowest level in more than a month. And I did speak to Maersk this morning, and it was before the post from the Iranian foreign minister. So timing is important. But still, they said that there is no change in their approach and that they are not transiting the strait. So again, guys, clearly a big response in the market here, but we have not seen a resumption of flows. And it doesn't feel like flows will normalize anytime soon at this point.
So what are you reading and hearing, Pippa? Because, I mean, the ceasefire was agreed to, right, by Israel, Lebanon, and President Trump, imposed by President Trump. But Hezbollah wasn't involved in this. So I do wonder just how fragile this is potentially.
I think fragile is the key word there, Sarah. And also, if you are a ship owner, you probably don't want to be the first one to send your crew through and to test the water, so to speak. And so there is probably not going to be a big surge to send your ships through, especially since it is a temporary ceasefire and there are still so many questions open right now in terms of what's going to happen. Should the ceasefire expire or should it be extended? And so, again, you know, if you're a ship owner, you're not really going to want to risk your crew. And we still have seen flows more than 90% below their pre-war levels. And the other thing is that even if the war were to end today, in order to get all the tankers back in position, that will take a while. You look at the number of VLCCs heading to the U.S. right now, it's at 70. That's up from an average of about 27 last year, according to data from Kepler. And so, once again, to have all those tankers U-turn and go back to the strait will take some time. And so even once traffic has resumed, it will take a while for things to be normalized. And then the final point I'll make here is that if you are a producer and you've closed in some of your operations, given how expensive and how how much time it takes to restart things like a refinery, you are not going to do that unless you have certainty that you can operate at full capacity. And so while the market is clearly taking this as indication that we could see a resumption of flows, there's going to be a while before things really normalize.
Not to mention as well, the blockade continues, the president making that clear. So Iranian oil will not be reaching the market. Is that fair to say, which obviously is different than it had been, because that had been the one thing that had been going through?
Exactly, and that's about 1.5 to 1.7 million barrels per day of exports. And there are some conflicting reports about the extent to which vessels are currently loading at Iranian ports. But of course, a lot of questions here about the extent to which Iran needs that revenue from their oil exports, and so how long they can sustain that oil not reaching the market. But guys, also, look at elsewhere, look at other choke points, whether you talk about Bab el-Mandab Strait or Malacca Strait over in Singapore, where China is building up their presence in the Scarborough Shoal. There are a lot of choke points here on global markets, and now people are saying that those are going to be repriced going forward, and that when flows do resume through Hormuz, there's going to be a new sense that these choke points around the world for key commodities and for shipping will be repriced, and there'll be more of a little bit of a risk premium priced in, given that we've seen Iran can effectively close down the Strait of Hormuz.
All right. Pippa, thank you. Pippa Stevens. Let's take a look at the broader markets here, of course, with the S&P up over 1%, NASDAQ up over 1.2%. And joining us now from, Council on Foreign Relations Senior Fellow and former Bridgewater Associates Chief Investment Strategist, Rebecca Patterson. Good to have you here, Rebecca.
Great to be here.
All right. First, just give me your take on the news flow this morning, not to mention, of course, the significant rebound we've seen in the broader markets over the course of the last week or two.
Yeah, the last week or so was tech dominant, right? So it was, if global growth is uncertain, we know there's over, just 4 companies, $650 billion of AI capex coming into the economy this year. So it makes sense after those stocks sold off that they would come back, because it's structural, it's not cyclical. Everything else, though, we have this cyclical question around the supply shocks and what it means for inflation and growth. And that was front and center this week in Washington, D.C. But this news could not come at a better time in terms of the strait potentially being open. And I say that with a lot of caution, because the buffers that have been helping the market in terms of physical supply are quickly being run down. So all those inventories that were released to give some cushion to economies that are net importers, that is getting exhausted. So we really need the supplies to start coming back online quickly if we don't want to see the supply shock escalate, which could happen as early as the next couple of weeks.
Is there any reason to think that this isn't going to be temporary, the oil shock?
The oil shock itself? Well, look, we know that there is significant damage to energy infrastructure in the Gulf region. One estimate I read said over 80% of energy infrastructure has some damage, and about a third of it severely damaged. So that's going to be a tail to this, if you will. That's probably going to limit supply versus what we had previously, and that's going to be a support under prices, all else
But
equal.
on the flip side, what about Iranian oil supply increasing on the prospect of some deal happening?
How much were they damaged, though, the infrastructure? How many of those wells have been shut in that are going to take weeks or months to restart? So, yes, if we get a resolution of this crisis, ultimately we could see a lot more oil coming out of Iran and the region overall, but it's going to take time. So I think the market reaction today, we have a lot of volatility. It's going both ways. I don't know how deep this market is right now, how liquid it is. Wouldn't shock me. But I think this reaction is kind of a leveraged play, if you will, on what the real picture is.
But we have gotten back to sort of the themes that obsessed the market previous to the Iran war, a lack of compute, and therefore what companies are actually going to benefit from continuing to bribe more and more and more. That's not going to stop.
No, that's not going to stop. And it's another reason that I think this administration would love to get this conflict resolved sooner rather than later. Don't forget, President Trump, President Xi Jinping in China are supposed to meet in less than a month now, May 15th, I believe. And he doesn't want to go in there having this war in the backdrop. He wants to go in there with as much leverage as possible and be able to get a good deal, which includes getting the critical minerals, the magnets, et cetera, that America has to have in order to build the chips we need to keep going on that AI race.
Yeah, I'm curious how you view that. Again, it's something we haven't really talked about that often, at least of late. What will conceivably come out of it and whether it will be a positive?
Again, let's assume it happens on time, that window is open for President Trump to go over there. personally, I would guess that it's going to be just stability, right? So China will agree to buy more agricultural goods. It'll agree to buy a lot of Boeing airplanes, probably. They'll agree to comply with promises they made in the Trump's first term. And then the U.S. will, allow them to get some chips. And the question is, what is the right play for U.S. from an AI dominance perspective? Should we be allowing China to be keeping such a close race with us, if you will, on that AI development? Because right now, by some metrics, America's ahead, but by some metrics, China is ahead. They have more tech engineers, they have more data, they have more electricity available to them. So we're winning on some fronts, they're winning on others. And so how comfortable are we giving them chips if part of the goal is for the United States to be dominant?
We will get back to a lot of those issues, it would seem, conceivably, if in fact the war is over. Rebecca, thank you.
My pleasure.
Rebecca Patterson.
All right, so here's our roadmap for the rest of the hour. Still ahead, we'll bring you the latest on a reported meeting taking place today between Anthropic's Dario Amodei and White House Chief of Staff Susie Wiles.
Plus, Netflix shares giving back a chunk of the gains that the stock has seen, at least since it abandoned its deal to acquire Warner Brothers. This after last night's results. Co-founder Reed Hastings also announcing he'll be stepping down from the company's board. We're going to talk to an analyst who says the stock is still a buy.
And key takeaways from earnings. The CEO of regional bank KeyCorp will give us his read on credit, the consumer, and the overall economy. Squawk on the Street will be right back after a quick break.
We shared the spotlight, a real rarity in Hollywood, by the way. He pushed me into the spotlight and celebrated the wins and coached through the misses and, in short, made me the executive that I am today. I am forever grateful. He built a company of risk takers and a culture where character matters and nobody rests in the pursuit of excellence.
That was Netflix co-CEO Ted Sarandos during last night's earnings call, talking about Chairman Reed Hastings' decision to exit this board, the board, I should say, when his term expires in June. Netflix is sitting out today's rally, of course, this after reporting what it Certainly was a mixed quarter, perhaps some disappointment about margin guidance. Let's bring in Michael Morris, Senior Managing Director and Media Analyst at Guggenheim Securities. Still has a buy rating on Netflix after earnings did lower his price target. It's now $120. It had been $130. Michael, good to have you. Why do you still have a buy on the stock after the quarter?
I think the punchline here is that the shares are still attractively valued for the sustained multi-year growth potential of the business. So we, perhaps you saw in what we wrote, we understand why the stock is giving some back today after the rally following the discontinuation of the Warner Brothers deal. There was some baked in expectation. We do survey work as a team here at Guggenheim. We had over 80% of investors expecting some upward revision to margin guidance on the quarter, which did not happen. So these expectations can run hot into any individual earnings report, but the long-term story remains intact. And we also think there's option value at the company that's not really even in the stock price yet.
All right, well, I'd love to hear about the option value, but why shouldn't the fact that they did not raise margin guidance not be seen as concerning?
Sure. I think the thing to keep in mind is how long-term investors are going to think about the value at the company. And if you remember last year, there was a leak of what the company's 5-year growth plan was. And while the company hasn't blessed that as guidance, they didn't shy away from the fact that they did indicate their long-term targets. And so when we look at what the company just reported, which was a beat and maintain, if you will, we think that they continue to be on track for those long-term goals. And that's strong double-digit revenue growth. It's high teens operating profit growth. That translates to well over 20% earnings growth through the end of the decade. So I think long-term investors will continue to have confidence about that ability to compound. And that's why they will be there. But of course, on any quarter, we have the expectations of a raise, of a different trajectory, perhaps something new. And that didn't really materialize. So we understand the reaction, but we're still buyers of the stock here.
I wonder if you think, Michael, the Reed Hastings departure raises questions for investors, especially in light of the fact that, this company is doing things that it never did in the heyday, chasing big acquisitions and ad dollars, ad revenue. I mean, that wasn't the original Netflix model.
Oh, I think you're right. I don't think you can dismiss the impact that an announcement like that has on near-term sentiment. Obviously, Reed Hastings is a Hall of Fame business founder, and being somewhat surprised by having him step away raises questions, of course. I do think that the business has been run and very well run by Ted Sarandos and has sort of started new things. We bring up advertising. You bring up the really big swing that they were willing to take on Warner Brothers Discovery. And while the company says that running the business and the runway ahead is still attractive, Ted did mention yesterday that the Warner Brothers experience did strengthen or develop the M&A muscle. And while we don't see anything major on the horizon, I think that investors do have to take that into account as well.
Yeah, we've mentioned that this morning, but I am curious, do you feel like you understand strategically why they were going to buy Warner Brothers and then why they decided not to, and what that overall means for how they see their business?
Well, I have my opinions, right? And the company will only share with us as much as they will. But I'd say a couple things. One, I do think that Warner Brothers, the studio and the HBO service were complementary to Netflix strength. Netflix is a very broad global platform. They're rapidly growing their advertising supported tier. I think that there are elements of that Warner Brothers studio and the prestige branded HBO that would have been complementary to Netflix. And so we saw some constructive opportunity there, but clearly the market didn't like it very much. And we understand that as well. Walking away, I think, was a matter of price, honestly, when they speak about it. I do think that ultimately Paramount was going to have the flexibility to raise price more, and Warner Brothers made a disciplined decision. And now, as we this print, I think there are questions about where they go from here, why they were willing to do that, and what they might do beyond the scope of the existing business as we know it. I think those question marks remain, and that's why there will be a debate.
Is there any AI narrative here in this stock, and is it problematic that they're not, considered an AI play in this environment?
Yeah, it's a great question. There are a couple things. One, I like it a bit as a defensive AI play, quite honestly. When I think about why I have a buy on the stock, I think about it compared to other ideas. And Google and Netflix in this space are Google and Meta rather, are best in class. and they have AI question marks and CapEx stories. At Netflix, they're making some smaller AI-related acquisitions they did in the quarter, and I think there are some complementary functions to the existing business that they can use AI for with respect to sort of the production process. I think the proliferation of AI content, I still stand in the camp that there will be a lot, that it will primarily be, slop, if you will, or long tail. So I think Netflix is well positioned to benefit from AI without having to take big swings. And that's why we like it as a sort of complementary idea to Google and Meta.
Welcome back. We are here about 30 minutes into the trading session. Stocks are rallying big time, led by the Dow, which is up now more than 900 points, around 2%. Sector winners include consumer discretionary and industrials. And here are three big movers, individual movers that we're watching. Airline and cruise stocks jumping this morning as oil prices fall after Iran said the Strait of Hormuz would stay open to commercial traffic during the Israel-Lebanon ceasefire. Meantime, Affirm climbing after Morgan Stanley names it a top pick, saying private credit fears are overdone. And then watch Apple getting a solid boost today. Data from Counterpoint Research showing the company's Q1 iPhone shipments to China surged 20%. Mackenzie Sagalas actually has been digging into this report, has more on the iPhone numbers, which come as a bit of a surprise here, Mackenzie.
They really do. And you got Apple shares popping this morning, specifically because of that, out of that fresh data on China. Counterpoint Research showing iPhone shipments there surging 20% in the first quarter, the strongest growth among all major vendors, even as the overall market fell because of supply chain disruptions and those soaring memory chip costs really weighing on the broader industry. That report also noting that Chinese consumers still see the iPhone as a premium device that lasts at least 3 years. So While rivals are raising prices on these budget handsets, you've got Apple with a real moat here in that market. The result, Apple is now neck and neck with Huawei in China. Huawei holds 20% share, but Apple is right behind it at 19%. Even as Apple works to shift more of its supply chain outside of China, the market remains critical to its business. CEO Tim Cook was there last month, in part to handle App Store negotiations and certain one-off exemptions just for that market. And the urgency is clear. Greater China revenue surged 38% last quarter, snapping a 2-year slump. And Apple would like to keep up that momentum. Now, also out this morning, Bank of America reiterating its buy on Apple with a $325 price target. That's 24% upside from here. The bank calling Apple the highest quality name in its coverage, arguing that it's relatively insulated from all this AI volatility, not because it's ahead, but because its valuation is still driven by consumer hardware and services, giving it a different exposure profile than the hyperscalers that are burning cash on infrastructure. They point to Apple's new in-house M5 chip family. It's purpose-built for AI that runs directly on your device. That makes it faster, more private, cheaper than routing everything through the cloud. B of A sees that as the foundation for keeping hardware upgrade cycles relevant for years to come. Guys?
It's funny, we just heard that argument for buying Netflix from an analyst, which is it's insulated from the CapEx swings and it's sort of defensive AI. Interesting to hear another analyst say that about Apple. Mackenzie, thank you.
Let's get a CNBC News update. Contessa Brewer has that for us. Contessa.
Extend a major section of the Foreign Intelligence Surveillance Act, that's FISA, extending it until April 30th. The law is known as Section 702. It would have expired Monday. President Trump was pushing for an 18-month extension without any changes, but some Republicans demanded they be allowed to add privacy limits. The Senate still needs to approve the short-term extension. Acting Director of ICE, Todd Lyons, is leaving the administration. The nearly 20-year veteran of the agency said he'll resign at the end of May to spend more time with his family. Lyons has defended the Trump administration's immigration crackdown, but recently also talked about a surge in threats to ICE officers, including that his own family has been targeted. And Google has some luxury shades in the works. The CEO of Gucci tells Reuters it plans to launch branded Google smart glasses next year. That will pit them against EssilorLuxottica, which makes Ray-Ban smart glasses with Meta. I don't think I've ever said that out loud before. Google hasn't commented, but it plans to roll out new Android XR smart glasses in the coming months. The battle of the high-end smart glasses.
Do we need smart glasses?
Yes.
I don't know.
Yes, because we want to stop
you
having.
do not.
I do not.
You are plenty smart without them.
What a good one, David. Thank you, Contessa. That's why we keep you around. Quickly.
Is that why?
Yeah.
Okay.
When we come back, CEO of KeyCorp, among other reasons, here with us. First reaction to earnings, beating on the top and bottom lines, how consumers are handling the fast-changing geopolitical headlines, and more. And what's behind the massive relief rally here in software this week? Have AI displacement fears faded? We'll discuss that when we come back. Welcome back. Financials participating in today's rally with the sector up more than 1%. It's been a big week for bank earnings. KeyCorp popping this week after reporting results. And joining us now in a CNBC exclusive is KeyCorp Chairman and CEO Chris Gorman, who is here at Post 9 for a change instead of Cleveland. Welcome. It's good to see you.
It's great to be here.
So how would you characterize the overall environment right now for, the big, I know you probably hate the word regionals, but super regionals like yourself?
I think the environment is good. If you think about it, the consumer's in good shape. We look at all these metrics, whether it's credit, whether it's spending, whether it's the wealth effect. The consumer is in really good shape. And our commercial customers are amazingly resilient. Obviously, there's been a series of things. We're about a year away from, the Liberation Day, and we're, about 10 minutes away from a development in the Middle East. So our clients, are very resilient, and I feel good about things. The regulatory environment is helpful. So kind of on all fronts, I feel pretty good about business.
Where does the growth come from here? Is it from just lending?
The growth will come from a variety of things. It'll come from transactional lending. So I think you're going to see a pickup in transactions. You're also seeing people, as a result of the big, beautiful bill, people are investing more in CapEx. As you know, you get accelerated depreciation. So you see some of that activity. And obviously this AI build out and the power associated with same, that's a huge kind of macro driver.
And you see that continuing, I would assume, for quite some time.
I do. David, these have pretty long lead times. And so once people are committed to these projects, the projects will continue to be funded for a while.
Yeah. When it comes to the bank itself, I think your return on tangible common equity was 13% in the first quarter.
Right.
You have a 15% longer term target. So
right.
How do you get from 13 to 15?
Well, a couple ways. One, about half of it is just the benefit of low-yielding assets rolling off. So in the next 2 years, we have about $34 billion of low-yielding loans and bonds rolling off. And other than that, we're getting a lot of organic growth. We've been hiring a lot of people. We have great trajectory right now in our commercial businesses and our investment banking business. So it'll be a combination of those. And of course, the last piece is we're returning a lot of capital to our shareholders. Between share buybacks and dividends, we'll return about 9% of our market cap to our investors this year.
What I'm actually curious about, you mentioned credit was good from consumer. Do you have private credit exposure?
We do have some private credit exposure, and we feel good about that exposure. It really, when people talk about private credit, it's about a $3 trillion market. So it's a bunch of different things. We have some exposure, and we feel good about it. I actually think what's going on in private credit could actually benefit the banks. And I say that because private credit has been a factor in an ever-expanding universe of loans. And to the extent there are redemptions, one of the first things you do if you have redemptions is you stop, making new loans. And so I actually think some of the activity,
you will be able to generate some of those loans.
Yes, I think some of that lending activity will probably come back to the banks.
Are you loaning to software businesses or rethinking how you do that?
We don't have a lot of exposure to software businesses. We have about 300 million of direct and indirect. We have about 1.2 billion. So that's not an area of concern for us.
We spoke to one analyst who said on the call, and this was his words, you sounded a little more downbeat than some of your peers on the prospects for investment banking and middle market M&A.
Yeah.
Do you think that's a fair characterization, and if so, why?
Well, no, I don't think I'm downbeat. We had a record first quarter in our investment bank, which was higher than the record first quarter we had last year. Last year, we had our second best year. Our backlogs are at records. What I did say is we haven't yet seen the pull-through of middle market M&A that we would have expected at this time. So we have record backlogs. We had a record first quarter. I actually feel very good about the business.
Well, why haven't you seen that pull through then?
I think because what's gone on in the market so far is the total number of announced deals, as both of you know well, way up. It's like up 46%. The number of actual transactions is down 26%. So what you're seeing is that there's a little bit of a divergence between the largest banks who are advising on the largest deals and middle market banks like ourselves. But the backlogs are there, and I feel good about it.
What about deals in your own space? Everybody always says that this sector needs to consolidate.
Yeah,
what do you see ahead?
I don't think there's a lot of activity. Well, first of all, there's no question that our industry will consolidate. There's no other country on the planet that has 4,400 market participants. If you go back 20 years, I think we had 20,000. So I think there will be consolidation. As you know, there were some deals announced kind of in the back half of last year. I don't think there's a lot of activity. When we get through some of these times of uncertain macro issues, I think you could see, more consolidation going forward.
Chris,
Sarah.
do we ever get through those times of uncertain macro issues?
I'm looking forward to it. I'm hoping for maybe 60 days or so.
60, take it, right? We don't take 60 days.
Do you think that what's happening now in Iran and the rising gas prices, have you seen an impact on consumers yet?
We really haven't. That's what's interesting. And we look at our consumers carefully. As we look at our loan portfolios, where we have seen some impact, obviously we finance some oil and gas companies, and to the extent that they're hedged, if they're unhedged, they're making a lot more money. If they're hedged, they're making, not making as much. Transportation has been impacted. People that don't have surcharges built in, they've been impacted. We've yet to see it really impact our consumer discretionary customers. We're watching that closely. Eventually, if gas prices stay this high for an incredibly long period of time, it has to crowd out some spending on behalf of the consumer.
It's very similar from what we heard from the CEO of Pepsi. I mean, we heard it from Ray Washburn last week, who owns a lot of the shopping malls. Do you see an impact, a positive impact? We hit the tax refunds and how they're tracking higher so far this year.
I think that will be positive. The average refund is going to be about $1,000 more than it was last year. And you combine that with, low tax rates. And then again, the big, beautiful bill doesn't do a lot for huge companies, but for small companies, this accelerated depreciation, I think those are all positives. I think those are tailwinds for the economy.
So should the Fed be cutting this year?
I personally don't see it. I think one of my concerns is I think inflation, regardless of where oil is trading today, I think inflation is pretty stubbornly high. And I don't really see, my base case is that the Fed, stays where they are for the balance of the year. The real interesting question will be, ultimately, is the next move up or down? That'll be interesting.
You think there's a chance it could go up?
I think there's
pretty high bar.
I think there's a chance that nothing will happen for several meetings, and then ultimately the next move could in fact be up.
Is that just because you're a banker and you benefit profitability from higher rates?
You're really offending your sensibilities here, Chris.
No, we're actually pretty well hedged. We're neutral. We're just fine. And what's probably going to happen is what you could see is
nothing.
You could see nothing for a long time, and then I think you could see a steepening of the curve.
Well, this was a treat having you in the studio in Post 9. Thank you for coming in.
Well, thank you for having me. Always great to see you.
Chris Gorman, CEO and chair of KeyCorp.
Up next, the CEO of Anthropic is reportedly headed to the White House today, aiming to defuse that pretty vicious fight with the Pentagon. We're going to take a look at how that meeting could reopen the possibility of Anthropic working with the Pentagon again, and much more ahead as well on big rally. And in fact, we're hitting some new highs here for the morning, up 1.5% on the NASDAQ right now, given that wow, look at the decline. Look at that, Sarah.
14%, $81.
Talk about lower gas prices. We'll be right back.
Chris is getting his relief.
Welcome back. The CEO of Anthropic reportedly scheduled to meet with White House Chief of Staff Susie Wiles today. Megan Cassella has been following that story for us and has more. Megan.
Guys, good morning. That's right. So that's according to multiple reports citing people familiar with the meeting. The White House, though, not responding to my request at this point to confirm the meeting. But it does come amid Anthropic's fight with the White House over its Claude AI model. Now, you guys will remember the Trump administration in February sought to blacklist Anthropic, ordering all federal agencies to stop using its technology, labeling it as a supply chain risk to national security. And that all came after Anthropic refused to let the government use its models without any restrictions. But now the White House is reportedly looking to give U.S. agencies access to a modified version of Anthropic's new Mythos AI model. So on all of this, a White House official does say in a statement to me this morning that the White House continues to proactively engage across government and industry to protect the United States and Americans, including by working with Frontier AI Labs to ensure their models help secure critical software vulnerabilities. The official went on to say, though, that any new technology that would potentially be used or deployed by the federal government requires a technical period of evaluation for fidelity and security. The collective effort, they say, of all involved will ultimately benefit industry and our country as a whole. So, guys, not engaging on the meeting at this point, but the official there highlighting that they do want to see a period of evaluation for any technology that might be used by the government. Guys.
But, Megan, an important point that you've raised here is it very well may not be at all about the relationship with the Pentagon, maybe more about the relationship with the NSA. I don't know. But, I mean, if the government were to have access to Mythos Preview, which, as we know, is not available, they haven't released it. It's part of Project Glasswing. Conceivably, they could, I don't know, it could help them, I guess, crack a lot of potential software out there of our adversaries.
Absolutely. And that sort of highlights this sort of awkward embrace between the administration and Anthropic right now. On one hand, the court case is ongoing. The Pentagon has sought to blacklist them. They're not using some parts of their technology. But now the administration appearing to acknowledge, according to reports, according to the fact that this meeting is even happening, that they want access to the new Mythos model, that turning their back on it might leave the government vulnerable, that they should want to be using something that can help them boost cybersecurity. So on one hand, not wanting to use parts of the technology, caught in a fight over here. On another hand, recognizing that they might need to use parts of it on the other hand. So the fact that the meeting is happening at all sort of underscores all of that taking place and the fact that there might at least still be some relationship between Anthropic and the administration.
Yeah. Sarah, did Besson say anything when you met with him earlier this week about the meetings that he and Powell had with the banks around the same issue?
We did. We talked about it. And he said actually the media reports about it, about him urgently calling all the bankers, a little bit overblown. He said they were all in Washington for a regulatory meeting. He got wind of the update, the Anthropic update. And, he and Powell said, well, they're in town. Let's call them over and let's just find out. There's always a concern when you have some sort of new cybersecurity development that the bad guys want to go after our financial system. And so he just wanted to get with the banks to make sure they feel covered and sort of safe and are aware of some of the changing risks and dynamics. So we know the federal government's paying attention.
Right, exactly.
That's the point.
Exactly.
All right, Megan, let us know if you hear anything else. Thank you. After this, have AI displacement fears faded for software? We're going to look at what's driving this massive relief rally over the past week, just getting more fuel today. Look at the software ETF, IGV, up another 2.3%. Stocks overall hitting new highs this morning, and oil sinking. As President Trump just posts on Truth Social, Iran has agreed to never close the Strait of Hormuz again. It will no longer be used as a weapon against the world. That's certainly why you have oil plunging in part, also the ceasefire. We'll be right back. Welcome back. Software stocks rallying today along with the broader market, adding to a pretty big rebound as some AI replacement fears appear to ease. Seema Modi's looking at this week's relief rally, what it could signal, and just what you're hearing about the sentiment out there.
Yeah, certainly sentiment has improved, Sarah and David, but there have been a couple of drivers. First, Oracle decision to partner with Bloom Energy. That did serve as a key catalyst this week. It proved to the market that, like Google, Microsoft, and Amazon, Oracle too is finding ways to become more energy efficient as it plots its data center pipeline. With Oracle's 30% gain this week, founder Larry Ellison, who is the majority shareholder, is up about $50 billion on paper. Now the conversation shifts to earnings, which are around the corner. RBC Capital analysts are expecting three major trends to look for. One is software companies cutting costs. Analyst Rishi Jaluria does see headcount growth decelerating in the coming quarters. Buybacks to continue. We've already seen that from Salesforce, Intuit, Adobe, who have bought back significant amount of shares. And a hard pivot from those seat-based consumption models to a more growth income-based monetization model. ServiceNow will be the first report that we get next week. Oppenheimer analysts conducted channel checks, and they believe ServiceNow could become among the first enterprise companies to generate more than 10% of revenue from AI in the fourth quarter. Analysts there maintain an outperform rating on the stock, but cut the price target to 130 from 175. And if we take a look at the week, some pretty significant gains. I know you guys have been discussing this, but the IGV software ETF is on track for its best week on record if it closes up more than 15.5% for the week, which we're right about there right now, guys.
But despite this week, I mean, it doesn't mean that there still aren't going to be a lot of debates about the winners and losers and those software companies that are perhaps well positioned and others that will simply find their business severely challenged by the latest model from you name it.
Absolutely. I think one proof point this week was Anthropic releasing a scaled down version of Mythos, Opus 4.7. I think that delivered a message to the market that perhaps future AI models that come to market, David, will be released in a more thoughtful manner. We did see a lot of the cybersecurity names rally on that specific news and outperform CrowdStrike and Palo Alto as they try to figure out how to identify some of the vulnerabilities attached to Mythos.
I've also heard this idea that maybe there's a rethink that some of these updates, like a Mythos, cyber updates, could be a catalyst for Palo Alto or a CrowdStrike, because if we're able, if first of all, they're partnering with them, and if they're able to identify more serious risks, they still need the software companies to come in and fix, right, some of the cyber problems. In other words, it could actually drive more business rather than take it away.
Sure,
and that's something out there.
That was a point that the CEO of Palo Alto Networks, Nikesh Arora, made in a blog post just 10 days ago, saying that we must partner with the likes of Anthropic and OpenAI to ensure that we can create this sort of comprehensive cybersecurity solution. You can't just rely on the LLMs. So the key is how they partner and what type of ways they can upgrade their security stack. That's what the type of upgrade we're still actually waiting for from those companies.
Okay, Seema, thank you. Seema Modi. Much more on this big move lower in oil prices, move higher in equities around some of the Iran headlines this morning. Money Movers has it covered for you when we come back. Good Friday morning. Welcome to Money Movers. I'm Sarah Eisen with Mike Santoli, live from Post 9 of the New York Stock Exchange. Today, oil prices are plunging and stocks are surging. As President Trump and Iran declare the Strait of Hormuz open for business, NASDAQ on track for its longest win streak now since 1992?
Yes, absolutely. And yes, I remember it. Plus, Netflix among the biggest laggards this morning, shares tumbling on weak guidance and the announced departure of its co-founder and chairman, Reed Hastings.
And New York City Mayor Mamdani following through on his plans to tax the rich, touting a new levy on ultra-wealthy non-residents who own luxury second homes in New York City. Witkoff CEO Alex Witkoff says it will only lead to, quote, driving out capital and destroying the city. Well, he'll be joining us to explain that hot story.
Right now, markets whistling higher, actually not too far from the highs of the day. The S&P 500 up 1.2%, the Dow ahead by full 2%. It was a tech-led recovery over the last, week and a half, 2 weeks. Now it's consumer and cyclicals joining the party as oil prices decline. Treasury yields also to the downside. They were near 4.3 overnight, now down to 4.24%. Let's first start with oil prices and the tumble we're seeing today as Iran declares Strait of Hormuz open. Pippa Stevens has more. Pippa, the oil market, as I guess we've discussed, wasn't fully acting as if this was going to be an indefinite closure even before today. And now, of course, we have this relief.
That's right, Mike. And the market seems to think that the strait is now open, with President Trump saying just now that Iran has agreed to never close the Strait of Hormuz again and that it will no longer be used as a weapon against the world. And that follows the Iranian foreign minister saying earlier that the strait is open, but there does seem to be a caveat, since he pointed to a coordinated route as announced by the Ports and Maritime Organization of the Islamic Republic of Iran. Now, Iranian state media also saying the passage of vessels must be coordinated with the Iranian forces responsible for a passage. Now, oil prices are accelerating losses, with WTI now down here more than 13% and just about $14 above where it traded prior to the war breaking out. The market clearly taking this as a positive, but everyone will now be watching the ship map even more closely than before to see if flows actually start to resume. The TD Securities' Daniel Gali telling me just now that we're going to have to see actions instead of words. He also said that oil is likely to remain elevated longer term, with 90 the new 60, and the world will have to change its mindset about energy security. But for now, guys, the market clearly taking this as a positive.
I mean, down to 80 now. That's what I was going to ask, Pippa, is how fast it can fall and how far, given that some folks are still warning about longer-term damage to facilities and supply.
It definitely feels like a knee-jerk reaction right now, Sarah, and people are saying that we're going to have to actually start to see resumption of flows through the strait. Bob McNally from Rapidan Energy telling me that this could more likely just be another head fake, even though the market is clearly pricing this as a big breakthrough that might not necessarily come to fruition. But I think also once we do get a resumption of traffic, I think there will be a rethinking about what energy security looks like going forward, and we're probably going to see more pipelines being built. Maybe we'll see some more refineries come online, given that we have seen places like Australia be especially tight for fuel, including for diesel, which is the backbone of their mining industry. So I think that even once flows start to resume, the Strait of Hormuz is not going to handle the same type of traffic it did before, because now people are going to be looking for alternative routes. And then what does that mean in terms of the price of oil? And if you are spending a lot more, if you are becoming more capital intensive and building more infrastructure, including pipelines, what does that mean for what the price of oil needs to look like? So it's going to be, for lack of better words, kind of a whole new world for energy looking forward, just given how large the disruption has been and how Iran has shown that they can effectively block the strait.
Yeah.
And of course, Pippa, this price relief we're seeing, as would be expected, is being more pronounced on the short end, on the near-term contracts. So looking at, December WTI, it's down more like 6-7% from yesterday, and still in that $70 or above $70 a barrel area. So I guess we have to watch that to see what the trend is shaping up as.
Yeah, we definitely need to watch the curve. And then I think the other point is that there is going to be a need to refill all this inventories, longer term. If you look at the SPR swap that was agreed to, that is going to be refilled at 120%. And so that does create more demand longer term. We had that, historic 400 million barrel release by IEA parties. And now a lot of oil has come out of storage, and we've seen OECD stocks fall. And so that will need to be refilled. And then there also might be a move by governments to not only refill them, but to increase those levels, given we've seen what kind of impact this can have. And so countries looking forward are not going to want to be in this position again. And so, to what extent that creates a longer term demand profile, then we could see that higher for longer scenario for prices.
Okay, thank you, Pippa Stevens. For more on how investors should be thinking about the latest developments in Iran, let's bring in DWS Group America CIO David Bianco. Welcome back. It's good to have you.
Great Friday morning.
Yeah, great Friday morning for the market as well. Does it make you change your outlook on any particular group or earnings or the economy or anything?
Let's start by acknowledging great news. Great news for America, great news for investors this week, and a big thanks to our military. Our thinking while we look at this news is the S&P 500's rallied on the idea that the U.S. is winning. And while that's not a certainty, that does look like the path that things are on. The S&P 500's over 7,000. We could quibble whether that's a little rich given the risks that are still out there. However, we're trying to focus on what industries. I know those are looking at consumer. And they're running away from the energy stocks now, and we've been underweight.
Airlines are at the top of the list.
But yeah, things like airlines and transports and consumer stocks are having a great Friday. But we would argue that financials, technology, even healthcare, electric utilities are still where the secular strength is, even where some of the benefits were even during the conflict, like utilities. And I think that's what you should stick with through the summer and into the end of the year.
It's been an interesting dynamic. The market, as usual, kind of got ahead of the headlines to a fair degree. The market was treating this as at least the peak of uncertainty was behind. The de-escalatory momentum was likely to kick in. Now we have confirmation of that. Right. And so, but what it did to get up to this point, this, 10-12% rally, even before today, was go back to the AI infrastructure stocks, the power industrials, all the adjacent CapEx-related trades, and now we're getting a little more of a flush into the stuff that, as you mentioned, economically cyclicals. But we're also seeing just risk appetites have a dam break, right? It felt like people were left behind, feeling like they had too little risk on, and now a lot of the speculative stuff is running and the high beta.
Always a dip to buy, apparently. But as you said, sticking with fundamental strength through thick or thin makes sense. The data center, the AI trade was so strong. We had 20% upward revisions in the earnings estimates of semiconductor and equipment stocks. Those stocks are still attractive to us. But a sector like software or industry like software, which has become a bad word, and software as a service, SaaS is a dirty word, we're going to just start saying soft tech. And the earnings estimates have been solid there. And that's an area where we see some opportunity too. So we think it's a spring to get back to tech because that's where the strengths in the future are. Sure, I'm glad that the risks have been reduced for the more vulnerable parts like the consumer, but they're not completely over. Oil might go back up, maybe it doesn't. But interest rates, there might be some lasting damage to the interest rate outlook. I still see it as the spring didn't play out as thought at the start of the year with it's a spring for the consumer and home building and so forth. Not so much. It's a spring of tech once again.
But software is included in that for you. You're not worried about AI,
especially the big ones. We can have a whole sidebar conversation about small cap software and private software, but the biggest of, I'm not even sure I'm going to call them software companies anymore. They're hyperscalers. They're critical systems and security applications, and they're not going anywhere, and they're going to benefit from AI. And they're leaders in AI, most of them anyhow.
One of the interesting setups, too, here is that even though the market has gone almost vertical since March 30th, it's not that far above where it was last fall. So we had this multi-month period of kind of churning around. And it was really October when Mag 7 and Peak and, it peaked in AI on a relative basis peaked. So at this point, do you think we're slotting back into, a technology-dominated tape? I know you said you like financials.
I've got plenty of things I've been right and wrong about, but last autumn we argued diversify away from the Magnificent 10, other sectors to look at. Since early March, the conflict, we've been saying let's get back to tech, all of tech, especially the big stuff and the data center and AI related stuff. Yeah, I think this is still the leadership in the S&P 500. If the S&P just keeps marching higher, it's likely to be led by tech. But the downside is more protected given the waning geopolitical risks.
I know you mentioned the home builders. I mean, they're right at the top today, along with the airlines today. Well, no, that's my question: is whether this completely changes the rate outlook and what the Fed is able to do.
There's a whole lot to be said about the Fed at this stage. After all these years of the economy proving resilient over and over again, and inflation proving persistent over and over again, maybe the Fed should just wait. Take your finger off the button.
Well, they're waiting now. I guess the question is in the end of the year.
There's a good chance of a cut by the end of the year. I think the key here is how does the 10-year yield react to that? Because, what is weighing on the economy is 10-year treasuries at 4.25, and they got higher owing to the inflation, the cost of conflict, and the very high deficits.
Yeah, but now, I mean, consumer inflation expectations should come down if we see the price of oil and gas come down.
Well, aren't we supposed to ignore oil and gas?
Right. Well, that's one view. So it sounds like you're not convinced that
inflation's been sticky for a very long time.
Yeah. Okay. Well, David, thank you for coming by.
Thank you.
Always good to get your take. David Bianco.
All right, coming up, Netflix shares sinking this morning after an earnings miss. Co-founder Reed Hastings also announcing he's leaving the board. We'll break down that quarter next.
And later, Witkoff CEO Alex Witkoff joins us as New York City Mayor Mamdani announces the city's first ever pied-à-terre tax, a tax that the mayor says will target rich non-New York City residents who own luxury properties here. We're going to break down the potential impact on the city's economy when Money Movers comes right back. Welcome back. Shares of Netflix are sinking this morning after earnings miss estimates. Julia Borson here at Post 9 with more on the story here. And it really does stand out, especially with stocks rallying so hard.
Yeah, so many different factors at play here for Netflix. On top of that earnings miss, the company also delivered guidance that missed expectations. Netflix also announcing a leadership shakeup as co-founder Reed Hastings announcing he plans to step down from the board following the company's annual meeting in June. Now, going into this report, investors were seeking answers on the company's roadmap going forward without the Warner Brothers deal. Co-CEO Ted Sarandos saying its core business remains strong without that acquisition, but he did leave the door open for more potential deals.
We invest in the business both organically and opportunistically with M&A, like you just saw with Interpositive. And we do that while maintaining strong liquidity and returning excess cash to shareholders through share repurchase. So M&A for us remains a tool to help us achieve our goals. And as you can see with the WB deal, we'll remain very disciplined in how we approach it.
Netflix did share a number of bright spots, saying its ads business does continue to grow. Now, 60% of new Netflix signups in the quarter were for that lower price ad-supported tier. And as reports swirl about Netflix and YouTube looking to snatch up more NFL rights for the upcoming season, Sarandos saying that the company's current NFL games are delivering value and that Netflix is in discussions currently to expand that NFL partnership.
It's interesting, the comments on M&A. I think there was a little bit more clarity gained on that in the sense that WBD was maybe idiosyncratic, right? It was in play, and Netflix stepped in. But now with Sarandos saying, look, it's going to actually be a focus going forward, probably investors have to adjust to that.
He described it as developing the M&A muscle. It seemed like this coming into play really opened their eyes to the potential to use an acquisition to acquire valuable intellectual property. They are ramping their investment in content spending, and that's something that investors are looking at right now. They have to invest more money in content. They did also talk about how they're going to use AI to bring down content costs to a certain extent or manage visual effects costs and the like. But the question is, how do they get those really valuable brands?
Who could they buy?
Well, right now, there really isn't anyone else in play. The question, though, is will we see Paramount, with the incorporation of Warner Brothers Discovery, decide that maybe they want to sell off some of those assets or some of those brands, maybe not immediately? Or you think of the smaller companies like AMC Entertainment, where we all saw Mad Men, that is a much smaller company, or Lionsgate or Starz. So there are some of these smaller players, but certainly nothing with the kind of IP we saw from a Warner Brothers with DC Comics, Harry Potter, and all of that.
That would have been more transformative, of course.
Absolutely.
Yeah. Julia, thanks.
Great to be
See
here.
you. All right, let's bring in Oppenheimer head of Internet Research, Jason Helfstein. He has an outperform rating on the stock, but just lowered his price target to $120 from $135. Jason, good to see you here. What's your view on what the street is principally reacting to here? Obviously subdued guidance, but are we seeing signs of maturity in the core business too?
I mean, I think people are worried about that. If you kind of try to take out the year-over-year compare, the 2-year growth is slowing. Not a lot, but I think it was enough to give investors pause. I think we can explain it, but I think investors wanted to hear the company to explain it. And I think it relates around the timing of when you raise the price, particularly in countries like the U.S., and the advertising cycle, which is not even across the year. And is, again, 60%, as you quoted, of the new subs are coming from advertising. It makes the kind of the incremental growth more dependent on advertising.
Yeah, I noted how you point to that advertising sales cycle is now more important when it's essentially kind of an old TV model of every almost seasonal getting the new budgets into their platform.
Yeah, I mean, ideally they'll eventually have a fully built programmatic stack. You'll have, call it tens of thousands of advertisers like the other big digital platforms do. Right now, I think there are about 4,000 advertisers, and that was up 50%. But, that's like well below what you need to have like an always-on programmatic. So there is still the old cycle of, calling up the biggest advertisers and the agencies and pitching it. And as you well know, that cycle kind of starts over the summer, and you start to see the benefit of those dollars in September. I think in hindsight, it probably would have been better if they raised the U.S. price in the first quarter. I think it would smooth things out. Now, did they not do it because of Warner Brothers? They claim that's not the case, but I do find it hard to believe that Warner Brothers like had no impact on the business, whether timing or distraction or any of that.
So Julia just told us that Ted Sarandos talked up the NFL partnership and said that they're in talks to do more and sees a big opportunity. It's notable because this week I interviewed the FCC chairman, Brendan Carr, and we talked about the NFL, and he's actually very unhappy with how much of live sports is going over to streaming and behind paywalls. Just listen to what he said about that.
I do think there's a point at which the NFL reaches a tipping point where they're sticking too many games behind a paywall, in which case it really raises a lot of questions about the scope of that.
Said that DOJ is looking into it. He said that they're looking into it at the FCC of whether there's any recommendations there to make. And I do wonder how big of a risk that is for, a lot of these media players, including a Netflix, which is now betting on growth from that.
Yeah, I guess my reaction would be that, they talked about how they were really happy with the success of the World Baseball Classic, and it drove the highest day of signups in Japan. Happy with the relationship with the NFL and wanted to expand it. But I don't see them as bidding for full season rights. I think they like sports events as a way to kind of like spike signups, spike engagement without taking that kind of big financial risk that obviously comes with kind of season-long sports. I mean, look, football is kind of like apple pie in America, and it's a very sensitive topic, and I'm not going to go there. But I do think most consumers are getting frustrated how hard it is to find sporting events due to the spectrum of ways that you can now consume content.
Yeah, although it's kind of funny in the sense that the NFL has more of its content free over the air than any other league, essentially, right now. So it's kind of an amusing target in that respect. Jason, one thing I've wondered about the Netflix business model is whether they are demonstrating that it really scales. Obviously, it's low churn, it's global, they have pricing power, but are they able to grow content spend appreciably slower than revenue growth on a long-term basis, which would obviously mean that they're scaling in a profitable way?
Yeah, I think you've seen it. I mean, they grew content spend 7 to 8% in the past 2 years. Revenue grew well in excess of that. We have content spend growing 10% per year the next 2 years on our model. Revenue's growing double digits. So I think the reason why they were so comfortable with the Warner Brothers deal is because they knew their ability to pay back the debt, given how profitable, how free cash flow generative the business is. So ironically, I think now that they're not doing Warner Brothers and Paramount is going to need to kind of find cost savings to kind of justify the deal and kind of pay down, et cetera, I actually think it's a greater opportunity for Netflix to lean in to those content relationships. So again, we think this business scales kind of very well. There is some investor debate if the business becomes more advertising dependent, does that get a lower multiple than a pure subscription business? You would probably generally say yes, but I think the point is, how many businesses of kind of this scale and size, that can kind of generate this kind of like high teens free cash flow growth year in, year out.
So let's talk about how to value the stock now. I think you reduced your target to what, 120, which is still a big boost from where we are right now. What do you think the market is pricing in, and where's the gap there from what you see?
Sure. We're doing 30 times earnings. That's pretty similar to where Spotify is trading at right now. On next year, I think it's like 28, 29. My sense is like the earnings number, though, can go, probably goes a bit higher. So if you assume there's a little bit of upside to 27, maybe you're talking about 27, 28 times next year's earnings. Look, I mean, I think, again, with the more of it comes from advertising, you'll probably get a debate of, well, should it be like more like 25, not 28? But you really haven't seen the advertising, really like move the business yet. Like while it's doubling this year to $3 billion, it's still a very small percent of a business that revenue wise, we're forecasting this year is going to do $51 billion, right? So it's really over the next few years when advertising becomes a $10 billion business and then actually starts to move the business more, I think investors will reward that.
Gotcha. Yeah, it's been fascinating how Netflix and Spotify, the stocks over time really have mirrored each other over the last, let's say, year or two. Jason, appreciate the time. Thank you.
Thank you for having me.
When we come back, Anthropic CEO Dario Amodei reportedly heading to the White House today. That's ahead of the company's potential Mythos release to government agencies. That's the cyber update. We're going to discuss what's on the agenda here.
Plus, oil prices are tumbling today as Iran declares the Strait of Hormuz open. We'll look at what that means for the broader market next. We are back in a moment. Strong rally again at all-time highs for the S&P 500, up 1.25%, pretty close to the highs of the day as oil prices declined double digits in response to the news that the Strait of Hormuz is open, at least until into next week, the length of the ceasefire.
All right, time now for a news update. Contessa Brewer has it for us. Morning, Contessa.
Hi there, Sarah. The FAA says it's going to limit flights at Chicago's O'Hare Airport this summer, trying to alleviate delays at one of the country's busiest hubs. The number of flights is going to be capped at just a little more than 2,700. That's down from more than 3,000 scheduled on upcoming peak days. The government says it would have represented a jump in traffic of about 15% from the busiest days last summer. Ford is recalling nearly 1.4 million F-150 pickup trucks following a federal notice about a gear shift issue that can increase the risk of a crash. The National Highway Traffic Safety Administration says the company was aware of the incidents related to the issue and that dealers will update the truck's powertrain, control module software as a remedy. And more than 100,000 people in Cameroon attended a mass by Pope Leo as part of his 10-day trip across Africa. The Pope openly criticized the uneven distribution of wealth and called on attendees to reject violence as a means to get ahead. That's the news right now. Mike, I'll send it back to you.
Contessa, thank you.
Sure.
Still ahead, the major averages are back at record highs. So can the momentum continue? We'll break down the bull case with one market strategist when we come back. Welcome back to Money Movers. Oil making a big move lower this morning after Iran and President Trump announced the Strait of Hormuz was now, quote, open. Our next guest telling his clients about a bull case emerging in his most recent report, now saying today's move in oil only amplifies the market's bullish factors. Let's bring in 314 Research co-founder Warren Pies. Warren, good to see you. I mean, the market obviously treating it as confirmation that we have an outbreak of certainty here after, a month and a half of questions around all this. So how far can it carry us? Where do you think, first of all, where oil heads from here?
Yeah, thank you for having me. As far as oil goes, I think one of the things we've talked about throughout the closure of the Strait of Hormuz is the longer it goes, the higher you raise the long-term oil price. So if we actually have an imminent reopening of the Strait, I think we obviously dodged the worst case scenario. I think long-term Brent's going to settle in somewhere around $80 a barrel. When I say long-term, we probably average for the next 2 years, so a bit lower than where we are right now, but the market's pretty good at getting us to that equilibrium fast. But I think it really does. It amplifies the equity bull case, like you said. To me, we were very bullish coming into the year. This was a bit of a detour. But what's happened over the last 3 weeks, what's happened in developments with AI and the Mythos announcement, kind of in the surge in compute demand, EPS and forward earnings growing 9% year to date while the market corrected. And then this price action, 7,000 has been that level the market can't topple, and now we're breaking out above that definitively. I mean, this has the looks of the next leg of the bull market to me.
So there was a lot of talk, and we've gone into it quite a bit here, right around the lows, March 30th, and then the beginnings of this comeback, that we might not have gotten sort of that full, comprehensive liquidation, washout type conditions the way we did April 2025. Now, whether that matters or not, who knows? Because clearly the market was underpositioned for this risk-on move and has to chase it for the moment. But what do you think the actual upside is from here? You mentioned valuations got reset. Clearly sentiment also did. But did we actually get this kind of huge momentum push out of the low?
Yeah, I think our target for the year was 78.50, and we haven't taken that down. And so I think that's still a reasonable destination for us. And the acceleration in earnings, I think, supports the case. The fact that we had an 18% correct, yes, we didn't correct that much on the index, but the PE ratio itself between earnings growth and the index coming down corrected 18%. It's very rare to get an 18% correction in the multiple outside of Fed tightening or recession. You only saw it a couple times, 2010, 2012. We saw it last year with tariffs, and you know what happened after that. So I think we have the positioning has been reset too, which you always need that to carry the next leg of the bull market. So I still think that the upside target we laid out at the beginning of the year, 78.50, is intact.
Warren, stay with us if you would, because the market is hanging on every headline here on Iran, and we do have some breaking news from Washington. Megan Casella, what do we have?
Sarah, we've had a lot of mixed messaging on just how reopened the strait might be, with all these various statements from different government officials from the U.S. and from Iran. And the latest we have from the Iranian side threatens to throw some cold water on this idea that the strait is completely reopened. This is a report from Tasnim News, which is affiliated with Iran's Revolutionary Guard Corps. And what they say here is that tweet from Iran's foreign minister this morning that sort of kicked off this rally saying the strait was completely reopened, the military-linked news agency now saying that was a bad and incomplete tweet that created various ambiguities. And what Tasnim News is reporting is that one of the various most important conditions that's attached here is the full supervision of the Iranian armed forces over the passage and movement of ships through the strait. And they go on to say that the passage and movement will be considered null in case the alleged maritime blockade continues. We know that we heard from President Trump this morning, guys, that the naval blockade does continue, will remain in place, the president said, until such time as our transaction with Iran is 100% complete. Trump had said he thought that process would go very quickly, but that the blockade remains in place. Now we're hearing from Iranian state media that the strait is not, in fact, reopened as long as that blockade remains, and that even if and once it does reopen, that it will require coordination with the Iranian military. So not, in fact, quite as completely clear as we may have thought, guys.
Okay, thank you, Megan. We'll look for clarity, I guess, on the U.S. side from that. But for now, thank you. Warren Pai is still with us, of course, 314 Research co-founder. Does that change anything for you?
No, I don't think so. I mean, I don't think you want to let go of your oil hedges at this point. I mean, our recommendation back on April 1st, we boost our equity exposure. And then later on April 9th, we boost our commodity exposure and basically said, look, if you want to be long equities here, if you want to be fully invested, you need to have, I think, an oil type hedge, commodity hedge. And so this is crazy times. And we have had a lot of inventory that's going to be forcefully drained because of this closure out of the oil market. And like I said to Mike, that we're going to have a long-term elevation in the price of oil. So who knows what the path is to get to the end of this thing. I wouldn't let go of my oil hedges quite yet. But I ultimately think the path of travel is to de-escalation. That's what equity markets picking up on.
Yeah, for sure. And I know you like the tech reasserting leadership from the broader list of stocks, Warren. We'll talk about that again soon. Appreciate the time this morning.
Thanks for having me.
Not doing much to shake the confidence here. We're still near the highs of the day.
Oil's up $1 off the lows, but not really much of a change.
Yeah. Stocks, though, roaring higher. Coming up, Witkoff CEO Alex Witkoff joins us after New York City Mayor Mamdani announces the city's first ever pied-à-terre tax. It's a tax on second homes valued above $5 million. We'll discuss the economic impact right after the break.
When I ran for mayor, I said I was going to tax the rich. Well, today, we're taxing the rich. I'm thrilled to announce we've secured a pied-à-terre tax, the first in New York's history. This is an annual fee on luxury properties worth more than $5 million, whose owners do not live full-time in the city. Like for this penthouse, which hedge fund CEO Ken Griffin bought for $238 million. This pied-à-terre tax is specifically designed for the richest of the rich, those who store their wealth in New York City real estate, but who don't actually live there. But even so, they're able to reap the huge financial rewards of owning property in, dare I say, the greatest city in the world.
All right, that was New York City Mayor Zohran Mamdani in a video he posted on X this week on Tax Day announcing the city's first pied-à-terre tax. So the policy is intended to target the, quote, richest of the rich, singling out their Citadel CEO Ken Griffin for his purchase of that multi-million-dollar penthouse back in 2019. It's all part of a wider effort to plug a $5 billion gap in the New York City budget. Let's bring in Alex Witkoff, CEO of real estate firm Witkoff Group. The firm maintains a large presence in New York City, as well as a growing presence in Miami. It's good to have you, Alex. Look, there's no comment from Ken at Citadel, but something that I pointed out on social media is that Ken's building the tallest office building on Park Avenue in New York City, employs thousands of people, is investing probably millions, if not billions more, to employ more people. What kind of effect is this going to have?
Sure. Thank you for having me, Sarah. Everyone's watching this. I mean, there's no secret that the construction of office throughout the entire country is down precipitously. And Ken Griffin is taking a huge investment to build a 1.7 million square foot office building, which will create thousands and thousands of new jobs, not just white collar, but also blue collar, whether it's the construction to plumbers, mechanics, electricians. And he's doing the same thing in Miami, and he's being heralded. And I think everyone's watching. Every job creator, everyone who's considering placing investments is watching. And unfortunately, it's just bad policy, and everyday New Yorkers are going to be the ones who suffer. Ken Griffin will be fine, but when the jobs are lost and they flee and continue to places like Miami, it's the everyday New Yorkers who are going to be the ones who bear the brunt of this very bad policy.
So that's my question: is whether the fleeing is a real risk here. A lot of businesses. I mean, they're long term, right? You're a developer. You think about the long term prospects. So, if this mayor's here 4 years, does that make you switch direction because of bad policy, or not?
Look, it's not even a question. Are people fleeing? They already are. Every 3 minutes and 20 seconds, a taxpayer leaves New York, and consequently, New York is projected to lose over $3 billion this year of taxable revenue. And this pied-à-terre tax that he heralds as some novel policy, it exists. This isn't the first time it's ever been done. It exists in some form in Toronto. They're about to implement it in Rhode Island. And it's existed since 2014 in Paris. And what's happened in Paris? You have home prices that are most elevated among any city in the entire world. There's no house price affordability there that benefits everyday people in Paris. And also, you have over 100,000 people have fled Paris over the past decade. The policy exists, and it's never worked.
Alex, I mean, I guess just to speak to why this might not be as damaging as some of what you say suggests. One is New York City's never been an inexpensive or low tax venue, and yet we still do have wealthy people wanting to have property here. We do things like New York City 6% hotel tax, 6% parking garage tax for non-residents. It's a classic thing to kind of tax people who don't necessarily live here because presumably they want to be here for other reasons. Finally, for a second home tax, you're not really competing for somebody to live there 183 days a year. And so therefore, somebody could have a place in Florida for their full-time tax purpose and then also pay the surcharge here. I just wonder if any of that mitigates the potential damage.
Carl, you have many public company CEOs on this show, and look at the budget of New York. Kathy Hochul is including this pied-à-terre tax in her New York State budget for this year, which is going to be $260 billion. That's up over $100 billion per a year. Everyday New Yorkers are not feeling the benefit of that in terms of the school system, in terms of crime and safety and policing, which the police force hasn't grown in many, many decades. New York does not have a revenue problem. They have a spending problem. This pied-à-terre tax is nothing more than covering up for decades of financial mismanagement. You have already tons of transaction costs. The tax burden in New York is the highest in the entire nation. You have transactional costs, including mansion tax, which they just redid in 2019 to lower the threshold to $1 million. You have transfer taxes, you have annual property taxes, and then as we know, you have income taxes, which when you combine state and city are among the highest in the nation, and people are leaving and you're losing revenue. And consequently, what do you do when you do a pied-à-terre tax? You stifle investment. You discourage people from buying apartments. You encourage then construction companies and all these jobs that are created when these buildings get built. Those are blue-collar jobs. Over 300,000 New Yorkers are employed in construction jobs, and they depend on those jobs. And when you have investment stifled, you have construction jobs that dry up. And when you contrast that with the sentiment coming out of places like Florida, what is Governor DeSantis doing? He's not focused on how does he stifle and not encourage people to invest and come be here. He's focused on how do I drive down the cost for everyday people in Florida and actually trying to lower the property taxes for people who live in Florida. Not how do I raise them from people who are spending here and discourage them from doing such.
So I guess the question, Alex, is New York City different? Is it just unique and one of a kind? Because, you know, we've seen bad policy impact places like Chicago and San Francisco and the migration, but you know, it is hard ultimately to compete with New York City for talent and diversities and university and just so many things.
Well, look, I love New York. I grew up there. I think it's one of the greatest cities in the world. And that's why I'm speaking, because it saddens me to see this really bad policy. But, you know, since 2017, with the changing in the SALT Act, states are competing with each other. Companies can increasingly, particularly with work from home, and the increasing growth of AI, they could pick where they grow jobs, and you're seeing them pick elsewhere. JP Morgan, Jamie Dimon just came out and said there's more jobs now for JP Morgan in Texas than there are in New York. You're seeing companies like Morgan Stanley and Goldman Sachs choose to grow in places like Georgia and Texas. They're not choosing to grow their finance jobs as much in New York. You're seeing Apollo even announce a second headquarters. They'll be the focus of their job growth, and that won't be in New York either. So unfortunately, this bad policy is pushing companies to not grow in New York. And unfortunately, New Yorkers are the ones who are bearing the brunt of this bad policy.
Alex Witkoff, thank you for joining us. Really good to get a real estate developer's point of view on all this.
Thank you for having me.
We're getting a news alert on Cerebras. Seema Modi has the story. Hey, Seema.
Guys, we now have two sources who confirm that Cerebras, this is the AI semiconductor player that really focuses on inference, is set to go public. It's planning to go public and file its S1 after the bell today. This is a company that is a small but growing competitor in the larger semiconductor industry with the likes of NVIDIA, AMD, and Broadcom. We also have confirmed that it now counts OpenAI as a customer and that OpenAI will be paying about $20 billion to Cerebras, and Exchange will also get warrants as part of this deal. So it sort of highlights once again the circular nature of these, of what we're seeing across Silicon Valley. But this will be an interesting company to follow, because while we've been seeing a number of competitors in the broader AI ecosystem, data centers, industrial names within the AI space, you haven't seen as many competitors in the semiconductor sector file to go public. So we'll be watching for those latest financials after the bell. And this is the second go. They initially planned to go public last year, withdrew because they wanted to revise their financials. So we'll be looking for updated numbers later.
Yeah, the market is saying windows should reopen here, and I think there's going to be a race to get ahead of the trillion-dollar giants coming to
Great point, yeah.
All right, Seema, thanks. Still ahead, Anthropic CEO Dario Amodei is heading to the White House today. That's amid tensions with the Pentagon over the government's use of AI. We'll discuss what to expect out of the meeting after the break. Anthropic CEO Dario Amodei is heading to the White House today for a meeting about Mythos. Mackenzie Sigalos has more in today's Tech Check. Mac.
Hey, Mike. So I'm here at the White House where CNBC has just confirmed that Anthropic CEO Dario Amodei could be walking through these doors here at the Southwest Gate at any moment. He's set to meet with Chief of Staff Susie Wiles. It's a sign that the administration may be trying to reset one of the most contentious fights it has had yet with the AI industry. Now, Anthropic is a no comment on this, but the White House did tell us last night that any new technology potentially used by the federal government has to go through a technical review for security and reliability. Certainly a sign that officials are already laying the groundwork for possible broader access here. Now, today's talks, they are specifically on Mythos. That's Anthropic's powerful new cyber model, which parts of the U.S. intelligence community are reportedly already testing, with Treasury and other agencies also said to want to use it. Axios reporting that some inside the administration now see it as counterproductive to keep this technology at arm's length. One person telling them that this would literally be a gift to China if they don't use it. Now, that is a major shift from where we were just 2 months ago in terms of talks with the Anthropic C-suite and the government, when essentially the Pentagon moved to blacklist Anthropic as a so-called supply chain risk. That is a fight that is still being played out in courts in D.C. and San Francisco. These talks very much separate from that, all about whether or not the government can deploy Mythos across some of its agencies. So, guys, that's what we're looking at right now.
And in order to do that, I guess it would have to remove the supply chain risk designation, which is blacklisting it.
Well, the sense is that these are actually two entirely different negotiation tracks, because at this point, the D.C. court has weighed in favor with the government to uphold that supply chain risk designation, while the court in San Francisco has said that they can stay that designation, so it's unclear where they are. But that, remember, is to use the wider family of Claude models in the context of Palantir and the battlefield, and that is separate from using Mythos. The question now, it seems that Anthropic is willing to kind of come to the negotiating table. They reportedly hired people from the Trump world, these consultants that are helping them navigate talks with the government to use Mythos. And we know that it's something that, at least behind closed doors, Treasury Secretary Scott Bessent was talking to bank CEOs about the threat potentially posed by it. Everybody wants their hands on this to get ahead of it.
Yes. All right. Keep us posted if you learn anything about those meetings. Mackenzie Sigalos outside the White House. I'm expecting Dario Amodei, the CEO of Anthropic, to be there. We've got a nice rally here, Mike, on top of what was already a very positive week. We're up 1,000 points on the Dow. It's getting supercharged now by this huge drop in energy prices. Oil prices are declining heavily on news that President Trump announced the Strait of Hormuz is open.
Yeah, there's an old saying how, the market kind of figures it out and then the headlines confirm it. And that's not exactly true here, because I think the market was being selective in how it was sort of pricing in a resolution to the crisis in Iran. Today is a more full reflection, I think, of the fact that the fundamental risks have been reduced. And obviously oil prices coming down, you get a refresh on the consumer, and it's a level of disruption and a duration of a crisis that can be handled by the underlying economy. That's the market's assessment right now.
Yeah, I mean, the rally in airlines, consumer discretionary stocks, also in the rate-sensitive stocks. Home builders are at the top of the market right now. Why? Well, because bonds are rallying and yields are coming down because, consumer inflation expectations should come down, and inflation could come down as gas prices ease here. There's also a saying, Mike, of buy the rumor, sell the fact.
Well, that's the other interesting part.
And that did not happen.
Well, it didn't happen yet, but we are running super hot. It wouldn't surprise me if we got confirmation. Now the market needs a rest.
All right, there's a prediction from Mike Santoli to start your weekend. Thank you for being here. We'll send it now to Frank Collin, Halftime Report. Have a great weekend.
Thank you, Sarah. Mike, welcome to the Halftime Report. I am Frank Collin in for the judge, Scott Wapner. Front and center at this hour, the record rebound as positive ceasefire developments. They push stocks to all-time highs. We debate the market's next move with our investment committee. Here with me today, Jenny Harrington, Amy Raskin, Jason Snipe, and Steve Weiss. But first, quick check of the markets. You can see we're in the green across the board right now, on pace to hit more record highs. In fact, the NASDAQ is on pace to hit its 13th straight day of gains, right now up about 1.5%. The Dow up over 1,000 points. The S&P gaining about 1.25. The small caps, the best performer, up over 2%. I think really this is what we have to start with. Jenny, you're right here to my left. We're seeing these moves in the markets. We're seeing the NASDAQ on a 13-day winning streak. We're seeing big upside moves over this month. Is what we're seeing today when it comes to Strait of Hormuz, or we believe that we're seeing. We're going to get more developments from our Megan Kinsella coming up in just a second. wasn't it already priced in? I mean, isn't that what the markets were saying, that they believe there's going to be a near-term resolution that would be very favorable? Isn't that what this 13-day rally on the Nasdaq's about? Isn't that what the upside moves on the S&P are all about?
Yes, I think it is. And this is where I'm having such a hard time reconciling this short term, which I've joked with my clients. The outlook to me for the very short term is cloudy with a chance of meatballs, where it's as cloudy out there and meatballs might start falling from the sky. For all you parents out there who read the book to your kids, you'll get it. But it is cloudy out there. And what the market has priced in, I think, the best case scenario. We are not even close to dealing with reverberations that may or may not come from supply chain disruptions. I mean, I was listening to the radio the other day and they were talking about rice production. And right now, apparently, there's an oversupply of rice, but fertilizer isn't getting to Asia, and the rice growing season is starting now. If it gets there in 2 weeks, maybe things will be okay. If it doesn't, things will be worse. So there's this really tough short-term outlook going on. In the longer term, I think things are pretty good. In the longer term, you can really count on 16+% earnings growth. I love the fact that the multiple actually contracted on the S&P by 10%, moving from 22 times down to 20 times during the quarter. Things are okay in the long run, but it's this battle that's out there that's hard to digest right now. And even within that, Frank, as an investor, I think you need to be really, really granular. So I don't think it's the time to say like, oh, buy Mag 7, everything's better. No, suss out all of those 7. I don't think you say buy energy. You can't even do that. And look at energy today. But things like midstream energy, and in that space, they're okay. Whereas companies that have direct fossil fuel exposure that ran up 20 and 30 and 40% in the last month, they're really getting hit hard. So no industry can be looked at broadly, I don't think. I think the short term and the long term offer two very different outlooks, and it's tough to be an investor right now.
All right, so Jenny, you're trying to suss some things out. Jason, I want to come over to you. I'm looking at the S&P up over 9% just so far this month. Also, the MTUM ETF, Momentum ETF, up over 14%. So the momentum's returned to the markets. I mean, it shouldn't just be, hey, let's just go. Let's just go. Do you have reservations about where we're at right now and the potential for a pullback?
Of course, without a doubt. I mean, too far, too fast is definitely a big deal for me, as we've seen, to your point earlier, Frank, on 13 days in a row, the NASDAQ kind of running highest numbers we've seen since the early 90s, right? So I think that is definitely room for concern for me. I think the other piece for me that plays out is just the narrow breadth that we're seeing, right? You're seeing, obviously, the S&P dramatically outpace what we've seen in the RSP, you know, the equal weight, the cap weight for the equal weight is definitely a story for me. I don't think that's healthy going forward. But what I will say from a positive perspective is clearly what's going on with earnings, right? The earnings picture is very strong. You know, revisions continue to go higher, and I think that's going to be the story, obviously, that I'm focused on going forward. But this move, although we're enjoying it for our clients as investors, is a little bit of a concern for me.
Amy, I want to come over to you. BTIG, Jonathan Krinsky out with a note. I'm going to read it in part. Still bullish, but he says a tactical pause is likely. He goes on to say he doesn't think that we need to have a big price pullback on the indices, but with caution chasing strength today. Would you chase this rally at least today, or would you give it some time to settle? We're just showing some of the headlines right there. Again, our mega sell is coming up. Iran says the Strait of Hormuz is open. The U.S. and the president say that the naval blockade is still going on. So there seems to be a bit of friction still.
Yeah, I wouldn't necessarily chase here. I think we're going to get a lot of news in the next few weeks with earnings. We'll see how they go. Their expectations for earnings are very high. We haven't seen great reactions even to a lot of beats. So I would be a little bit more cautious. And putting everything in perspective, remember, we started the year at 6,800, 6,900. So being at 7,150 doesn't, you know, if you just look at the two endpoints, it hasn't been a huge rally. And we were sort of around these levels last October. So I think we should everybody just take a step back. It feels very good. We've had this really nice run very recently, but we're going to get a lot of data, and there's still a lot to parse through.
Yeah, by the way, Barclays out with a note saying that investors seem to be pricing in a lot of hope. Steve Weiss, I know you to be one of the most hopeful investors I've ever met. On a serious note, what do you make of this? Barclays going on to say a lot of FOMO out there in the market. Do you think that's what's driving all this? Is this FOMO, or is this a real continuation of the bull market that we saw prior to the Iran conflict?
Yeah, first of all, I got to apologize to Jace for the bell ringing. They thought I was about to talk.
That's right. That's right.
Look, this is, in the last 40 years, you've seen the quickest move from being oversold to being overbought. So typically when that happens, there is a pullback. So I'm not betting on it. I'm not adjusting my positioning, but should be aware of it. And why I am conscious of it is because I still have some cash, not a lot, but I'd use that opportunity to buy in. This market, look, it's not a market any of us have foreseen. It makes no sense. It's too easy. When markets are too easy, that's when trouble starts brewing. And you can't believe the headlines. You can't believe anything coming out of headlines because there's one narrative coming from Washington. There's another narrative coming from Iran. You can't believe either one of them. So basically what you've got to do is stick to fundamentals. And if you're a long-term investor, stick to that, block out the noise. Today, we're seeing a big move in the market, 1.5% to almost 1.3%. It's not normal for those moves to happen every day. It's just not. So I'm still optimistic on the market because these markets just want to go up. And markets generally do go up. If you go back through time and you take a look at every major decline, including the crash back in the 20s and 30s, we're a lot higher. I mean, it's such an obvious statement, but it's true. So again, pick your spots. You take a look at some stocks that get dislocated on a short-term basis. Those are good opportunities to pick them up. And we've seen that with Meta. We saw it at Microsoft. There's one today we're going to talk about as well. So that's how I'm playing it. You just can't jump on the highs. You can't jump on the lows. You just got to be very even keel.
All right, here to help us parse some of these conflicting headlines, we're going to bring in our Megan Casella live in our D.C. bureau. Megan, we're seeing two conflicting statements here. Iran says the Strait's open. The White House and the president says the naval blockade continues. What's the very latest?
Frank, you're right that there are a lot of moving pieces here and a lot of conflicting reports. So let's lay out a little bit of everything that we've learned over the past couple of hours. The most recent is that President Trump has been making calls to reporters, a number of calls, where he claims that a deal is almost done. And in that deal, he says that Iran has agreed to suspend its nuclear program indefinitely and that it won't get any frozen funds in exchange. He's presenting this sort of as an almost done deal. He says there will probably be talks this weekend to wrap everything up. And he said to Bloomberg, most of the main points are finalized. He says it'll go pretty quickly from here. But I want to emphasize, we have not heard any confirmation from the Iranian side on this. This would be a major capitulation from Iran to agree to all of this. We don't know what they'd be getting in exchange or why they would agree to it now. So we don't have any confirmation that Iran has agreed to the points that the president is laying out. Now, in the meantime, we're also getting these conflicting headlines over the state of the Strait of Hormuz. The president said on Truth Social earlier this morning that yes, it's reopened, but that the U.S.'s naval blockade remains in place. And the latest we have in response from Iranian state media is that despite what the Iran foreign minister said early this morning about the Strait being reopened, this Iranian state media is now saying that as long as the U.S.'s blockade is remaining in place, then the Strait is not reopened, that it will require coordination with Iran's military, and that if the blockade is in place, they will not be reopening the Strait, Frank. So a lot of pieces there. The president claiming that a deal is almost done. No word yet from the Iranians, so we'll see what happens throughout the day and potentially with talks this weekend.
Well, Megan, we know that you're going to stay on top of it. Our Megan Casella live from our D.C. bureau. A lot to kind of go through right there. Amy, I want to come back over to you. So Megan mentioned some of the conflicting headlines right there. We also have some other headlines about the administration wanting U.S. oil producers to drill more. Right now, I'm looking at oil. It's for WTI. It's trading about $83 a barrel. It's down about 12% today. Does this lower price of oil, does that change your view of the market in a meaningful way? Do you believe it's sustainable?
Well, what's really interesting is if you look at the 5-year strip today, it's virtually flat. So it's the near-term price of oil that went up a lot. The long-term prices basically didn't move that much, and now the near-term's coming down a lot, and the long-term prices again are still stable. We've been bullish on oil. We've been overweight energy. It's been it's helped performance obviously in the short term. We think it has nothing to do with the Iran conflict. It just has to do with the massive fiscal stimulus that you're seeing from almost every place. So we do think the long-term outlook for energy is good. We just added to Schlumberger. We think countries will look to diversify from the Middle East. That requires more exploration. That requires more oil field services. So we do think there are opportunities to make money here. We did trim a little shell that did very well with the conflict.
Yeah, we're going to get to your moves in just a bit, but I want to focus on technology right now, the tech sector. Jenny, I want to come over to you. I'm looking at the XLK on quite the run, pacing for its best month since November of 2002. The SMH also pacing for its best month since November of 2022. What is your view of just the broader tech trade? How are you looking at it?
I think this is dicey too. So one of the things that is important to remember is XLK. Great, it's up 7% year to date, so it's been hot, but it's not as hot as the last few days to make it look. Anyway, one of the things that we've been really looking at for our disciplined growth strategy is with all those software stocks getting thrown out the window, where's their opportunity? And the reality is as you suss through those, it's still dicey. I think in software, I don't think you quite go there broad. I don't think you at all, not quite go there. I don't think you at all go there broadly. There are some compelling names. There are some stocks that I think will survive. But for example, we were looking at Paychex, not a super traditional software stock. We're looking at Paychex and we're like, no, this has real long-term existential threat from what's going on with AI. And as we've gone down the list of our software potentials, even though they look like they still have free cash flow and they look like they have earnings growth, we think that's suspect. Now that's totally different than when we think about semis and when we think about Micron, for example, and what Micron's multiple is right now. I think it's about 10 times, and it has unbelievable 60% earnings growth ahead. And that's totally different than Meta and Google and Amazon. So within tech, this is an area where you go line by line, industry by industry, company by company, but I don't think you should jump in broadly. And the whole move up that we've seen, that's just emotional relief. And we saw the same thing after Liberation Day last year. Trump brings you to the edge. We're all looking over the edge. We're all scary. He pulls you back, and then there's this euphoric moment. The aftermath of that is reasonability comes in and it gets more granular. But we're in this moment where everyone's just breathing a sigh of relief that we didn't jump over the cliff last week or a week and a half ago.
So Jenny, you're kind of the voice of caution here on the desk. Amy, you're taking a very different stance. I mean, you're making some buys. Well, you bought some Broadcom.
She's granular.
I bought some Broadcom.
And some CrowdStrike as well.
Right. But we're just in that context, we're very underweight tech. So tech is about 30% of the benchmark. We're in the low 20s. So we've used some of the recent weakness to reduce our underweight a little bit. We also trimmed some ASML that had worked really well. So I'm happy to take a little profits from ASML. We did that before the quarter. The quarter was largely disappointing. We saw a pretty big sell-off. I wish I trimmed more, actually. Put that into Broadcom. We think Broadcom is really well positioned for the AI trade, although I still have a lot of doubts about the real true return on all this capital. But I don't think we're going to get the answer to that anytime very soon.
And see, we're actually saying exactly the same thing, which is some areas are doing well, take a little off. Some areas have been punished. There's opportunity. Be granular.
You're getting more opportunities in this market.
Oppenheimer out with a very favorable semi-earnings preview. NVIDIA, that's the stock that you own, Jason. What's your view when it comes to chips right now? Again, we just mentioned the SMH having its best month since November 2022. And chips have actually been leading the market during this rally.
They have. I mean, they've been an excellent sector over the last couple of weeks. I think for me, especially as it relates to kind of NVIDIA and the rest of the band there, I mean, I think there's been a little bit of a pay into the more customized chips like the Marvells and obviously, some other stories that are kind of playing out well there. I think NVIDIA, again, the runway, the GPU chip, the GTC conference went well. The Vera Rubin chip, I think, is 30x power and capacity compared to the Hopper chip. I think that has obviously played out well. That they're going to be part of the earnings story. I mean, you're talking about 45% earnings growth for this sector going into this earnings season. So I think that if we're thinking about tech broadly, I think the semi space is almost, in our view, almost like the picks and shovel, like the infrastructure for the trade. So I continue to like semis here.
All right, so you're talking about growth. I'm talking about growth in the chip sector, maybe not always being good enough. Steve White, Shio and Taiwan Semi, they just reported their earnings, 40% revenue growth, and the stock sold off.
I can't figure it out why it did. I mean, what was expectation? The whisper number, 50% revenue growth? I mean, just think at the monster growth they're experiencing. And their growth is, you can't like NVIDIA, you can't like Broadcom, you can't like any of these companies without liking Taiwan Semi, because they make the chips for everybody. What's even more astounding is their margins. Their margins are not what you would see from any type of manufacturing company. They're significantly higher. So that means to me that the stock should be priced higher. So I still think, despite the run, that there's room to grow here because they keep adding capacity. They've got big projects that are happening in the U.S., which will take some years to really be functional. But I continue to think it's the number one play in semis.
By the way, the information out with the report, OpenAI to spend more than $20 billion on Cerebrus chips, also receiving equity stakes. So a lot of people seeing that as a read on demand for AI chips. It's just another read on that. But a lot of people also questioning some of these deals where you get chips and equity and kind of going back and forth. I want to go to broader software. Again, Amy, we hit that you bought CrowdStrike. Jason, this is your moment. Oracle. It's rallying once. I mean, we gave you a hard time when it sold off, but now you can kind of take a bit of a victory lap. I'm just looking at the stats here. It's up 43% over the last 6 months.
Yeah.
Also having its best week. It's partying like it's 1999. Having its best week since 1999.
It's really insane. You know, so it's up 30% obviously this week. It's still down, I think, 7 or 8% year to date. I think that the story for me, you know, is part of the broader software bump so far this week. But you know, what I do like what they did recently is this Bloom Energy deal. That partnership, I mean, that's just expanding their capacity, 2.8 gigawatts for data centers. I think that's going to be accretive for them longer term. And I just think that they also expanded their deal with Amazon. That's also kind of this multi-cloud story where firms don't want to just be with one player there, and I think that's also been an accretive. But listen, it fell a lot. It's still down. So we're still looking for opportunities here, but I like, obviously, the move.
Can I ask you a question? I think it's a question for just about every part of the market that's rallied over these last 13 days, 2 weeks, whatever you want to call it. Is now maybe the time to take some profits on a name like Oracle that's seen a huge run-up just this week?
Definitely depends on where you're in, right? But I would say definitely. I mean, this is time where you have to be prudent, you know, from a kind of a management perspective. When you're seeing runs like this and you've been in the stock for a few years and you're up a lot, you know, and I think Jenny was saying this in terms of kind of forward return after moves like this, you definitely want to take some chips off the table.
People seem to want to get active in this market, Steve. Bank of America's flow show out, $172 billion in outflows of cash. Kind of a bullish sign about people wanting to put some money to work in the market. Where would you look to put some money in tech, whether it's software, cybersecurity? Is there an area, if you actively want to put some money to work, that you would go to?
You know, first of all, I'd love to see the correlation between their flow show numbers and the activity in the market. Because we talk about it all the time, but we never talk about the results. So I'd love to see those numbers, see if there's a lag, what they are, because I don't find those particularly helpful and don't invest alongside them. Just another data point. But look, I like my portfolio, and I look for opportunities where companies get displaced, like Baba. So I bought Baba in the 150s. That turned out being a mistake. So I bought more in the 120s, and here we see it having a move like the rest. Microsoft. So I buy companies that I know well, and that, again, when there's an opportunity, when they go on sale, even if it's only for a brief moment, that's where I buy. So in terms of broad sectors of the market, I'm having trouble finding those that are undervalued. I mean, you take a look, you know, at some. I look at Bloom Energy. I mean, I don't know when they're going to make money. They announce all these deals. Right. You know, the stock, now maybe it's sour grapes, because I sold the stock about 100 points ago, you know, after a nice run. But I just don't see where the valuations in the market are conducive to running out and buying them, and that goes across sectors.
Amy, let me ask you that question about Apple. You bought some more Apple. I'm looking just at the charts here, up about 7% over the last 12 trading sessions through yesterday's close. We're going to show where it's at right now. Are you seeing this, I guess, as an attractive entry point for this name right now? We're still waiting to kind of see their AI plan fully roll out, but their sales in China actually spiking. They seem to be the preferred mobile phone in China right now.
Right. We bought Apple a couple of weeks ago, but Apple was $250 at the end of 2024. Stock hasn't done anything for a really long time. And so I didn't know their China sales were going to be strong, but we view Apple as a consumer products company more than anything else. It's hard to find things that we like in consumer discretionary right now. I think the consumer is sort of stretched. What we think will distinguish Apple, though, from the others is just their discipline with regards to capital. I think they will distinguish themselves when you're seeing all the other hyperscale. Well, Apple's not a hyperscaler, but all the sort of the Mag 7 just spending money hand over fist. Their cash flow estimates are just cratering, and we think Apple will distinguish itself by being prudent guardians of capital.
Right. Jason, you own this name as well. B of A, maintaining it as its price target, at 325. Also has it as a buy. They call it the highest quality name amidst AI volatility. Do you agree? This is a safe harbor as we see volatility, and I'm sure right now we're seeing some euphoria. Let's just be honest. We're seeing a lot of euphoria today, but
100%.
the fears of AI disruption could certainly rear their heads once again.
I think to Amy's point, I mean, the free cash flow story is a very important story for them, and the prudence in terms of how do they manage their dollars, I think, is a big deal. And we've known for years they're definitely not the first of the party. They're obviously watching everyone kind of do what they do. The early part of this year, part of the sell-off in the AI infrastructure names is all the spending, all the CapEx spending, $200 billion from Amazon and others, right? So I think that obviously plays well for them. Also, iPhone 17 numbers were good last quarter. Services numbers they're at an all-time high. So I think they're continuing to hitting singles and doubles. I think you want to invest in stocks like this in this type of market.
So since Scott's not here today, and I wouldn't want to give him the satisfaction of saying anything positive about Apple when he's here, I'll say one positive thing about Apple. As we've really dove in on the software stocks and looked for opportunity there, one of the things that we realized is that they've had enormous revenue growth, but they haven't actually increased their number of customers. And one of the things that I think is going to be a huge headwind and a problem for the software stocks, especially as their competition increases, is that they've gouged clients. They've acted like monopolies and just jacked up costs year after year. When you compare those to Apple, and I know it's not apples to apples, it's software versus a consumer product company. Apple hasn't gouged their customers in the same way. And there's a lot of loyal. I don't think so, Steve. You can still get an iPhone.
How much more gouging do you need than $1,500 for a phone?
But you know what? I just got a new phone and I paid like $150.
I gotta be honest.
That's only if you want the bougie, fancy phone, right? If you're a cheapskate like me,
Let's not go down this rabbit hole too much. In all fairness, people are financing phones.
Do you know why Apple
you don't have to pay $1,500.
Do you know why Apple will never gouge? So I believe they are.
They don't want you to
No,
go to Samsung.
because the phone companies subsidize the purchase.
Right.
So they'd be gouging the phone companies who'd say, forget
when
it.
you look like for like, and you're looking across technology, you don't see that same level of abuse at Apple that you see at the software companies. It's one
Let me
nice
just
thing.
ask you this question.
Listen, let me say one nice thing for once.
Well, I'm trying to help you, but let me ask you this. You just said before, you've got to look at companies across technology separately, like this one, this one, this one.
I didn't say I'm buying it.
Yet you just said, well, software, but Apple. So you
I'm
can't.
just saying one nice thing. Look, I'm not buying Apple because to me, it's still 30 times, and I do count it as a consumer product company.
Right.
And with 10+% or 10-ish% earnings growth, I don't think that multiple works. Right, so I'm not saying buy Apple. I'm just saying one nice thing about the company that we thought of when we were looking at software stocks.
In all fairness, I know that was a bit of a spite rant, but we want to move on to the other side of the coin when it comes to mega cap tech. Meta, you can play the part of Jim Lebenthal, pat yourself on the back for this one.
Lord.
Over the last 12 days,
Nobody's arms are as large as Jim's.
the shares up over 25%. What do you make of the fact that investors seem to have turned to Meta during this rally of hope of the Strait of Hormuz opening back up?
I don't think one links to the other in any way, shape, or form. I think it's just part of that, like, hey, everything's going up all at once. But when you look across the Mag 7, Meta, I think the valuation is still the most compelling. So you've got a 22 times multiple. You've got high teens earnings growth ahead. I know they've had their tobacco moment, and I think that long term that will suppress earnings growth, but it's still enormous, and their free cash flow generation is stupefying. If we also think that maybe the role of the AI spending is slowed because suddenly we're seeing constituent pushback and municipal pushback on AI data center build. So if that slows and they can't spend that CapEx as fast as they want, that's only positive for the share price. It just increases their free cash flow for the near term.
And that's a positive in another way for Meta. So Meta has moved, and keep in mind it was moving before the market really took off. And that's because they're finally getting recognition for their CapEx in AI. So they've already made their bets in AI. They've already secured significant, data center space. So if there's a moratorium driven by municipalities cutting back on data centers, they're already there. So that creates the mode for others that can't get in. Well, they're monetizing it, so they're reportedly going to surpass Google as the #1 seller of ads. So they've shown, Zuckerberg has shown an uncanny ability whether it's buying Instagram that everybody thought he overpaid for with $1 billion to create products. So that's how we're monetizing.
That's a fair point, by the way. Meta shares up just about 1% right now. But out of the mega-cap tech names, as you mentioned, they really depend on ads. They're most sensitive to economic downturns and upturns. So it's kind of interesting that investors, I know you say you don't think it's correlated, but have put their money in Meta during this rally.
But the statistics show that they keep their ad growth, and the ones that lose the ad growth are print, of course, never-ending downward slope, television. So their ad growth, you get more bang for the buck.
Right.
That will continue to grow. So I have no concerns about economic, but the economy slowing down their ad growth.
By the way, Steve Weiss, also a Meta shareholder, as I mentioned, shares up about 1%. Coming up, more committee moves. Amy Raskin is ready with a few more trades. We just got started with Amy's trade. Halftime's back in 2 minutes. Welcome back to Halftime. Let's get some more moves from you, Amy. We talked about a few of them. I want to get to a couple other ones. Illumina, a biotech focused on precision medicine.
Yeah, so this is the company that basically makes all of the genomic sequencers. Steve and I were just talking about this. If you want to use AI in healthcare to discover new drugs and find causations, you need genomic data. This company sequences over 80% of all the genomic data sequenced in this country. It's less than $20 billion market cap company at this point. We think it has a really strong growth in front of them. We like it a lot.
All right. You also made another trim, this time in the financial sector. Goldman Sachs, the company also cut from BofA's US 1 list today, replaced with JP Morgan.
Yeah, so this is our second trim of Goldman. We trimmed it at the end of last year, too. This is Goldman basically went from 300 to 800 in a year and has kind of sort of flatlined-ish since then. We just think there's a lot of good news baked into the financials already. You saw it had a good first quarter and the stock didn't work. It kind of had an okay second, it had a good Q4. The stock didn't work after that and had an okay Q1. The stock also didn't work. We just think that there's a lot of good expectations. I don't expect the company to miss drastically, but just expectations in financials generally are high.
All right, Jason and Weiss, you're both shareholders. Jason, any quick thoughts?
I continue to like Goldman Sachs. I think capital markets revenue was really strong. FIG trading was a little different, but I just continue to like this stock. I think the environment going forward will improve. So I think they're the best of breed, so I'll continue on it.
Want to make sure, we're really quick question. I want to make sure I paint this the right way. It's still buy rated. They're still rating as a buy at B of A, just taking it off the US 1 list.
Yeah, that means a lot to me. Look, I bought some after earnings on the dip, and I can't tell you that the valuation is compelling, but there's new paradigm for valuation, so I try not to get stuck in the way it used to be. And I still think there's plenty of room here, like Jason. I mean, we've barely touched the underwriting cycle. We've barely touched, even though you've seen record M&A volume, it's big company volume. So we've got a lot more under the hood there to go. And again, I think management's excellent. So I'd continue to own it, and I'd take opportunities to buy it.
All right, let's move on. We got to hit one of the big stories of today. Of course, that's Netflix. Shares dropping just about 9% right now after giving some disappointing second quarter guidance. Got a lot of ownership here on the desk. Weiss, you own this one. You and I have talked about Netflix quite a bit. Weaker than expected Q2 guidance. Also, Reed Hastings, co-founder, stepping down as chairman coming up in June. Is that meaningful to you, the fact that he's stepping away from the business?
Look, he was a visionary, but he's long ago ceded responsibilities for the day-to-day to Ted, and he holds the vision. He's been there forever. So I've got no issues with that. Wish him well. He's just a genius. Created a medium that nobody knew existed and transformed that medium from just hard, discs to now online streaming. So no, that doesn't bother me. Look, I said on Wednesday I was on, it's feast or famine each quarter. By that I mean it's either up 5 to 10%, or it's down 5 to 10%. You never know what it's going to be. But if you hold it for the long term, you're going to do quite well. So I haven't bought any more here because I had been buying it when it was in the 80s. And I want to see it settle for a little bit. And it also has taken longer for it to recover, as we've seen with this recent move up to 107. So, and also the analysts did help by basically coming out, raising their price targets, guessing it's going to be a good quarter in front of the quarter. It's never helpful. But I like it. I mean, they still hold the #1 position. Their margins for a company like this, their margins are about 34% operating margins. You just don't see that. So those are software margins. They've got their churn is way down. Their product, their sports product is selective. Like with the World Baseball Classic, they signed up more people in Japan than they've ever signed up, and they're sticky. So I think the fundamentals are very, very strong, remain strong. And if you don't own it, I would take the opportunity right here to buy it.
Yeah, we're just showing the price targets. A lot of pretty bullish price targets. Price targets signaling that a lot of analysts believe there's a double-digit gain from where the stock's trading at right now. Jason, you own this one. I don't know if you got a chance to listen to some of Julia Borson's great reporting on this. You talked to some other people. They make a point that I think is interesting. It's not just the same old Netflix. They do live events now. They do more expensive productions. So it's not quite the same business. Has your thought about Netflix changed?
It hasn't. I think their foray into live sports is going to be a big deal for them, and obviously they're focusing more deeply on advertising.
Expensive.
It is expensive. It's an expensive asset, but I think it's worth the price of admission on that front. I think the revenue was definitely a beat there. Clearly, the $2 billion to $3 billion termination fee that they received, X that was a miss on EPS. But for me, I think the original content spend, they're planning on spending $20 billion. That's going to be an important part of the focus for me going forward. But I think, again, with sports, advertising, we're expecting a double that this year on FY26. I think there's smooth sailing going forward. I mean, this is a little bit of a tough price action response, but I think going forward, this is an opportunity.
All right, we got to go, but really quick. Weiss said he's staying pat. He didn't nibble on any more. Would you buy right here? Or is this a good place for you?
I've got a large position in it, too. So.
Understood. I'm saying you just didn't buy any more.
Yeah.
I think so. I think, to Weiss's point, I mean, there's a lot of disruption on the earnings day for them. It is feast or famine. It's like up a lot or down a lot. I think that's totally true. I think this is an opportunity.
I didn't hear a lot of conviction, though, Jason. All right, we're going to move on. Netflix shares down to 9%. Straight ahead, shopping for opportunity. A few bullish calls out there on the consumer. We're going to see where the committee stands next. Stay with us.
Contessa Brewer with your CNBC News update. The man accused of killing conservative activist Charlie Kirk is due in court today in Utah. Tyler Robinson and his lawyers want the judge to ban cameras from the courtroom. They say live broadcasts would violate his right to a fair trial. Prosecutors say they intend to seek the death penalty if Robinson is convicted. He hasn't yet entered a plea. Transportation Secretary Sean Duffy says the FAA opened applications overnight for new air traffic controllers. Already, it received 6,000 applications in just the first 12 hours. The FAA is facing persistent shortages of air traffic controllers. Many are forced to work mandatory overtime and 6-day work weeks, and certainly the traveling public would like to see some relief on that front, too. The San Diego Padres ownership reportedly close to a deal to sell the team to private equity billionaire Jose Feliciano and his wife Kwanza Jones in a deal reportedly valued at about $3.9 billion, according to the Wall Street Journal. That would be by far the highest price ever paid for a Major League Baseball team. But Frank, you know, what you get for that is an extremely loyal, some might even say rabid baseball crowd they have like the vast majority of their games are sold out. So you can see how someone who wants to be invested in sports might want that team.
Number one, great weather for baseball. Also, a historic acquisition if it all goes through. Jose Feliciano and Kwanza Jones will be the first Latino and African-American owners in Major League Baseball, and that would be amazing. Our Contessa Brewer, thank you very much.
Sure.
All right, we're going to move on to the consumer discretionary sector. It's the second best sector this week behind tech, and Bank of America's Michael Hartnett's out with a note saying to buy consumer-related stocks. Take a look at that chart right there. Jenny, I'm going to come over to you. You and I were just talking. You own a whole lot. You got Best Buy, you got Kimberly-Clark, you got Clorox, which did get a downgrade today. I want to point that out. Also, Conagra. What's your view of consumer-related stocks? We were talking just a bit about the consumer maybe being pressured.
I think the consumer will be under pressure, but if you look at these stocks, and by the way, we added Best Buy and Clorox fairly recently. I'll get to that downgrade. I think it's late, but the thesis of the downgrade is the reason the shares were cheap enough to buy. But if you think about these stocks, a lot of them really took it on the chin over the last month and a half. And the worry was not just the consumer being under pressure, but it was also that fossil fuels and petrochemicals are huge input costs, and transportation and using oil and gas, you know, to transport goods to grocery stores. That's a huge input cost. So they all took it on the chin, and I think they now have a huge opportunity. Most of these are trading at under 10 times earnings. Most of them have mid to high single-digit earnings growth ahead of Best Buy, Conagra, Clorox, Kimberly, not Marriott, but those first four, they all have huge dividend yields and they're well covered. So I think there is an opportunity here. And you know what? The consumer's not falling off a cliff yet. And you all know I'm usually, you know, the most negative on this desk. And even with my negativity, I see employment holding up. I see wage growth still increasing. I see net worth holding up. And so the consumer still, in aggregate, is okay. So I think you have a mismatch of concern over the future of these companies that's made really compelling entry points and great margins of safety.
Okay.
Do you want me to touch on that downgrade, or you want to move on?
Well, let's just move on just for a second. But it's interesting. A lot of the companies we talked about are really focused on the household. Weiss, I want to come over to you. You own Dick's, a lot of exposure to Nike. I mean, that's very discretionary. I mean, bleach, soap for your house, while it is, you know, technically some of that stuff staples, you need that stuff. Sneakers and things like that, you don't necessarily need. What's your view on a company like Dick's?
Yeah, so look, Dick's is not a place you go to because you need things. It's a place you go to because you want things.
But doesn't that make you worry that higher gas prices?
Here's why
Give me
it
the
doesn't.
thesis.
They are the number one player and often the only player in terms of their offering, the size of their stores, et cetera, in the market, in the sports, athletic market, sneaker market. While they do have a good relationship with Nike, they're basically brand agnostic. You can walk in their store and see On, you can see Hoka, even though you get, you know, sort of ugly, you got to shield your eyes, but away from that, they carry all brands.
Don't you pick on my Hokas.
Yeah, but what I'd say is that, you know, you spend anything that you can on your kids and your pets. And this is largely for the youth of America. So you go in there, you're not going to deny your kid a new baseball club, new cleats. So plus you keep seeing more and more kids coming up, more and more kids staying with sports longer. So that's why I'm not concerned. On the margin, could there be some impact in a really down economy? Of course there can. And families are making choices right now. I just think Dick's is going to do fine.
All right, Amy, I want to come over to you. You own Costco. Jason, you do as well. Is Costco maybe a safe place to hide? As I mentioned, there's certain things you just got to buy, no matter what happens.
I mean, Costco's growth is now all coming from outside the U.S. I mean, their retention within the U.S. is still very strong. It's very expensive. It didn't work for a long time. It's been working more recently. It is sort of, we're generally underweight the consumer. I do think there's still a lot of headwinds. As Jenny said, income growth is okay, but real income growth is pretty punk right now. You just did get these bigger refunds, but that's going to be largely behind us. So I do think the consumer is going to sort of be touch and go from here.
Costco shares up about a third of 1% right now. Coming up next, Mike Santoli joining us with his midday word. More halftime coming up right after this. And we are back on halftime. Senior markets commentator and overtime co-anchor Mike Santoli joining us with his midday word. Mike, I know you want to talk about that Padres sale and it being about $1.5 billion more than the Mets sold for, but we got to talk about the markets, if you don't mind. we got to chat about it a little bit. I want to ask you, this rally, we're seeing some notes that say don't chase it. There's a pullback that could be coming up potentially. Other people seem to have a lot of confidence in it. We're seeing the markets move higher, on pace at least, to hit new record highs. NASDAQ on a 13-day win streak. How are you viewing?
Well, I mean, you'd have to, first of all, decide whether you are involved at all. When you say don't chase it, I would say that means set your expectations in such a way that gives account for the fact that we're on this mad sprint higher. We have been for 13 trading days. I was saying for the past 2 days, when you get these streaks or these really rapid comebacks, when they kind of go in the history books as the fastest return to an all-time high in history, it's almost never a fluke or a head fake. Now, it doesn't mean it continues at that angle. I do think we're going to be running a little bit hot. I think everybody today who was waiting for some kind of clarity or certainty of de-escalation is happy and forced to buy it, or maybe just forced to buy it 13% higher than you could have 2.5 weeks ago. That's just the way the market works. So I do think there's still room for people to rebuild their exposures to the market. Valuations had a good reset. Now we're almost back after today. We're not going to be that much cheaper than we were, let's say, going back to late January. But I think valuation has come off the boil. And, obviously have a lot other things that have fallen into place. The inflation picture, Treasury yields, the Fed may be able to get back in the game. Now, this is all contingent on things going the way we now think the headlines are pointing. So at some point, we get up at these levels, and we're going to be vulnerable to downside surprise because, we've already just convinced ourselves that this thing is over. So that's the way the game always works. But I think you're more encouraged than worried by the fact that the market has come back this quickly.
All right, some encouraging words from our Mike Santoli. Mike Santoli with his midday word. We'll see it coming up on Overtime later today. Mike, thank you very much. All right, coming up, the earnings setup on some key committee names that are reporting in the week ahead. Stay with us. Much more halftime. welcome back to Halftime. Let's get the setup on some key names reporting next week. First up, D.R. Horton reporting on Tuesday. Jason, you own this one.
Yeah, it's up a lot today. It's up 6%. I think that's obviously the news with the straight. But I think for me, I'm not expecting a lot of affordability is a major deal for them. You know, with 30-year mortgage rates above 6, you know, this is going to be a tough story. But I think going forward, this is a nice top tone.
All right, as you mentioned, shares up 6%. Want to go to UNH. Also coming up on Tuesday, Weiss, you're in this name.
I am, and this company has had just a major run. It's gone from about $250 a share to see where it is right now. So that's huge. I mean, that's like a 30% run. I don't like seeing that in front of the quarter because that creates what we saw with Netflix even more so. And I think the future of healthcare, particular payers, is still, you still have to be cautious there. Nonetheless, I have confidence in Steve Hemsley and the rest of the management team, the new CFO, others to really drive results here. But you're still in early innings of a turnaround.
All right, moving on. American Express reporting on Thursday. Jenny, you're in this one.
Yep. So positioning-wise, this is the opposite of Steve's UNH, where it's down 9% on the year. So the reason I'm excited about American Express is I think it'll offer really, really genuine, authentic insight on the state of the U.S. consumer and on the state of the U.S. economy. Also, I'm curious to see if they push back on AI disrupting their payment network, which is what caused the stock to tank in February.
All right, looking at American Express shares, they're up almost 4% as well right now. All right, final trades are coming up right after this break. Stay with us. And we are back on halftime with final trade. Steve Weiss, you're up first.
I'm going with Netflix, and I'm doing it on behalf of my friend Jason here because you doubted his conviction. My conviction is very strong.
What a match.
Jason, we need some more conviction. Final trades.
BlackRock, strong beat on the top of top and bottom, and they had 10% organic fee growth. I like this one.
I believe you this time with the shares up 4%. Amy.
Illumina, I spoke about it earlier. I like this a lot for long term.
All right, those shares up 1%. Jenny, you got the last word here.
Great. UPS, it's got a 6.1% dividend yield, and they just announced that they're going to automate 20 million manual scans a day. AI and robotics is going to be a huge beneficiary, and the stock's at 15 times earnings.
All right, we're going to leave it there. Those are your final trades. One quick look at the markets right now. You can see green all across the board. The Dow is up over 2%. The S&P up about 1.5%. The Nasdaq up over 1.5%. The Russell up about 2.5%. And that's going to do it for halftime. The Exchange with Dr. John Ford starts right now.
Frank Holland, thank you. Welcome to The Exchange. I'm John Ford in for Kelly Evans, and we got fresh records on Wall Street. The S&P and Nasdaq hitting new all-time highs. Look at that. I mean, the Dow is up 1,120 points. Wow, and that's off of the latest oil price drop on the latest Iran headlines. The Nasdaq is on pace for a 13-day win streak. All three indices on track for the third straight week of more than 3% gains. Well, big tech higher with Apple and Tesla. Your Mag 7 leaders, semiconductors, software, memory, all higher as well. The IGV software ETF, which had been struggling, up nearly 15% this week. That makes it the best weekly gain in a quarter century, 25 years. And the momentum trade going strong with the MTUM Momentum ETF higher for a 12th straight session. Top holdings include AMD, which reports earnings soon, Broadcom, and NVIDIA. But we begin with the latest headlines on Iran that are sending oil prices down 12%. You see crude there close to 83. Megan Casella is live in Washington. Megan.
John, there has been a lot of conflicting reporting today about where exactly things stand between the U.S. and Iran right now and what the current status is at the Strait of Hormuz. So bear with me here as we run through it. The most recent information we have is that President Trump has been making a number of calls to reporters over the last hour or so, where he's claiming that Iran has agreed to essentially all of the U.S.'s demands. According to reports, the president says that Iran has agreed to suspend its nuclear program indefinitely and that they won't get any frozen funds in exchange for concessions. He also says that they want to meet and make a deal. And Trump continues to say, as he said yesterday as well, that U.S. officials will probably sit down with Iranian negotiators this weekend, and he says he believes there will be a final deal in the next day or two. Now, all of that would mark a major victory for the Trump administration in this war against Iran, and of course, it suggests that a broader and more permanent peace deal is very close. But that said, it would also be a significant capitulation for the Iranians, and we have no confirmation or comment from the Iranian side as to whether they have actually formally agreed to everything that President Trump says they've agreed to. So there is much more to come on the details there, with the first step to watch for being whether the two sides will actually hold formal talks this weekend. And then on the Strait of Hormuz, Iran's foreign minister kicked off today's market rally when he posted on X this morning that the strait was completely open for the remainder of the ceasefire. President Trump then posted that the strait is open, but also that the U.S.'s military blockade will remain in effect until what he called the transaction with Iran is 100% complete. And John, the latest reporting out of Iranian state media is that if the U.S.'s blockade is in effect, then the Strait of Hormuz will not, in fact, be reopening. And that even after that, passage will require coordination with the Iranian military. So for now, definite movement towards an optimism about a peace agreement and an end to the war. But I would say it's far from complete, and the devil here will be in the details.
Lots of details. So lots of room for the devil, apparently. Megan, thank you. Stock staging a stunning turnaround, though, with the S&P going from near correction territory to an all-time high in just 11 trading days. That is the fastest move from a bottom of at least 9% to record levels in 36 years. But can that momentum continue? Well, let's ask Phil Camporelli, multi-asset portfolio manager at JP Morgan Asset Management. A lot has changed since 1990. 36 years ago, the last time we saw this
changed in the past 3 weeks, John.
Yes, indeed. So is this reaction just bottled up, warranted optimism, or is it perhaps overdone?
Yeah, I think that this reaction is completely warranted because of the oil price sentiment, right? So what did oil prices do? It made a lot of people anxious about things like inflation. Obviously, PEs on the stock market when, as you said, the S&P had a near correction territory. And for asset allocators like us, we philosophically believe that if stocks go down, you should be protected with bonds, and that broke down in March. So if you add all three of those things up, lo and behold, the volatility market's really important. Interest rate volatility as measured by the MOVE index, and the VIX, which everybody knows, which is equity market volatility. Those two things are right back to where we were in late February, which I think is a really good sign taking risk going forward, because fundamentals really strong. We still have above trend GDP forecast for the U.S. this year, right? Interest rate volatility, I think, promotes taking risk as long as it stays contained. And at the end of the day, we're positioned to overweight equities. We never touched the U.S. equity overweight because we thought the U.S. was insulated.
But if we're back to those February levels, does that mean that this level of adjustment is only warranted if you think that the Iranian regime is totally capitulating here?
Yeah, I think it does, John. So when you say totally capitulating, there is room for negotiation there. We don't really know what that means. Well, why we're positioned overweight stocks here, though, has to, again, go back to our double-digit earnings forecast that we have in the S&P 500, combined with the fact that we have about a 2.1 or 2.2% real GDP forecast. And if you add that up, right, you have maybe a 3% inflation rate and a 2% GDP forecast. 2 plus 3 is 5% nominal growth, which I think really supports taking risk here.
I think we're just looking at WTI crude around 83, right? And we have been talking about with a number of people over the last few weeks, hey, if it stays above, well above 80 for a while, then there's the risk of that leaking through price-wise into other segments of the global economy. So now, we're down to 83, which is exciting. But if we end up, once we hear from the Iranian regime, where they're really pointing with this, back in the 90 territory, does that curb your enthusiasm?
Yeah, so a couple of things here. First, on oil prices, we've calculated that if oil prices average about $88 for the entire year, we're still going to have U.S. GDP at about 2.1%. Now, there are winners and losers. Like, we like the U.S. the best, EM second, and then Europe. I think Europe is much more energy dependent on gas prices. Because of the One Big Beautiful Bill Act, if we average $4.50 on gas for the entire year, our investment bank at JP Morgan predicts that that will only offset the One Big Beautiful Bill Act. So I think
but that's going to hurt a lot of people if we're
it's going to hurt a lot of people. But again, we have this plus of fiscal policy this year that is happening at a really good time. I don't want to be Pollyannish about this. I don't want to be Pollyannish about this, right? But at the same time, you have to say, okay, if there's fiscal policy coming in, that could serve to offset. But then, right, you can't say that the fiscal story is going to be positive because it would be completely offset. So I'm just giving you an extreme example here. We don't expect that to happen, but we do have a cushion based on fiscal policy.
Two things I definitely want you to hit before we go. One is the Fed. How much does Warsh actually getting through matter, given that the president doesn't seem to be backing off, and Tillis hasn't backed off yet either on that threat that, hey, until you get this Powell thing behind us, we're not going to get Warsh through. And then we got midterms coming up toward the end. At what point does that start to influence the market as the polling comes in if it seems like something's happening politically that's less market friendly?
Yeah, so the uncertainty thing, right? Last year, it wasn't really the tariff story that hurt, it was the uncertainty of tariffs. So we'll start with Warsh. That is a really big piece of uncertainty that we think could be lifted. And we're not of the belief that over this next 6 months, the Federal Reserve should be doing anything. There's a cost-benefit analysis. Does the benefit of a cut in rates outweigh the cost of a potential policy error? And right now you can't make that case because inflation's closer to 3, the unemployment rate is very low, and we have above trend GDP forecast. And as of today, the S&P is at an all-time high, right? So we don't think it's the Fed should be cutting rates. And then midterms. The president likely and the administration would want this economy to look as shiny as possible heading into midterms. So I think there's always a calculus as you get close to that the economy, as well as the Federal Reserve, those things are going to be taken care of, which then sets up the midterm elections, hopefully, from the administration's perspective, going in their way.
You tell me I got time for another quick one. What's the most important earnings report on the horizon now, whether it's because of guidance and how much confidence gets expressed or something else like the resilience of the consumer?
Yeah, so I'm looking at retail sales next week. I'm looking at consumer discretionary. I'm looking, as you said, does that spike in oil, gas, and electric eat into the consumer discretionary story? So I think those are actually more important than tech. Even though tech is so widely held, it's the consumer still, because they determine success or failure on the U.S. economy.
All right, Phil Camporelli, thank you.
Good to see you.
All right, let's get back to the big moves in oil. WTI, as I was saying, sitting at around 83 bucks a barrel, its lowest level since March 23rd. Our Pippa Stevens has more on that. Pippa.
Hey, John, so conflicting reports about the status in the Strait, but the oil market clearly viewing this as a positive development. WTI getting down to a low of 80.56 today. Now, if we go back a little bit further, the day before the Iran war broke out, we were trading at 67. We then climbed all the way to just shy of 120, and now we're down about 11.5% here at 83.89. But Baker Bott's partner Jerry Morton telling me that fully open is different from fully functional when it comes to the Strait. Until vessels can move without extraordinary risk mitigation, the Strait is not truly normalized. Or as Kepler put it, quote, Hormuz is open in name only. The firm adding vessels must still transit the IRGC-controlled corridor, which remains slow, constrained, and carries significant compliance and reputational risk for commercial operators. Now, in the coming days, we will see if ship owners are willing to send their crews through the waterway. And once traffic does resume, many are saying it will take weeks, if not months, for flows to become fully functional. Now, we are also seeing a big move in products today. Gasoline futures down 5.5%. Heating oil, which is a proxy for diesel, down 11.5%, with European diesel hitting its lowest level in more than a month, down 12%. John?
All right, Pippa Stevens, thank you. Well, despite the geopolitical volatility, my next guest has identified a group of energy stocks where he sees above average upside from here. Joining me now is Neil Mehta. He's the head of the America's Natural Resources Equity Research at Goldman Sachs. Neil, first of all, good to see you.
Great to see you, John.
Second of all, premature celebration here related to energy in the markets, or do you think it's all warranted?
Look, there's tremendous amount of volatility on the front of the oil curve, and I think predicting the path here is going to really be a call on how Hormuz evolves, as Pippa said. We are in a period of very tight physical shortages. We're seeing fuel shortages for jet and distillate in large parts of the world, and we're drawing around 10 million barrels a day. So the closer we get to opening up Hormuz, the better we are in terms of what it means for both the economic picture and medium-term oil price. What we really care about from an equity perspective is what the world looks like in 27 and 28. And I think the normalized world that we are moving towards is about a $75 Brent, $70 WTI environment. And the back end of the oil curve, which is in the low 70s Brent, does still look undervalued to us.
What does normalized mean?
Yeah. Normalized is an environment where U.S. shale is getting to a point of maturity. I mean, in my career, I've seen shale go and U.S. oil go from 5 million barrels a day to 14 million barrels a day. It's been a tremendous growth story, but we are getting to a point of maturity in regions, including in the Permian. When we look at our top projects, it's a suite of 450 oil and gas fields. There are very few big projects that come in post-2026. And demand growth is going to slow because of efficiency, but we're still going to grow 1 million barrels a day. And in that context, the marginal barrel will require probably $75 Brent, $70 WTI.
Does muscular U.S. foreign policy, some might say imperial, say take Venezuela, does that benefit the oil supply and therefore the market toward normalization as you talk about, or does it add a different kind of risk of moments like the one that we've had over the past couple months?
I think volatility equates to ultimately a higher cost of capital, right? And so when we think about the break-evens, they have moved up as a result of this conflict. We've talked about normalized Brent prices in the $70 to $75 Brent range for a while. We've moved that up towards $75 in that environment to reflect the change in the cost of capital. I think the physical manifestation is going to be whether countries build redundancy as a result of wanting to have some of their molecules closer to home. One example of that could be, would India build a strategic petroleum reserve that effectively provides a buyback mechanism to cut off floors the way that China did last year? And in that environment, as shale matures, as demand grows, as there are fewer projects, I do think the higher for longer commodity price on the back end does make sense to us.
What does this do to China and India in particular? Because not just those two countries, but those are two very populous countries with big energy needs that have been pretty dramatically affected by what's gone on in Iran over the past few weeks.
Yeah, I think it makes the case for controlling more of the strategic petroleum and product and energy in-house. China's been working very hard to reduce their consumption, for most of my career, it's been a 400,000 to 500,000 a barrel a day grower. If you look at our long-term modeling for Chinese demand growth, it's pretty flat, and gasoline's actually declining. I would say India is going to have a tough time reducing its oil demand intensity because the country has such rapid growth, and alternatives are less clear, but it makes it more compelling to control more of the reserves in-house.
So with all that context, give me some winners you've picked.
Yeah, so I think there are 4 stocks in energy that we've talked about here as we talk to investors over the last couple of days that look good in a mid-cycle environment. ConocoPhillips is a company that can grow 20 to 25% free cash flow per share growth between now and 2030 as one of the big projects, Willow, comes online in Alaska. That project comes online in 2029. That's on our conviction list. We continue to like power as a theme. John, I've learned a lot about from you over the years, hearing you talk about technology. I would say power demand is going to grow at around 3% as a CAGR between now and 2030. Data centers are a big part of it, but there are other things too. Quanta is a company that's EPS is going to grow 15 to 20%. That's ticker PWR. And we think that stock has a pathway towards $700. We also like Vistra, which is a large power producer that has excess capacity that it could PPA into large hyperscalers. Both Beaver and Comanche Peak is a stock where our analyst, Carly Davenport, has a positive view on the power side. And gas has sold off here. Global gas has done really well, but U.S. gas has been very weak. And we like owning the low-cost gas producer, and that's EQT.
All right. Neil Mehta, you gave investors a lot to work with here, so we appreciate it.
Thank you, John.
From Goldman Sachs. Well, coming up, Oracle slightly lower today, I believe. Yeah, a little bit, fractionally. Up nearly 30% this week, though. Best week since 1999. Does it have room to run from here? That's next. And as we head to break, check out Bitcoin, up more than 3%, trading back above 77,500, up 6% for the week, but still down 11% since the start of the year. Exchange is back after this.
This is The Exchange on CNBC.
Welcome back to the exchange with the Dow still 1,000 points higher. That's about 2%. Oracle shares, meanwhile, down slightly today, but they've had a monster run this week, up nearly 29%, best week since October 1999. Let's put that move in perspective, though. The stock's still down 48% from the 52-week high it hit on September 10th when it rallied 35% after earnings, and some promises there about what was going to happen with AI and the cloud. So can it get that momentum back? For more, let's bring in Gil Luria, head of technology research at D.A. Davidson. Gil, good to see you. So my question about Oracle is, I think sometimes about data center in terms of real estate, like almost like office real estate. You got your Class A and you got WeWork, and we saw what happened to that over the last couple years ago. To what extent is Oracle closer to the Class A of your AWS, Google, Microsoft Azure, or is it maybe in a different category that's more exposed to shifts in the market?
I love that categorization. I'd put them as Class B in that sense, right? Amazon, Microsoft, and Google have all the customers, and to a certain extent, Oracle and the neo clouds are a little bit of there for overflow, not to mention that they all have to build data centers by borrowing at decently high interest rates in order to do that. So it's a higher level of risk for sure, but Oracle is a lot closer to those hyperscalers than it is to the neo clouds because it does have this very highly cash generative core business of selling software that is funding the ability to borrow a lot and build out this data center. And it's important to note that from a backlog perspective, Oracle has the second largest backlog only after Azure. So if Azure has slightly more than 600 billion, Oracle has 550, Amazon only has 350. So Amazon Web Services, that's almost 10 times bigger than Oracle Cloud, has a much smaller backlog. So Oracle is in very good shape, but there's a lot of execution ahead to keep the story going, both in terms of deploying the data centers and getting the capital in order to do that.
Do you consider there to be an asterisk over part of that backlog, though? I mean, there's questions about the projections of some of these companies, particularly OpenAI, how fast they'll be able to grow. We tend to talk on CNBC about comparisons to the dot-com bust in terms of what the markets did, but I think about internet equipment and fiber in the ground and what it did and the overbuild there that took a while to digest. How much of a possibility is there for that, particularly within that sort of overflow category that isn't the hyperscalers themselves?
So that concern is justified. And to your point earlier, the reason we went down from $350 on September 11 to $140 a few weeks ago is precisely because of that asterisk. Having said that, a lot has changed since then for the better, in the sense that OpenAI, we didn't get enough news cycles around this. OpenAI raised $122 billion. That's the largest fundraise in history by a factor of 3 or 4. And that is enough to pay for all the compute they need for at least the next 2 or 3 years, which includes their commitments primarily to Oracle, but also to Microsoft and Amazon. So that's a huge change. The other big change is that the revenue run rate for OpenAI and Anthropic is now so high and growing so fast before they even optimize their monetization that we can really see a path for them needing all this compute. And the fact that people are now throttled on Claude, which most of us are, tells you we need so much more compute, and these companies have the capital now to deploy that compute, especially OpenAI. And so that puts Oracle in a very different situation. That asterisk is much less of an issue than it was even a month or 2 ago. OpenAI can pay its bills. Oracle has raised the capital. Now it's just a matter of executing on building out those data centers.
We need more compute, but we also need better prompts and more efficient operations so we don't burn so many tokens, I think. Gil Luria of D.A. Davidson, thank you.
Thank you.
Coming up, Royal Caribbean, Carnival, and Norwegian Cruise Lines among the top performing names in the S&P as the Strait of Hormuz reopens, it seems, temporarily. We're going to bring you more moves across the travel sector ahead. And before we head to break, check out shares of Affirm, up just about 7% at the moment with this broader rally. Morgan Stanley naming it a top pick this morning on upward estimate revision potential, overdone private credit fears, and a strong catalyst path. Shares on track for their best day since January. The exchange is back after this. Welcome back to the exchange. Stocks still in rally mode as oil prices sink. Right now, the Dow not quite up 1,000 points anymore, but still better than 900 points. Leading is a lot of things that consume oil. Sherwin-Williams, Home Depot, 3M, Boeing. The only Dow component in the red from what I see is Chevron, which makes a lot of sense. The S&P up 1%, NASDAQ up a little better than that. Let's head to Dom Chu for a closer look at today's biggest movers. Dom.
All right, so the big rally today has put new, fresh intraday record levels for the S&P 500 and the NASDAQ. So we'll put the stars up here right now, but it just exacerbates a trend that we've already seen play out so far this week here. Big rally mode, but the technology or growth-oriented parts of the market are really the ones leading the way higher. So the S&P is up 4.5%. The NASDAQ Composite Tech Heavier is up 6.5% versus a 3.5% gain for the Dow. But again, record levels here for the S&P and the NASDAQ. Now, that growth versus value trade, just to kind of put things in perspective, the Russell 1000 Growth ETF, the overall growth ETF, is about 4.5% higher. Now, if you take a look at this is just the regular again, large cap index. The growth index is up 6.5%, and the value one's up 2.5%. So it gives you an idea of just the gap that's developing as some traders and investors view this as possibly a clear signal to get back in the market, and the muscle memory is kicking in. So growth is where they're going to, at least over the short to medium term. We'll see if that trend plays out. With regard to those sector moves that we are seeing, it is technology, consumer discretionary, the two biggest gaining sectors so far on a week basis with this rally as it unfolds on this Friday. And then energy is the big week decliner, down about 3.5%. Oh, so again, that growth versus value trade. And then one other place to watch, you guys were looking at that software trade earlier. One of the big consensus trades over the course of the last year has been, again, software versus semis. Over this last week, the software ETF's about 14% higher, and the SMH VanEck Vector Semiconductor ETF's up a very respectable 5.5%. So software closing that gap up very markedly this week. Go over the last year, though. Check this out. Remember, a big consensus trade was this short software buy semiconductors. Well, that gap over there over the last year still favors very much the semiconductor trade, but we'll see whether or not this movement here closes at all over the course of the next few months. That might show a sign here that there are some people willing to buy software stocks on this deep value type trade, John. I'll send things back over to you.
Yeah, I was talking about that last week. Software could use a break. Dom, thanks.
You got it.
Now to Brandon Gomez for a CNBC News update.
Hey, John. A federal judge this morning rejected a Department of Justice attempt to force Rhode Island to turn over its non-public data on almost 750,000 voters, so the administration could probe election integrity in the Democratic-run state. It is the latest in a series of setbacks for the administration, with similar requests shot down in California, Massachusetts, Michigan, and Oregon. In a unanimous decision, the Supreme Court today sided with energy companies, saying those that face lawsuits over environmental damage to Louisiana's coast can move the cases from state court to federal court. Louisiana state officials have said the oil companies, led by ExxonMobil and Chevron, should pay the cost for coastal erosion. And Air Canada said today it will temporarily suspend daily flights to JFK Airport in New York because of soaring jet fuel costs. That's according to Bloomberg. Canada's largest airline says its 4 daily flights to JFK from Toronto and Montreal will be suspended starting June 1st, with a plan to resume flights on October 25th. So hopefully no flights north planned for you, John.
Well, not at the moment, Brandon. Thank you. Well, coming up, Anthropic CEO Dario Amodei heading to the White House today, aiming to perhaps ease tensions over the company's new cybersecurity model, Mythos. Those details and what comes next when the exchange returns. Welcome back to the exchange. Anthropic CEO Dario Amodei heading to the White House as the company remains locked in battle with the Pentagon. Meanwhile, a new competitor is reportedly making inroads with the administration. Mackenzie Sigalos has more in today's Tech Check.
Hey, John. So I'm here at the Southwest Gate at the White House. This is where all visitors come and go. We've confirmed that CEO Dario Amodei will be meeting with White House Chief of Staff Susan Wiles specifically to talk about Mythos, that is their powerful new cyber-focused AI model. I want to point out this is less than 2 months after the Pentagon and the wider Department of Defense slapped a supply chain risk designation on Anthropic. You saw very public sparring between Pete Hegseth, the Secretary of Defense, President Trump, and members of Anthropic's team, yet they are coming together today. We've got reports that different government agencies, specifically within intelligence, are already testing out Mythos, but Treasury and other agencies want to get their hands on it. That's what these deal talks are about today. But the backdrop here is that supply chain risk designation still stands. Anthropic has not dropped its 2 court cases against the government. They're suing them over that supply chain risk designation. Yet there is a thawing from both sides. You have Anthropic now apparently sharing their models with the government agencies, talking about expanding that partnership. But John, you started this conversation talking about how some of Anthropic's rivals have been jumping in as this fight has been going on the last 2 months. One of the biggest names there, Alphabet, just yesterday, reportedly in deal talks with the Pentagon to deploy its Gemini models across classified workloads, apparently signing up for some of the contract language that Anthropic refused. John?
All right, Mackenzie Sigalos, thank you. Now for more on the ongoing battle for AI dominance, let's bring in Slow Ventures' Sam Lassen. Sam, happy Friday, good to see you. So how awkward is it to see Anthropic slapped with this supply chain risk designation and then with Mythos see them perhaps exposing actual risks and cluing the government and others into them?
Well, look, it's really hard to tell what's fact and fiction in all of this, I think is the important thing to keep in mind. On one hand, these models are super powerful and they're doing really cool things. They're really, really useful at a lot of places. On the other hand, from the earliest days of, Altman OpenAI marketing, one of the big stories of AI has been this doomerism, extremism, fear. And there's been a lot of kind of going to Washington and talking about, fear-based stories, which is incredible marketing. And so the hard
what
one
are you
to
saying
know
exactly? Is it a question about whether Mythos is really exposing what they claim?
Who knows? I mean, that's the problem with all this stuff is that people have gotten really good at marketing and they realize kind of what sells. We're all talking about it right now, which is great for Anthropic, right?
I did hear from somebody who would know at a large technology player that Mythos really is very good and there's not hype going along with that. And this is one of those major players that's had access to it for quite a while to figure out how to shore up security.
Yeah, look, I mean, there's no question everyone's thinking about shoring up security. The number of emails I've gotten from people in the technology world recently asking if I have any access to get to the Anthropic team about Mythos and other things, it's not zero. Like, there's real stuff here. But when it comes down to, like, how much better is Mythos than what's coming from an API or what Google has, et cetera, this kind of like race of that's going on, it's really, really unclear. I think the bigger question is not about a specific player, but just about structurally where we're going, which is it in some ways doesn't matter which company provides it or where you get to, they're all going to get there. This is the kind of security risk future profile we're going to face, big picture. And then on the margin, it is storytelling and marketing ahead of that.
But there's also a storyline here, is there not, about the amount of government control or influence there is over who gets ahead in this market. There was a time when it looked like this designation from DOD could really put a chill on Anthropic, but there were many in the industry who seemed to help Anthropic contain that damage, at least for now.
Yeah, I mean, look, I think there's two stories going on here about procurement and who controls what in the world broadly. One is, you remember the John Deere situation where John Deere kind of locked down their tractors and said, hey, you farmers, you can't futz with our thing. You don't have control over it because it's centrally controlled now. This is actually the same story, right? Which is that as technology goes from being something you buy and stick on the shelf and can customize any way you want and you truly own it, to services which are housed elsewhere, who controls that and what you can and can't do with what you've quote unquote bought is a big deal. And I think this is like a structural problem we face with a lot of things, not just, locally this one situation.
What do you make of this power shift? I'm going to say going back to the DoD controversy, and it seemed like some folks shifted from using OpenAI's ChatGPT to moving to Anthropic's Claude in the midst of that. And then we saw Claude have some infrastructure issues. Then over the past few days, there were some complaints about performance for Claude, and then we saw Opus 4.7 come out, which seems to be shifting some of the calculus and how these models work. And OpenAI trying to make an argument that they're actually better for some of these things. How are you scoring that?
Here's the reality. I think in the fullness of time, it's all commodity, right? That's the interesting story. It's obviously not branded and priced like commodity. I use Anthropic for everything right now. It's awesome. The second there's something better from OpenAI, it takes me 1 second to switch over. You know, I just in web services, I use SendGrid for a lot of things. Literally yesterday, Cloudflare announced a better email service, and I, in one line, switched it. And so the basic point is that unless someone has the dominant narrative, which for some reason they're able to do a breakthrough, which no one else can do, and you have to use them, in which case they have all the power, the reality is you're going to see a lot of this jockeying back and forth with storytelling. Anthropic's been on a tear, you know, absolute tear, right? They're now, I would argue, the dominant story position. But you better believe people are going to fight back on that. There's going to be a lot of dynamics around, you know, how do you distinguish yourself from this is breakthrough big deal technology to you can build a big company on it that has any defensibility.
Given the valuations involved, commodity has got to be a scary word and its implications for profitability down the line. Sam Lessman, got to leave it there from Slow Ventures. Thank you.
Thanks so much.
Speaking of tech, don't miss my exclusive interview with Adobe's chair and CEO, Shantanu Narayan, from Adobe's annual summit in Las Vegas. We're going to talk latest moves in software, new products, and his career at Adobe after announcing he'll step down as CEO but stay on as chair. Coming up, airlines surging with oil's plunge. The NYSE Airlines Index on pace for its best day since August, ahead of the busiest earnings week for the industry. We're going to preview those results and discuss the impact of today's big drop in energy prices next. Welcome back to the exchange. Airlines soaring as oil prices plunge, but that's not the only big headline for the industry this week. United reportedly considering a merger with American. American shares were up 8% for the week before today's big moves, now higher by about 13%. But it's JetBlue seeing the biggest jump, up 23%. JP Morgan analyst Jamie Baker telling us here on the exchange there's speculation United's bid for American could be, quote, a precursor to a United JetBlue partnership. Meanwhile, the IEA reporting Europe only has 6 weeks of jet fuel left. All this coming ahead of next week's results from United, American, Southwest, and Alaska Air. Joining me now to weigh in on all of that is Oscar Munoz, former chair and CEO of United and a CNBC contributor. Oscar, happy Friday. Good to see you. So I got to say, I mean, United's already been tightening up on frequent flyer miles for non-card holders lately. I don't imagine that's going to help the case that an American Airlines buy would be consumer friendly, no?
Yeah, probably not. You know, the argument is it better off, acquiring American because of its competitive position, its highly leveraged situation. So you ask yourself the question, is it too big to fail? And of course, theoretically, no one's too big to fail, as we've learned, but it is too big to disappear. So interesting news. Is it a ploy for the JetBlue aspect? Well, that's a wonderful Jamie story.
I got to ask you, what scenario is there where we could afford to lose a major airline in the U.S. right now? I mean, we've seen what just the hints of chaos in air traffic control can do to the consumer and economic psyche. I don't even know what that would look like. What does failure mean for a major airline?
Yeah, well, we've seen it, right? TWA, Trans Am way in the background. If you think of the hubs that these big airlines operate, there's such crucial linkage in the world of business for sure, and as well as leisure. And so anything that happens would have to be managed slowly. But again, all of this is hypothetical.
So they are too big to fail at this stage, aren't they? I mean, the age when TWA went out was very different. We don't have as many major airlines with these hubs, right?
Yeah, no, you're absolutely correct. Too big to disappear would be the I say. I think there'd be a transition of some sort that would bring a little bit of order. But nevertheless, fuel prices dropped. Of course, it's a reset. It's not, we're not out of the woods yet. It's still pretty high versus what it was before. And it certainly helped the stock market. But we're going to hear a lot these coming week about what airlines are thinking.
So then what are the implications of letting the ones that are already so big and essential get bigger? Versus right now what's been happening? Look at Spirit, look at some of these others. The smaller ones have been struggling. Who knows what's happening with Southwest, whether, I don't know if you can say righted the ship when you're talking about airplanes, but isn't it more of a risk if we don't end up with some second and third tier players that are healthy?
Again, purely my opinion, the regulatory aspects are very difficult to manage. There is no question that the smaller players are going to have a really difficult time. JetBlue being one. We've seen Spirit. I don't know how they survived yet another round. A little bit of a, this fuel price will help them a little bit, but I think the consolidation will continue at the lower levels. The higher ones are just going to be much more difficult from a perspective of the government allowing it. We saw it in railroads where I used to work. There was something moving with Union Pacific and Norfolk Southern that was looking really well, and all of a sudden it began to hit some roadblocks. It is a big impact to customers. I don't have enough knowledge to opine on what the impact would be to customers or anyone else in the ecosystem.
You might be the only one with enough knowledge to opine on that from where I sit, but I appreciate the humility. Finally, I want to get in an energy question when it comes to jet fuel. We're just talking about the shortages that it sounds like are coming for the European players. But as we head toward the back half of the year, particularly things like holiday travel, is this a scenario where we're just going to see sky-high prices for flights because of what's already happened with energy earlier in the year?
I don't know what the term sky high is. I think they'll moderate. I think the customer won't see relief in the near term because there's a lag when jet fuel price drops. So you're not going to see that immediate aspect. It is a competitive business, so this concept of skyrocketing or sky high prices will be modulated and moderated by just the competitive aspect. We do have a very strong, and we'll hear again a lot about it this week, Demand on the high end seems to be continuing. Tourists, all the vacations, summer travel. There doesn't seem to be any signs of dissipation. So the airlines are feeling bullish, at least the good ones are about able to service those folks. The pricing will be dynamic and it'll be competitive, is what I would say.
All right. Oscar Munoz, former CEO of United. Thanks for joining us.
Thanks.
Well, coming up, it's not just airlines surging as crude falls. Marriott hitting an all-time high today. We're going to check on the other travel stocks making big moves when the exchange comes right back. Welcome back to the exchange. Discretionary, the best performing sector today, with cruise lines among the biggest winners. Contessa Brewer joins me now to break down today's moves.
Yeah, so John, we've got a lot of wind in the sails for these cruise stops. Look at Royal Caribbean now up almost 9%. You've got Norwegian up 7%, Viking up 6.5%, and Carnival up 8% here. It's really crazy that these share prices are so closely tied to the price of oil. I was talking with the CEOs this week about it at Sea Trade at the keynote in Miami, and they said, look, the oil prices are for sure a headwind, but demand from customers is so high, they still are expecting big profits this year. Even Carnival, which famously does not hedge on fuel, it's just insatiable demand for travel. And that's a continuing story in spite of worries over inflation. But doesn't this look like the choppy seas there? Look at lodging here. You've got Marriott up 4%, Hyatt up 5.5%, Hilton up 3.5%, Airbnb is up on the day as well. Remember, Expedia owns Vrbo, and we can see the movement in these online travel agencies rising as well. Expedia is up almost 5%, Booking up 4%. You've got TripAdvisor up on the day as well. So what you see here really is that there's a lot of enthusiasm over consumers, even if inflation worries are looming, but those oil prices are just driving the share prices up and down, John.
I guess that allows them to say full steam ahead. Contessa,
Yeah.
thanks. Coming up, Netflix shares bucking today's rally, on pace for their worst day since October after the company reported an earnings miss and announced co-founder Reed Hastings will be leaving the board. But does the dip provide a buying opportunity? We'll trade it next. Welcome back to the exchange. Stocks rallying as the Strait of Hormuz reopens, it seems, temporarily. The Dow was up more than 1,100 points at the highs. Now it's up a little less than 1,000. The S&P topping 7,100 for the first time ever. Let's take a look at where to find the best opportunity today. CNBC contributor Tim Seymour joins me now with what he's buying. Let's start with Netflix. Worst performing the S&P today. Hey, Tim, earnings miss, weak second quarter guide. Do you binge it here or do you stop watching?
No, I think you binge. I think this is a chance to be buying weakness in a company that people probably know that there wasn't a lot of room to miss in terms of the valuation. But to get better, but the sub growth of 6%, ad growth of 4%, pricing power, they're going to grow pricing probably 4 or 5%. I just think that the bar was a little bit high coming out of the WBD merger exit. And people kind of thought it was game on, game on. I think it's just game on, and I think you're buying weakness.
So we've had this big growth surge this week. So Tesla shares up nearly 17% after the company reported progress on a forthcoming AI chip. So, Tim, do you buy it here, or is it too caught up in the Bitcoin and everything else that also surged?
Well, if it's caught up in Bitcoin, and the beta to the market has certainly always been good for Tesla. The good news for Tesla is I think Elon's gotten what he wants here, which is that the market really now is not pricing this as an auto company. So we're doing this on robotics, on driverless, et cetera. And I do think this is a story that for those folks that want that story, this market right now is showing rotation into those types of names. I haven't been a Tesla investor for a long time. I don't like the valuation, even though I recognize that there is seemingly intrinsic value in some of these services.
Microsoft was around 540 something back in the fall. Now it's around 424. Some bullish notes from the street. Shares climbing nearly 16%. This is a name you own. Do you pick more up down here below 500, or do you just sit tight?
I've been nibbling. I've been adding over the last week or so. I think the stock itself, certainly 10% outperformance to the S&P in the last 5 days, up 16% on its own, is good news. I think as we look towards earnings out 10 days or so, I don't think Azure is going to knock your socks off. The comps are tough. I think Copilot is still not that impressive. But I think you get to a valuation really on a forward basis, whether it's now around 23 times forward, where it has moved back on a relative valuation to the market is very compelling.
Well,
let's get here. Big cap tech is leading.
Let's get a little meta with the market conversation and not talk about meta, but talk about Robinhood. You know, how a lot of people are playing the market. Biggest gainer of the bunch, up 33% this week as the SEC loosens margin borrowing rules for day traders. Do you like Robinhood here, or again, is this just kind of a sign of the growth times?
No, I've been buying it real simply. I think great demographics, new products, new demographics, and I think 16 times revenue is not cheap. But I think there's a lot of excitement around their addressable market and clearly their investor base.
What a week. A lot of action in the markets for those who are trading. Tim Seymour, thank you.
Thanks, John.
And that's going to do it for us. Thank you for watching. The Exchange Power Lunch starts right now.
And happy Friday. Markets soaring after Iran basically said the war is over and they will not attack any commercial ships. Welcome to Power Lunch. I am Brian Sullivan. Kelly will be back here on Monday. That news, rocketing stocks. We are at record highs. The S&P 500 crossing 7,100 for the first time ever. The Dow rallying 1,000 points. The NASDAQ, it says hold my beer. It's going for an incredible 13 straight days of gains. That is something it has not done since Michael Jackson topped the music charts. And on that news, oil crashing, the June contracts for both WTI and Brent down over 10%. That is also sending bond yields down as well. If you didn't gather, folks, it's a big day. It's a very busy day today. So let's start with a stat that we hope will make you smarter. Here you go. If the S&P 500 closes above 7,021 and 39, oddly specific, it will have gained 3% this week. Okay, why do you care? Why is that relevant? Because if it does do that, it would be the third straight week that the S&P 500 has jumped 3% or more. 3 weeks, 3%. That's only ever happened 2 other times since 1980. And the big difference, those other 2 times, 1982 and 2020, were after or sort of in bear markets. And as your first guest today will tell you, we did not even enter a correction before this rally. Here now on set with us is CIO of Merrill and Bank of America Private Bank, Chris Heisey, and Interactive Brokers Chief Strategist, Steve Sosnick. Steve, that was your stat.
Yes.
So thank you very much. I'll take random stats for 600, please, Steve, because that was a terrific stat.
Thank you.
But all that aside, does it mean anything? Does it matter?
Oh, when you get very sort of curve-fitted statistics, like this has happened twice in a lifetime, or this happens once every 20 years, they're obviously not great statistical precedents. But the thing that I would say here is, I gave that in because I wanted that to point out how unusual it is for the markets to have a rally this big when it isn't as the result of a major bear market exit. 1982 was when Volcker basically said, we declared victory against inflation. And so that was of course a great reason to rally. We've been in basically a grinding bear market most of the 70s, early 80s. 2020, that was the May-June period when basically the stimulus started to kick in, the quantitative easing kicked up. So again, that was both bear markets. This was a bit more of a, this was a bit more of a 7% downturn. I think we got down to 9% intraday on S&P. There are some more examples in NASDAQ, but I'll get back to that.
Yeah, and so Chris, I would imagine that your clients a month ago were kind of like calling you up saying, Chris, markets are down 7 or 9. They're not down 17 or 27%, but 7% these days feels like a lot of pain. It was a scary time. It still is in some ways. Did they go from something to fear of missing out? Like, did you tell them, like, stay calm and invest on?
Well, that's usually what we say when the fundamentals are what they are, which is still very attractive. I think, to your point, Brian, it was fear of being in, phobia, to FOMO. Now, no one really knows when the FOMO is going to start to happen again, but if fear of missing out happens at a time when fundamentals are good and the bear market, as Steve was saying, is in the headlines, but not in the trend lines, that's when you feel comfortable with conviction to suggest buy on weakness, even in the face of such uncertain times geopolitically.
Well, I would imagine some of the people that did get out are now feeling a little bit left out. Guys, sit tight for 1 second. We do have some breaking news, and maybe you'll get your response. I don't even know what it is. We've got Federal Reserve breaking news. Governor Chris Waller speaking in Alabama. Steve Leisman, what is he saying?
Not entirely along with the joyous mood on Wall Street. He does say he would be more inclined to cut rates now and focus on labor market weakness if the conflict in the Middle East resolves quickly. However, if it runs longer, the Fed may have to maintain the policy at the current target. Now, note he does not mention hiking rates. He says if inflation risks outweigh those to the labor market, that's what would concern him. High inflation and a weak labor market, he says, would be very complicated for a policymaker. And the oil price hike combined with tariffs, that's what he's really concerned about. This double barrel issue, he talks about it, could lead to a more lasting increase in inflation. Talks about the sequence of transitory shocks as a reason for the Fed to be cautious in looking through the oil price increase. And he says the increase in inflation could compare with the shock from the pandemic. And he thinks, this is interesting, Brian, for you to think about, he believes markets are undervaluing the risk that the conflict continues. And I'll leave it there, Brian, but it's this idea of piling on one transitory shock after another and whether the Fed ought to look through it.
Well, I think that's the perfect place to leave it, Steve Leisman. We really appreciate it because back with our panel here and Chris Heisey, I mean, listen, I don't want to take anything away from today or the last couple of days, last couple of weeks. Markets have rallied. There's optimism that this may be over. We've got some positive signs. There's no question. But it's Iran. We don't really know who's kind of running the show. Is there a level of risk that you're still tolerating for your clients now?
Well, I think the level of risk is how much does that translate to a true shock versus a shock in our minds right now. Now, that's in terms of supply shock, particularly around energy. If that translates over into higher prices, input prices that last, not just in the United States, but around the world, last enough to dent economic growth that changes the profit story, then I'd get more worried. So it doesn't appear that
it doesn't sound like you believe, at least from what we've seen, that's enough to dent the profit story.
Correct. Right. There's too much going on in nominal GDP, one of which is a little bit higher inflation than we would all like, mixed with decent real GDP, a consumer that's still resilient despite the worries, CapEx that's still going up well above average, and then productivity that's hitting the cost line with margins expanding even in the face of higher input prices. It's really hard to change that story.
Because, Steve, every smart person that came on this network, this show, other shows, pretty much to a person at the beginning of this kind of said the same thing, that it's the duration of the war and the inflationary supply shock that will matter. Yes. That's the key to the markets. We are, 5 or 6 weeks, 7 weeks max sort of into this. In your mind, if it ended today, would those 7 weeks be enough to change the earnings picture, the inflationary picture in America?
It depends to what extent stuff really starts moving through the strait and to what extent production capacity has been taken offline for a long period of time.
Is not over. I'm confident saying, let's be clear, it's a month long to ship from the Strait of Hormuz to Asia or parts of South America. There is no end to the supply shock tomorrow because some Iranian leader says it's all clear.
Absolutely, and that's part of the issue. So you've also lost production capacity in Qatar, in Kuwait, and some other places. That's not going to come online instantaneously. So I would continue to look, and I was looking all along at sort of oil futures out 6 months to a year. And they're still pricing in higher levels even after today's decline. So that's telling you there is a bit of an oil shock. Now, as far as the earnings picture goes, to Chris's point, in many ways, the CFO's got the greatest gift of all over the last few months, and that is the best excuse possible, right? I mean, you would have had to blame things on the weather for the first 6 weeks of the year, but now you've got this supply shock, and you could say I can't do guidance, it's too murky. I don't mean to minimize the conflict by any means.
No, but I get what you're saying. For the second quarter, when we hear the first quarter numbers, Chris, and they come out and they give their numbers and then they give their guidance, I think it's an excellent point that nobody, and they're telling the truth. I don't know if anybody really knows what the impact's going to be because we're a couple weeks into the second quarter, and the supply shock will only hit 1 month out of 3 in the first quarter.
Right, and it clearly matters, right? There's a lot of strategists out there that says, well, the expenditures that are impacted by higher input costs through higher energy costs are much less than they ever used to be. We know that. And it still matters, but it is dramatically lower than 10 years ago, 20 years ago, 30 years ago. That's point one. So the actual overall collateral impact could be less. And I think that's what the market's telling us. The second thing is, why is the bond market so calm?
We have Rick Santelli coming up in a second. We should probably just bring him into the conversation because that's his area. But I'm going to give and maybe we can patch in Rick now. I'm going to give. He is good. He's there. Look at you. Say it. And there it is. Rick Santelli, I say your name, and you magically appear behind a graphic. So Chris Heisey asks a good point.
This spot right here on the SIBO floor is reserved for optimists who were willing to take some risk to make some reward, because once we wait for the final solution, the trade's going to be gone. It's like a horse out of the barn. There'll be a skeleton out in the financial pasture. So I commend those patriotic Americans who believed in the U.S. because this is turning out well. Is it rubber stamped and sealed? No. But look at what the market's doing, Brian. We consider interest rates. First of all, look at a 6-hour chart of 2s and 10s, oil and 10s, tracking very closely. Now, if you look at a 2-week chart of 10s, there's something fascinating going on. You ask why it's so well behaved. It really is, because it's basically been holding in the low 420s. So that is very good. And even now, as it sits at 424, we're down about 7 basis points on today, down 8 basis points on the week. I think what we are setting up for in the Treasury complex is the long game. I completely agree, debt and deficits are out of control. But I have a feeling that growth could turn out to be out of control. There's no way we ever stop spending in this country. But what we can do is grow our economy. And look at the difference between the size of our economy and Europe's over the last 15 years. And to me, that's the whole game. So you optimists out there, I think we have a shot to close above 50K today, but we'll wait and see.
Wow. And by the way, Chris Heisey here on set has a question for you, Rick Santelli.
Hey Rick. All right. I appreciate the note there. I appreciate the optimism, the energy for sure. I want to know, in your expert experience, looking at the Treasury market, looking at credit spreads, does the bond market see a problem with what everybody's worried about?
No. Sees no problem. As a matter of fact, as it sits right now, we're up less than 10 basis points for the entire year. We closed at 417. We're at 424. How much trouble does that spell? We're lower in yield than we were last summer. This is a really amazing Treasury market. Is it going to stay that way? No. What's the real test is that the day before the conflict, 10-year yields closed right around, 394? That was the cycle low yield. We couldn't have picked the worst time to exaggerate the up move when the conflict began. So when it is ultimately settled, which side of about 4.25 we settle on will mean a lot. If we're above it, we're going to be going above 4.5. If we're below it, we'll retest those pre-conflict lows.
Well, Rick, I hope to be there in that spot for the optimists there with you and all my friends at the SIBO, and I'm going to be carrying a really hot, fresh hamburger because I know you're going to win the bet and you're going to be right. Have a great weekend.
You bring the flag. You bring the hamburger. I'll bring the flag. How's that?
There we are, and I'll bring an eagle. It's just going to come along with me.
There we go.
The Eagles, Chris. Don't get all excited. Thank you very much, Rick. All right, so let's go back to it. And I'm going to give you I'm going to see your stat at the beginning and raise you one, 50%. That's the gain for the NASDAQ over the past 12 months. I know we've been rightfully worried and focused on what happens with Iran for the last 7 weeks. But the market has been just ripping, gone from about 16 to 24,000. There were some concerns, though, about AI spending earnings. Are those now back on the table, or in your mind, are those also gone, or were they should have never been there in the first place?
Well, I think to some extent they were not ridiculous, because we are seeing a change in the fundamental nature of the balance sheets of a lot of the big hyperscalers, right? They went from having almost a magical balance sheet and of being they spun off a ton of cash. Their earnings power is phenomenal. Now they're borrowing a lot of money. They're becoming asset heavy. That's not necessarily a bad thing. They can continue to make money, but I think some of the magic dust has worn off. The other thing that I would say in terms of the rally, I started to allude to before, there are other examples I found later after I sent your producer the first set of notes about NASDAQ, and there are more examples of NASDAQ happening. Unfortunately, the vast majority of them happened between 98 and 2000. The last one of that period was literally...
That's not a good time reference.
So we're
supposed to feel good today.
When it happened in 98 and 99, it kept going. When it happened, late 99 and 2000, that was the end. And then it didn't happen again. It happened again after 9/11. There was a bit of a rally. It happened again in 2002.
And I know you guys are going to stick around gratefully and come back, but I want to leave it with you, Chris, before we'll bring you back in a few minutes. They're not going to go away. And I don't think this Iran thing is over yet, but that said, let's sort of move past it. What's the next most important thing then on your team's watch list?
We're going to start to worry about another thing, and it's going to be the midterms. This is what typically happens somewhere late April.
Say it ain't so. Say it ain't so, Chris.
Well, I think we got to look past that too. That's not something, that worry is not something that can actually dent and turn around, and I'm going to use the analogy, turn around this big ship we call the U.S. economy. It's not enough to turn that around and go the other way.
It's going to take our focus, and we do know that historically in midterm election years, the markets do tend to go down, 15 to 18% on average, because people get jumpy.
Yeah. Here's where it gets interesting, though. That is, and Steve said this before, you have to be careful with numbers, because there are pockets of the market that have already done that. And the structure of the market today, when you could actually go from a correction almost to an 11-day rally to a new all-time high, fastest ever done since 1928, more companies are technology companies today, not just the tech sector. So there's all this mechanisms within the market that history will tell you what to look for, but it doesn't always repeat.
All right, well, we're not done with you guys just yet. We dragged you out to New Jersey, so we're going to welcome you back in a few more minutes if you guys are generous enough to stick around. Absolutely. Chris and Steve, thank you both very much. All right, after the short break, oil prices plummeting, again on hopes that ship traffic in the Strait will soon get back to normal. But is the coast really clear? We'll discuss that with Halima Croft, Matt Smith, and more. All right, you know this. It is the map that every one of you should be keeping a close eye on. Of course, what else? Strait of Hormuz. I know, I'm tired of saying it too. Stocks are surging, oil is down, President Trump and the Iranian foreign minister declaring the strait is, quote, open. But there are some caveats. The first, President Trump says the naval blockade will remain in full force and effect as it pertains to Iran only until such time as our transaction with Iran is 100% complete. We are nowhere near that right now. And media affiliated with the Islamic Revolutionary Guard, and take this with a grain of salt, because remember, it is Iran, does warn that if the U.S. naval blockade continues, the Strait of Hormuz will be reclosed. Again, I'm always wary of quoting anything from Iranian state media, but that's what they're saying. There does seem to be a few conflicting messages, but obviously look at the stock market, look at the oil market, look at the bond market. They're reacting as if the coast is clear. So let's try to kind of clear this up. Let's bring in Halima Croft, Global Head of Commodity Strategy at RBC Capital Markets, CNBC contributor, joining us on the CNBC Newsline, because I know you're traveling, Halima. Is the coast clear?
Well, I think President Trump continues to win the sentiment game when it comes to the oil market. The fact that the Iranian oil minister was out on social media saying Strait of Hormuz open for business, that's all the market needed to see. They can again start pricing in end of conflict. But these caveats that you mentioned are critical. And the IRGC also said that you have to coordinate with them, their naval command, and go through their navigational shipping lane in order to proceed through the waterway. So that's a pretty important caveat. And a number of shippers have already come out and expressed trepidation. CEO of the Norwegian Shipping Association out saying he's concerned about mines. He's concerned about how does he coordinate with Iran. So I don't think the coast is clear, but I think it's continuing the trend of market participants saying they're going to call time.
Yeah, and I want to be clear on, and we want to be optimistic today. We're not being sour grapes. The signs are pointing to good news. But when I hear the Iranian foreign minister say one thing, and then somebody purporting to represent the Iranian Guard, and I'm very skeptical of any of this, because this is a country who some of their people, they'll massacre their own people en masse. So I'm not akin to trusting those types of folks. But we are hearing, Halima, some conflicting messages. Do we even know who to trust right now?
Well, I think we should trust the shipping executives, and I think we should really be paying attention to what they're saying about the security of the waterway and their comfort level going through at this juncture. And we have to pay attention to the status of the talks. There has been some discussion about talks resuming as early as Sunday in Islamabad. Will J.D. Vance be leading those talks again? Really unclear right now, the composition of the U.S. delegation. And also, we still don't know the deal details when it comes to issues like uranium enrichment. President Trump will say one thing, that they're giving it all up, and then the Iranians continue to insist on their fundamental rights to enrich uranium. So we don't know how close we are to bridging what has been pretty significant gaps.
Yeah, well said, and I think that's perfect advice. Watch the ships, watch the shipping execs. They're talking to insurance executives. They're the ones that know exactly what's going on. Halima Croft, appreciate that. Let's get back to your Friday. Thank you. I'm sure very, very busy. Yeah. So on that note, you are starting to see more ships cross the Strait of Hormuz with their transponders on. Now, those include that boat right there. It's a very special ship. It's called the Celestial Discovery, and it's a cruise ship. And that's special because that is the first passenger vessel to cross the strait since the war began. The ship departed Dubai today after spending about 47 days docked. That is a notable and potentially positive sign that conditions are beginning to normalize. Let's dig in a little bit more on what's going on with Matt Smith. He is Director of Commodity Research at Kepler. They are the company that own marine traffic, so you're probably living on this map, he said. Easy for me to say, it's been a long week. Matt Smith, are we starting to see ship traffic somewhat normalize at all?
No, Brian.
Oh.
So, no, I'm sorry, but it's not, right? So you have seen that cruise ship. Now, by all means, that's the first one to pass through, as you mentioned, since the start of the conflict. So that is a positive thing. But the result today has essentially been winners on both sides, right? President Trump has got oil prices plummeting. He's like feeling fantastic about things. The flip side is that Iran still has all the leverage here. The Strait of Hormuz remains closed. You've essentially got the Strait of Iran, right? So it's basically this safe passage where they're not collecting tolls there anymore per se, or they're saying they won't, but they're acting like a bouncer. So they're the ones that are going to be able to say, okay, you can come in. No, you do one, right? And so this is the thing. You're going to have these vessels. There was about 10 to 15 that was passing through over the last few weeks, right? So we shouldn't, it's a laborious process. It's going to take time for these tankers to get through there. So really, in the grand scheme of things, the numbers look like they're going to remain low.
Do we have any idea, maybe we don't, it's fine. Do we have any idea how many ships are running this with their transponders off? Basically, turning off the lights and running through at night?
You've got the Iranian tankers that are doing that. So you've got some of those there. So that's it. But otherwise, we don't know if they are doing it at night. But the thing is, we don't know if the strait is mined or not. And so, the Iranians know where those are. So they're okay to pass through. But everybody else, you're just basically playing a game of chicken, right? And so our kind of base case assumption is you're not really getting very many of those without their AIS on.
Yeah, it is. And and let's not forget that there are 2 and maybe more U.S. naval vessels enforcing that blockade, which means if any ship tries to go to where you were mentioning, they may get, fired upon. That risk does exist. When will Matt Smith and your team be convinced that things are truly better? What do you need to see?
Yeah, sure. So we're watching what we call the first movers. So essentially, you're going to have those larger operators that are going to start to look to move through if there is the conditions there to do so. So once we see some of those go through, that will give confidence for others to pass through as well. And so it's really once we start to see some of these bigger players taking on that move, and then that will encourage others to do it, and then others see safe passageway, and then that's when we start to see things getting back to normal. But really, we're still a long way from that, Brian. Right? We've only had 8 crossings just today, 4, and all of those have been empty as well. 4 dry bulk, a couple of LPG tankers, that's propane, and then 1 tanker, actually just a short sea tanker, has just gone through and then gone back again. And so really the situation...
That's just weird, crazy tanker wants to press its luck? Like, what was that?
Yeah, they're just a risk taker. No, I think what it is, Brian, is you've got a situation where that blockade isn't at the Strait of Hormuz, right? It's well outside of there. So even if we do see these tankers going through the Strait of Hormuz, then they approach the blockade, and then they are told or instructed or have the good knowledge to turn around and go back.
Yeah, and when we start to see a lot of those red dots, red lines, red arrows move on your maps, then we'll know. For now, the news is good. The actual ship traffic, not as good, but it's early. Matt Smith, Kipler, always appreciate your views. Thank you very much. And folks, good time to remind you to sign up for our energy-related newsletter called Power Insider Weekly Piece, key news, meeting power players, and more. How can you sign up? Go to that QR code. Go to that webpage right there, cnbc.com/power newsletter. A lot more to do. And a huge thanks, by the way, to all the people that have already signed up. The reaction has been really wonderful. All right, still ahead, the software shock turning into a software surge in just over about a week. Is it about to take off even more? Dan Ives here on Set. All right, welcome back. The stock market ripping today. The NASDAQ hitting another record high and now on pace for its 13th straight days of gains. Now, some of the biggest winners lately, today and this week, were some of the most beaten down software stocks. Most of them are up double digits this week. The big software ETF, the IGV, up 15%. That makes this week the best week for that ETF since October of 2001. That was a long time ago. Your next guest just returned from a 2-week trip to Asia for a check on AI demand. Says he saw more bullish signs for the sector. Joining us, Dan Ives, Global Head of Tech Research at Wedbush. Number one, thanks for coming in because you must be spectacularly jet lagged.
But that's why coffee is great.
Yeah, and hopefully ours here is doing the trick. I'm sure you know people like to give you the business about being too optimistic. Sure. Now, you've been optimistic. You've also been right. I mean, what you've said has occurred. Is there anything that you saw in your extensive Asia trip that tripped you up?
I come away incrementally more bullish.
More bullish?
The reason is that if you look at demand in terms of what you see in Taiwan, relative to all the chip players, all the supply chain, demand's accelerated. I mean, we're not seeing any cracks from an AI build-out perspective, which means from an earnings perspective, that's not just bullish for hardware players, the hyperscalers, the Microsofts, the Googles, the Amazons, and ultimately you talk about the software trade, that's where the ripple effect's gonna be. So I just think this is a bright green light going into earnings season, everything we see from a demand perspective, and I think that's the key right now. It comes down to monetization. We come way incrementally more bullish.
I want to combine your world and sort of the world I talk about a lot with energy. Taiwan, South Korea, the places you were, Japan, they're right in the middle of this energy supply shock. Was that discussed at all? I mean, it had to have. When it comes to producing semiconductors and stuff, it takes a lot of power, and they're worried about power right now.
Yeah. So right now, if you think about helium being right front and center in terms of through the strait, I mean, there's probably about a 6 to 8 week, what I view as really reserve that they have. So the point is that when you think about supply perspective, there is no really concern that there's going to be supply issues over the next few months. Now, look, if this continues, of course, for months, and then that's a whole nother situation. But I think it was calm and much more, I think, not fearful in terms of what we saw from a supply perspective. Demand clearly is what's accelerated, but I think you kind of look at this sort of combo, you felt very comfortable in terms of from a supply perspective, but
they have the helium, they have the raw materials, they have the power they need now, and in, I assume, weeks to come. I'd say because it's going to take a couple weeks to get the new ships to there.
I'd say 3 months. In my view, I think you have a few months until this would be some sort of panic situation. So I'm not going to call it Goldilocks, but I would just say that we're in a situation where I don't think that that's going to be anything in earnings season that you're going to start to see cracks start to form.
Are there any companies you're watching more than any others in this earnings season?
I think it's really, look, software, and me and you have talked about, I think that still is the most disconnected sell-off that I've seen in my career. You're starting to clearly see a huge rebound here, but it comes down to you look at Microsoft, you look at Amazon, Google, the hyperscalers, because when you think about everything that's playing out, hardware is where you've seen the success. Now, the hyperscalers, the software, you start seeing monetization. I think Palantir is going to be one to look at. I think ServiceNow, everything that McDermott's doing, I think that's very important in terms of as a barometer. Because look, it goes back to the Anthropic dark cloud fears over software. It's still there. You need to prove it out. But I think this is, at least for tech, this is, it's a third inning of this game in terms of AI.
Just the third inning.
Top of the third, one out.
Top of the third, one out. I love it. We're going to let you get out and go to bed. I mean, did you not sleep? You just got off a plane from Asia and came straight here? Or?
I mean, I had some time to go home, and get here. But look, but it does speak to the point. You see the demand in Asia. You don't see like a lot of the bears from the 30th floor of the New York City office.
And that's the power of getting on a plane and seeing this for yourself. That's what you got. You got to just get on a plane and go, and then eyeball it. Dan Ives, always appreciate it.
Thank you.
Thank you very much. All right, coming up, stocks ripping today, but should you buy the rally? If you haven't, do you buy into it now? one of our favorite traders, is going to share his playbook for navigating this red-hot market. Stick around. All right, welcome back. With just over 1 hour trading today and in the week, the Dow is up 900 points. The Russell 2000 small caps is up 2% today. By the way, it's up more than 10% this year. So today in this market rally, what's not working? Well, it's going to be energy. It's the worst performing sector today. No surprise. Valero, Apache, Occidental, Marathon Petroleum all leading it lower as oil prices crash. Let's bring in now Jay Woods, Chief Market Strategist at Freedom Capital Markets. Also back with us, Chris Heisey and Steve Sosnick. Full table, full day, very appropriate. Jay, who's surprised that oil stocks are pulling back when oil's down 10%?
Yeah, it's the worst drop since when? We had the biggest rally since, years before. So these swings are going to be wild. The question is, when it stabilizes, is energy actually a good place to be? And I think it will be. You look at these stocks, you look at the Exxons, the Chevrons, the Valeros, they were doing well with $55, $60 oil. In fact, Exxon broke out when oil, before this crisis started. So I think as these stocks dip and settle in, I don't think the worst is over just yet, but it's going to give the investor who missed out on that 40% gain in energy, XLE was up 40% at one point, a time to finally get into it. Are we going to see the spikes? Are we going to see the volatility? I hope not, but it's not out.
And I want to be clear, like if oil went from 65 to 85, we'd be bummed because we're like, oh man, it's so high. It's now gone from 120 to 85 and everybody's happy because it's going in the other direction. That said, oil was high for 1 month of the first quarter and now where it is a couple weeks into the second quarter. Any read on earnings or how these companies are going to deal with this?
Well, on the earnings, as a technician, you're asking the wrong guy.
Yeah.
The question is how much are we higher for longer? Does it stabilize now at 80? Is that the new floor? Or can we get it back into the mid-70s and then go back to the way it was? As long as the strait is clogged and we've had this logjam, it's not going to go much lower than this at this point in time.
You don't think so? As a technician,
all the time.
Don't quote me back to me.
Yeah.
But you don't. Yeah, because I've said I don't think 65 is in the cards anytime.
No.
Absent some sort of severe global recession and oversupply shock.
No, this has been about knee-jerk reactions, and we saw it. We saw this market. The script has flipped now. So as someone that was watching this slow and steady downtrend, these crazy headlines, we never got that washout. Sentiment, all-time record lows, that was a tell as a technician that the bottoms are low. But markets bottom in times of uncertainty.
And Steve, stocks go up and down because there's more buyers than sellers or more sellers than buyers. I mean, that's kind of it. And there's usually a reason behind that. Have you seen in Interactive Brokers any change in sentiment on the energy stocks to this magnitude?
In the energy stocks, not as much. They never really rose and got into the most active list of the stuff that I follow very
likes
closely.
them that much.
They don't. No, not that. The sexy.
They're not Nvidia.
Dan Ives was talking about the sexy stuff. We're talking about less sexy stuff right now. But to be fair, what our customers were doing was they were very aggressive buyers actually into the end of March and the beginning of April. And they've actually gotten more or less to the sell side a certain amount. We had, of the 25 most active stocks on our list, 9 were to the sell side over the last week. That's very unusual for us because usually they're almost always net buyers, at least have been for years. So the customers they did buy low, sell high. Maybe some of them regret selling a little earlier. But again, the question I get from investors all the time is, what the F is going on out here right now?
Yeah, easy now. We had a little Kevin Hart moment yesterday. Take it easy now.
I stopped with...
I think, by the way, you gave me my tagline for my new newsletter. Power Insider, less sexy than Nvidia. Chris, I know your clients probably never asked you about energy stocks, mostly en masse, until about 7 weeks ago. Do you have a take on that sector?
We're very similar to what Jay and Steve were just talking about. Investors were looking for areas that were underinvested for a very long period of time, but there needs to be a catalyst. It can't just be because you were underinvested, and that's infrastructure plus the investor. So portfolio positioning was extremely low for many, many years, as you already highlighted. And then all of a sudden, the fog of war hits, and now you're starting to talk about where oil prices go, and then you start to put that in your mind about free cash flow and higher profits. And when you look at the actual earnings of the S&P, they're one of the ones that were growing even more.
Yeah.
So now that invited more money coming in. We haven't seen as much on the sales side yet. People are still very interested in what does this mean for the next few years. We moved it up to neutral from underweight in our portfolios in the Chief Investment Office. And it's a small
Neutral's not the biggest badge of approval. It means you don't dislike it.
It allows you to participate, though. That's the key. So when you take a look at where positioning was, inviting more capital into there, the story's not over. Their free cash flow is going to continue to do really, really well. And I think portfolios will be revalued upward because of it.
Yeah, and we've got Conoco on April 30th, and I believe Chevron and Exxon earnings on May 1st. Don't quote me on that, going off memory, but I'm pretty sure that's when they are. So Jay Woods, absent all this, I asked these gentlemen what they're sort of next most watching. What are you next most watching? Is it technical levels on these markets? And if so, what are they?
Doubt. So
then what are we watching?
The script is flipped. So now we're watching that 6,900, that 7,000 level. When we see gaps in the market and then continuation gaps on the breakaway gap, now we have levels where buyers are going to come back in and buy the dips. So what's
a continuation gap on the breakaway gap?
Your initial gap is the breakaway gap. That's when we gapped above the 200 and the 50-day moving average. We held that. We had another gap up, and then this morning, another gap. The S&P opened up over 80 points. So, from the 4 o'clock close, not this after hours pre-market stuff, we gapped up. So when you look at the chart, you'll see a gap, and that gap has memory. And if it doesn't fill, when we get back to it, you usually see buyers come in.
Do you think this will carry over to Monday?
We'll see. The weekends are always interesting. News breaks on the weekends.
We're aware.
This ended on a tweet on a very busy Monday morning 2 weeks ago. So who knows? When we were on the way down, we were saying watch Twitter. On the way up, we're going to continue to monitor it, but at least we have levels. And I think we're out of the woods. We're in earnings season. The financials started us off. The leadership is changing. Financials still looking good. Citi, my favorite of the group, but Goldman, which I personally own, and Morgan Stanley.
What about Bank of America?
It would be number 5 on my list of 5. So,
but it's on the list.
It's
like
on
it's
the
neutral.
list.
It allows you to participate.
I believe that the financials are finally back and the trends are getting in the right directions. Technology, when you have the semiconductors continuing to lead, that is positive. NVIDIA breaking out. Let's see if we can get back above 200. They'll rally into earnings. Will good earnings get them higher? That's the question.
That is the question for another day, though, because we are going to say goodbye. Jay, Steve, Chris, gentlemen all, big day. Really appreciate your time, your views, your thoughts, everything.
Thanks.
Thank you very much. Let's now get to Contessa Brewer with a CNBC News update.
Well, hello, Brian. The Justice Department has reportedly removed a career prosecutor leading the investigation into former CIA Director John Brennan. CNN reports the prosecutor resisted pressure to bring charges quickly against the Trump critic. The president has long railed against Brennan for a 2017 intelligence assessment that found Russia interfered in the presidential election to help Trump win. The billionaire founder of Lululemon is building a new coalition of small athletic-focused brands. Bloomberg reports Chip Wilson's latest venture includes new and existing small brands. Wilson is a major investor in Amer Sports, which owns brands like Arc'teryx, Wilson, and Salomon. And New Jersey Transit announced today round-trip World Cup train tickets from Penn Station to MetLife Stadium. I mean, this is like 2 miles, maybe 3. They're going to cost $150. 8 games are scheduled at the stadium. New Jersey Governor Mike Sherrill vowed that New Jersey commuters are not going to be stuck with the FIFA bill for public transportation. She really wants to tell the world, welcome to New Jersey.
Well, I'll defend Mikey Sherrill a little bit and just say that she inherited this. That deal was made under the previous governor, Contessa, but you're talking about $150 to take, to your point, a 2.5-mile train ride. Tickets are hundreds or thousands of dollars each. They're going to knock out trains from Penn Station. I don't know about you, Contessa. I love the World Cup, and I'll be very excited to watch it from my couch.
I'm planning to go to the game, and apparently I'm going to shell out $150.
You're going to the game?
Ticket. I want to.
You have any extra tickets?
Hand out, Brian.
Contessa Brewer, thank you very much. I kept trying to get on the list. I didn't get on. I gave up. All right. Anthropic CEO Dario Amodei in D.C. today to meet with officials about its Mythos AI model. The latest update on that meeting. Is Mythos going to eat the world and cost us all our jobs? I don't know. Mackenzie Sagalos might. She's up next on that.
Build an app that works my way with Base 44. My work is chaotic, and I need tools that keep up. Today, I can build an app that adapts to me. I can create calculations, automations, and insights I need, all in one place. And I add my own AI agent that handles the routine work, all built my way. My numbers, my projects, my data. Because when you create it yourself, it just works. Base 44, build it your way.
If you're going to remodel your kitchen, you're probably excited to do it. If you're replacing your windows or doors, you may not be as excited. But that's why Renewal by Andersen has such amazing discounts. Brian Gary here with Brian Price, one of their project managers.
Hey Brian, even though windows and doors can help make your home a lot more comfortable, sometimes people need a nudge to start this project.
So what can you guys do?
Well, between our great deals and several financing options, we can make windows and doors easy to afford.
You could end up with a monthly payment that's the same or lower than your cable bill.
Really?
Happens all the time.
Do people have to replace all their windows and doors at once?
Not at all. Most of our customers do the job in phases. We'll help identify the bad windows and doors and the ones you can do down the road.
Now, why do you custom build your windows?
Well, you don't want some company messing with the framing of your house just to fit their off-the-shelf window. We build our windows specifically for your home, which can help improve energy efficiency and comfort.
And it's great that your company cares about the environment.
Definitely. Andersen's exclusive Fibrex material contains 40% reclaimed wood fiber by weight. That means trees were saved in the making of our windows.
Okay, so I want a price, but I'm super busy.
Well, we have appointments 7 days a week. Mornings, afternoons, evenings. We'll go over colors, styles, payment options, and at the end, you'll get it down to the penny price.
Nice, no pressure.
The product is
marvelous, but the people were even better. And it was one of the easiest things my wife and I have ever experienced. And we are extremely pleased with the product and how things turned out.
Before April 30th, buy one window or door and get the next one 40% off. Plus, get an extra $200 off your entire purchase. With no money down, no monthly payments, and no interest for 12 months. Call before April 30th, 1-800-918-0808.
Have you ever played Tierra Rajada?
Tierra Rajada plays to 7,015 yards, fairly priced, friendly staff.
What's happening?
Golf Now has over 2 million course ratings and reviews. Gopher memorized them all.
He's good.
Golf Now's even better.
Oh, sorry. What I miss?
There is a high-stakes meeting happening in Washington, D.C. Anthropic CEO Dario Amodei is scheduled to sit down with White House Chief of Staff Susie Wiles about the powerful AI model Mythos. Mackenzie Segalo is joining us now live outside the White House with more. Mackenzie.
So, Brian, I'm here at the Southwest Gate. CEO Dario Amodei could walk through at any moment. He is set to meet with the White House, specifically to talk about Mythos. This is an about-face by the government. Both sides were at a stalemate on that fight over whether or not the government could use Claude's model. But Mythos is so powerful, that cyber AI model, that only 40 companies, financial institutions, tech companies have access to it from Anthropic. The government reportedly, some of its intelligence-related agencies are using it right now, but Treasury wants it. Multiple other federal agencies want access to it. So that's what these talks today are about. There's still a question, Brian, about that supply chain risk designation and whether or not the government will lift it in exchange.
We'll let you go so you can ask Dario a couple questions when he gets there. Mac, appreciate that. More Power Lunch right after this. Jay Wood's kind enough to stick around for the last minute of the show. And in that break, you gave me some amazing stats. Only 3 out of the S&P 500, Hershey, General Mills, Abbott Labs, are oversold. Is this market overdone?
Well, if you believe this streak is going to end and you want to see a reversal, these 3 stocks, I believe it's only Abbott now in real time that's oversold. You may see a rally.
1 stock out of 503.
One. So this has been a heck of a rally. If it does pull back, this is where people may go. And then I'll give you more boring stocks. T-Mobile, Verizon, AT&T. They got hammered the last few weeks. They look like they could get, a quick trade. They don't really excite, but hey,
if you can make money in a quick trade, you're watching.
That's where the traders may go in the next week if we do pull back.
Well, Jay Woods, thank you for sticking around. Really appreciate that. Have a good weekend. So to wrap it up, folks, the markets are rocketing. You got 1 hour to go. It's going to be a very important hour. I will not be here for it, though, but don't worry. The Closing Bell team has got you fully covered. Thanks for watching. Have a good weekend. We'll see you Monday. Closing Bell starts now.
Thank you, Brian, and welcome to Closing Bell. I am Frank Holland in for the Judge Scott Wapner. We are live from Post 9 at the New York Stock Exchange. This make or break hour, it begins with a roaring stock market. Take a look, green across the board. The Dow up about 870 points off of its highs, but still up about 1 3/4%. The S&P up over 1%. The Nasdaq up 1 1/3. The Russell up 2%. We also have Iran's foreign minister declaring the Strait of Hormuz, quote, completely open, sending the majors soaring. Let's get straight to the scorecard with 60 minutes to go on regulation. I just hit the Dow, the S&P, and the Nasdaq. As we mentioned, everything's higher. Oil plunging. Following that announcement, as supply disruption fears, they ease. Other sectors also surging on the news. We're looking at cruise lines. Take a look at the action there. You see Royal Caribbean up almost 8%, Norwegian up about 6%. Airlines also rebounding. United up almost 7%. Tech also roaring back. Oracle, AMD, and Microsoft all up double digits for the week. And we are also watching Washington. Anthropic's CEO is preparing to have a meeting at the White House to discuss the company's new Mythos model. We'll have a live report on that coming up in just a bit. It all takes us to our talk of the tape and what's next for this record-setting rally. Let's bring in Partners Group, Anastasia Amoroso, who joins me right here at Post 9. What a day to have you here, Anastasia.
Good to see you, Frank.
Okay, we're on pace for new record highs, okay? Is this a rally that you would quote-unquote chase? We have Jonathan Krinsky from BTIG, coming up just a bit later in the show. He says, don't chase this.
Yeah.
Would you chase it?
I mean, look, right here, right now, probably not. We've had a monster week. We had a monster couple of weeks, and the snapback has been so large in magnitude and so quick. So maybe not right here, right now. But I will say the rally has occurred, Frank, for good reasons. And the good reasons are that oil is not at $100 or $120 anymore. It is declining, probably not to 60 where it was before the war, but 70 or 80. And that is more than digestible by the global economy. So not right here, but I will say that there's a lot supporting the economy otherwise on the consumer front, on the corporate front, on the AI front. So from a longer term perspective, let's say we ease off a little bit of the current levels. I will say the narrative is back to where it was before the war started, back to February, and it was quite constructive. So give it a little bit of a pause, but yes, probably still continue with it.
I have questions.
Okay. Sure, let's do it.
We're on pace for a couple of days of record highs, new record highs, but you're saying we're actually back to square one. We're back to basically where we were before the Iran conflict started.
Right.
Now, I do have to ask, energy was a big part of the rally before the conflict started. We've seen a lot of fluctuations in energy. Now, is that sector just as attractive as it was before all this?
Look, I think all of the developments this year have forced energy into the spotlight, meaning it is a critical enabler, whether you're doing data centers, whether you're doing energy transition, you need natural gas. So I do think between the developments of Venezuela and also now Iran, it is a sector that needs to be paid close attention to. Now, the parts that we like within the market is the natural gas infrastructure and maybe not the commodity sensitive infrastructure, not the price of natural gas or oil itself, but actually transportation of it. So I think that is here to stay, that is front and center. So I would not give up on energy just because it seems like we have resolved the Iran conflict.
Okay, what's your take on tech? NASDAQ on pace for a 13th straight day of gains, almost certain at this point. Nothing's ever certain, but it's pretty close to being certain right now. That'll be the longest streak since all the way back in 1992. At the same time, we're getting the numbers on earnings. It's still the early goings, but earnings up about 14%. What isn't priced in? What isn't priced in? What do you think is going to move the market higher that's going to come up and keep investors in this market continuing to buy? Because we knew earnings were pretty strong, and obviously we've been following this NASDAQ rally.
I think longer term, what's not priced in is that we're still in probably the first wave of what is a 3-wave transformation that is AI driven. The first wave is you kind of transform your business processes. The next one, you transform the performance, and the third wave is really about the business model transformation. Frank, I'm talking about here, multi-year cadence of some of that. And I think, near term, what's not priced in is, sure, we've got the conversational AI momentum giving way to the agentic AI momentum. I think you also have the physical AI that also has to come into the framework. You also have governments increasingly turning to AI, especially amidst the geopolitical conflict. So I think that is not yet baked into a lot of those estimates. And, having said that, the AI momentum is clearly continuing. If you look at the number of agentic AI tools and plugins and APIs that are launched so far this year, it is double what it was for the fourth quarter of last year. So I think there's plenty of momentum, and I think we'll hear that out of the hyperscaler earnings.
Okay, to your point, if we're back to square one, aren't we also back to those AI disruption fears that rattled the market? In fact, this week, Claude Opus 4.6, I got to keep track. It's like 4.6, 4.7, they keep coming out. It came out. It's better at software engineering. It's better at following instructions, and it's also better, quote unquote, you're talking about physical AI, at completing real world work. So does that mean we're going to also see those AI disruption fears that are going to make the market very volatile?
It's a great point, but I think what happened, Frank, over the last couple of months is that investors had time to digest and what does AI disruption mean to software. And at first blush, it was, let's say, 20% of private credit is in software. It's all going to be disrupted. But actually, when you think about it, when you study it, there's so many nuances within software. And first of all, the application software is likely to be disrupted a lot more than the infrastructure layer. And second of all, the horizontal software is likely to be disrupted more than the vertical software. And so once you kind of parse through that and you realize that software at risk, again, within private credit, for example, is not actually 20%. Software at risk within private credit is closer to 7%. And the other thing that investors sort of assumed at first blush, back in February, is that all software companies are going to face an earnings cliff and is coming now. But the truth is software companies have significant margins. The margin for software companies is somewhere around 75%. So Frank, if you're a company, software company in Silicon Valley or anywhere around the world, you're not sitting there waiting. What happens when the agents come? You are redeploying that margin, you're adapting, you're investing, you're innovating. So I think investors have developed a much better understanding of that fact.
Well, I think we have to wait and see until next week if they actually have. Anastasia, please stick around. We got a lot more to talk about. Investors are closely watching several key Fed speeches this afternoon. CNBC senior economics reporter Steve Leisman, he's here with all the headlines. We've got a lot of conflicting headlines today about the Strait of Hormuz. We're getting some conflicting headlines from Waller and Daly as well.
Yeah, and I'm sorry not to be able to add to the joy on Wall Street, but Fed Governor Chris Waller is suggesting the U.S. economy may not quite be out of the woods yet from the Middle East conflict. In a speech today that, by the way, came after all of this news of Iran talking about the Strait of Hormuz being all open, Waller expressed some optimism the economy could heal quickly, but worried more about a lingering conflict. He said, quote, oil futures prices and securities markets in general seem to be undervaluing the risk that the conflict continues, the strait remains closed, and disruptions to production and shipping keep energy prices high. He said those were real possibilities. He also expressed concern about whether the public's expectations for inflation could rise because the oil price shock is coming on the heels of higher prices for tariffs as well. He says, while intellectually it makes sense to look through each shock with a sequence of shocks, policymakers need to be more vigilant. Waller said the Fed could get back on track to cutting rates and worrying about the job market more if the conflict and its effects dissipate quickly. If it lingers and there's continued concern about inflation expectations, the Fed may have to remain on hold, especially if high oil prices begin to raise and bleed into other non-energy costs, Frank.
Our Steve Leisman, live from D.C. Steve, thank you very much. I want to bring in CNBC contributor Ryan Dietrich from the Carson Group and Joe Tanius from Northern Trust. Partners Group, Anastasia Amoroso, still with us. Gentlemen, thanks for joining the conversation.
Thank you.
Oh, okay, Anastasia, I think Anastasia, I'm going to turn to you. We're having some technical difficulties.
Good.
Everything's working on Wall Street. We're having some problems with some of the things that we're having technically. I wanted to talk to you about what Steve Leisman had to say. You heard some, I think most people will consider hawkish comments from Waller. Daly also out with some hawkish comments as well. What do you make of that? We're about 2 weeks away from the next Fed meeting. Do these comments matter today? Do they matter until we get more clarity on the Strait of Hormuz? Because it's almost certain we're going to see a pause at the April 29th meeting.
Yeah, we're about to go into the Fed blackout period. And, I think what really matters is the last inflation print. Presumably that incorporated some of the oil impact, but that oil impact was pretty insignificant in the grand scheme of things. And although if headline inflation has come up, the core CPI inflation is really, really contained. And so now you fast forward to today and you've got oil prices that have retraced significantly. So I do think that despite some of the hawkish comments, the Fed is much more likely to look through this temporary inflation spike and look at other parts of core inflation that are easing. For example, core goods inflation is actually easing because the impact of tariffs is starting to roll over. Housing inflation is easing. Wage inflation is running about 3.5, 3.7%. And, consumption overall is not that rampant. So I think with all of that, I actually see more reasons for inflation to skew down than up over the course of the year.
Joe, I believe that we have you right now. I want to come over to you right now. I want to get your take on, you're laughing, I know. Even we have technical difficulties, Joe. Your take on the rally that we're seeing today. I talked to Anastasia earlier about a note from Jonathan Krinsky saying don't chase it. How do you view the moves in the market today?
Look, I think going back just a few weeks ago, we didn't necessarily sell out of risk assets as a result of the conflict. We effectively looked through it. And so today we feel like we're actually quite well positioned. What you're looking at today is a very fragile ceasefire. We'll certainly take it. It bodes well for risk assets. But at the end of the day, the operative word there being it is still fragile. Of course, we have to think about the impact long term on oil. We also have to think about LNG and its byproducts and how that's going to disproportionately affect major economies around the world. So from our perspective, it isn't so much getting all in or getting all out, but being perhaps a bit more nuanced with respect to where we have that exposure based on how these things are playing out.
All right, speaking of nuance, you say the U.S. expansion, it's bending, it's not breaking. Exactly what does that mean? And are you talking about the markets? Because I'm looking at the markets right now. I'm seeing the S&P this month, it's up about 9%. Industrials are lagging, materials are lagging, momentum is leading, tech is leading. So what do you mean by that?
What I mean by that is this. When you think about what's happening as a result of higher oil prices and oil prices going up, of course, given what took place in Iran and the conflict in Iran, that is going to have a negative impact on consumption. That is, to an extent, going to be a tax on the consumer here in the United States. Yet at the end of the day, to your point, you have to recognize there are different parts of the economy that are going to feel the effects of higher energy prices in different ways. While it may be a negative for the lower K, if you will, of the consumer, it's certainly a positive. Energy sector. I mean, case in point, think about what's happening right now with earnings season and with estimates for earnings across energy, across materials. And again, I'll piggyback on something that you just said, which is take a look at what's happening in the equity markets. The economic data and the equity markets are not necessarily one and the same. They are clearly related, but at the same time, it's important to recognize the U.S. economy has been resilient, and there are clearly some bright spots, particularly when you take a look at what's happening with corporate America.
Ryan Dietrich from the Carson Group joins us as well. Ryan, it is always good to see you.
Well, thank you, Frank. The gremlins got me here, but I'm back. So I'm not exactly sure what we just talked about, but I'll just put it like this. Listen, this rally's been incredible, obviously hitting new highs. We know that. But Frank, I think listeners might like to know this. We're going to be up 3% this week. It'll be the third week in a row up 3%. You go back in history, only happened two other times. The lows in 82 and then the lows off of COVID and now. I get it. Small sample size, but this blast of strength, this blast of buying we've seen is not consistent with kind of a bear market rally or just, a short covering rally. I mean, it is, in our opinion, it's an extension of the bull market we've been in for a while, and we're still quite optimistic here.
Yeah, you put that on social media as well, Ryan. According to your research, after those two shocks in 82 and COVID, the markets went up over 30%. So I think a lot of people would like to see that happen. Everybody, just stick around for a second. We want to toss things over to our Seema Modi for a look at how software is faring ahead of some key earnings that are coming up next week. Seema.
Well, Frank, there's already been a couple of drivers of software this week. Anthropic's decision to release a scaled-down version of Mythos, which was a sigh of relief for the market, raising hopes that future AI models will be handled with greater restraint. Add to that, Oracle announcing an investment in Bloom Energy's fuel cell technology, a sign that it too is taking steps to, similar to Google and Microsoft, to become more energy efficient. The market liked it. Stock now up 30% so far this week. Oracle's Rebound founder Larry Ellison now has gained regained about $50 billion on paper, so a stock to watch so far this week. The conversation around software will certainly pivot to earnings, with IBM and ServiceNow set to report on Wednesday of next week. Citi last week initiating IBM at a buy rating, while Oppenheimer reiterated its outperform rating on ServiceNow. Analysts there estimate that the company will generate more than 10% of revenue from AI by the fourth quarter. And Frank, that's going to be key this quarter, right? Software giants proving that their AI capabilities and products are starting to win customers and generate a return. Without that proof point, Wall Street's concerns around AI displacement will likely get louder. Back to you.
All right, our CMO Modi with the very latest on software ahead of some key earnings coming up next week. All right, Anastasia, Ryan, and Joe, thank you guys for all sticking around. Ryan, you joined us late. I want to come back over to you. What is your take on the software sector? I was talking to Anastasia about this earlier. The Opus 4.7 came out, supposed to be better at writing software and a number of other things. Why aren't we more concerned about AI disruption with this model coming out?
Well, we are. Obviously, we've had the massive correction in software, but I'll tell you, kind of like last year, right? When everything sold off after DeepSeek and you realize these companies are making a lot of money, they do have strong moats. Carson Group, we managed a lot of money. We added some software maybe about a month ago, and I know it hasn't done great since then, but I think for longer term investors, it's really cheap. We're going to find out this earnings season if it's worth it, but we think it is. And just tech in general is taking back that baton, put a bow on this. We think tech's going to do really well the second half of this year. It's probably a little bit growth over value the second half of this year, which is a good sign for investors.
All right, Joe, I want to come over to you. One of the things you're watching is private credit. You mentioned it a bit earlier. Our Sarah Eisen, she sat down with Mark Rowan from Apollo, and he basically said, if you can't do the redemptions, he called people an idiot, but he also said maybe investors just don't know what they own, and they need to be more aware of what they own, and that's what's leading to some of this quote-unquote skittishness in the market. Do you think that settles down once we have less geopolitical tension, if this ceasefire when it comes to the Strait of Hormuz and this opening actually plays out the way it seems like a lot of people hope it will today?
I mean, I think it's certainly a hope. I don't know that I would necessarily hang my hat on that. I think ultimately what you're seeing play out in private credit is just the aftermath of what took place in public markets with respect to software stocks in particular, right? You have AI. It is clearly a disruptor, and it's having a negative impact to a degree, or at least perceived negative impact on these public companies. It's ultimately going to spill over into private credit. Ultimately, in private credit, you do have a bit of friction here between an asset that is relatively illiquid and providing liquidity to the masses. At the end of the day, it comes down, I think, to education and to investor education. But overall, we think there's opportunity there, and it continues to make sense.
Anastasia?
Yeah, look, there's so much to say about private credit. First of all, I want to pick up on the point about redemptions and the limitations to those redemptions. That's not a flaw. That is a feature, and that is a needed one, because as Joe pointed out, when you have an illiquid asset in a semi-liquid structure, that is the evergreen structure, you have to have some of those redemption restrictions to protect actual investors. So I think, first of all, that is a good thing. The second thing is, let's decouple the fundamentals of private credit about the concerns about private credit. And the fundamentals, if I look at equity cushions, they're actually much higher than they were years ago. If I look at leverage in private credit, it is lower than it was years ago. And at the same time, the earnings of some of those portfolio companies are actually stabilizing, and the coverage ratios are improving. So from a pure macro perspective, there's nothing wrong with private credit. Now, the concern, I think, started because of the software. And what I would say there is, we really think the trend in private credit is the bifurcation of returns. And of course, there's going to be some software companies that will get caught up in the AI disruption. But as I mentioned before, we're not talking about 20% of private credit. We're maybe talking about 7% that is software at risk within private credit. The realistic default rate is likely to be much lower. Here's the key point, Frank, about private credit is, so many private credit managers did not even exist, were not in the business 5 years ago. So when you think about how much money came into the asset class, something like 45% of funds were launched in the last 5 years. Have they seen the full credit cycle? Have they seen technological disruption? Absolutely not. So I think it is about bifurcation, about selection, and sticking with the managers who've been doing this for a long time.
Anastasia, those are all fair points, and the fundamentals tell one story. People's sentiment seems to tell a different story. I want to go to the sentiment part.
Yeah.
Should people be concerned, at least sentiment-wise, the fact that so many of the big banks are lending to these private credit shops and other non-depository financial institutions, and the fact that so much of their cash is going to these organizations?
No, I don't think so. So first of all, I mean, let's compare and contrast to the financial crisis and the mortgage-backed securities. What you had back then is securitization over securitization over and over again. You don't have that with private credit today. The asset class has grown, but it is not packaged and repackaged and resold. And so that's the first thing. The second thing is the credit lines that the banks provide to private credit managers are there, but they're not the only last resort that the private credit managers can draw on. For example, loans do mature, they get repaid, and also most credit funds do have 10 to 15% liquidity cushion otherwise. So I would say the bank credit lines is the last resort or one of the last resorts, but it's not the only liquidity lever that's out there.
All right, it's certainly not the end of this conversation.
More to
Anastasia, Ryan, and Joe, thank you all very much. Great to see you all. All right, meantime, Anthropic CEO Dario Amodei meeting with the White House Chief of Staff today. Mackenzie Sagalos there with all the details. Mac.
So, Frank, that could be happening at any minute now. I'm at the Southwest Gate here at the White House. This is where visitors are coming through. And this is a notable departure for the government. It was just a couple of weeks ago that they designated Anthropic a supply chain risk, banned their agencies and contractors from working with Anthropic. And then Mythos changed the game. That's their cyber AI model that has the perception of being the most powerful LLM on the market today. So much so that Anthropic is limiting access. But reportedly, the government is testing it out with some of its intelligence-related agencies, but Treasury wants it. Multiple other federal agencies want it. And that's exactly what talks today are all about. So what we're going to see also is whether we get any word on whether that supply chain risk designation could go away, because my understanding right now is that those are two different conversations. The White House wants to know about Mythos, and the Department of Defense still has an ongoing lawsuit with Anthropic in two different courtrooms, Frank.
Mackenzie Sagalos, live from D.C. with the very latest. It's certainly a very interesting meeting. Mac, please bring us any other headlines that come out of that meeting that you hear. Thank you. All right, we want to send things over to our Pippa Stevens for a look at the biggest names moving into the close. Pippa, what are you seeing?
Hey, Frank, well, a lot of stocks are moving around the latest Iran war headlines, so let's start here with the cruise lines. Royal Caribbean is leading the S&P today, followed up by Carnival. Norwegian is also among the best performers. Higher fuel prices had been a headwind for the industry. You see there Royal Caribbean up nearly 8%. On the other side, chemical companies like Lyondell, Basell, and Dow are the two laggards on the S&P. The Strait of Hormuz sees many petrochemicals flow through it as a byproduct of the oil and gas production in the Gulf, and the two have seen double-digit gains since the war began, those shares down more than 10%. And similar to those two, CF Industries, a major fertilizer producer, is down about 9%. As the Street bet the company would be able to raise prices for its fertilizer products amid a backlog from the Strait of Hormuz. The stock is still up some 46% on the year. Frank?
All right, our Pippa Stevens. Pippa, thank you very much. We'll see you again in just a bit. We are just getting started right here on Closing Bell. Coming up next, airline analysts adjusting their long-term estimates ahead of a very, very busy week of earnings. Why and what it might mean for those stocks. We'll have that coming up. We are live from the New York Stock Exchange, and you're watching Closing Bell on CNBC. And welcome back. Ahead of the busiest week of earnings for the airlines, analysts are cutting their long-term earnings estimates. Our Phil LeBeau has much more on that story. Phil.
Yeah, Frank, they've cut their full year estimates anywhere between like 25 and 28%, depending on the carrier. When we get the first quarter reports next week, three things people are going to be focused on. First of all, what's the jet fuel impact? Remember, these are Q1 results, and they really got hammered in March. That's going to be the focus on the cost side. What's happening with spring and summer bookings? That'll be one of the key questions for the CEOs when they're talking on the analyst calls. And there's also going to be a number of questions about industry consolidation, especially when we have two airlines in particular who have been front and center with this week. On Wednesday, we will hear from United CEO Scott Kirby. That's when the United has its conference call after posting Q1 results on Tuesday afternoon. And then the following day, we will hear from Robert Isom, CEO of American Airlines, after his company reports its Q1 results. Curious if this is going to be one of those, hey, you know, it's out there, or if there's going to be something a little meatier to discuss with both of those gentlemen. As you take a look at the airline stocks today, Frank, heck of a pop for Alaska Airlines, up almost 10%. We will hear from Alaska Monday afternoon and then talk with Ben Minicucci on Tuesday. Frank, back to you.
All right, our Phil LeBeau with the very latest that have a big week for airline earnings. Phil, thank you very much. Let's bring in Raymond James airline analyst Savi Sith. Savi, thank you so much for joining us.
Thanks for having me, Frank.
All right, so Savi, are you one of these analysts that are cutting your earnings estimates for the airlines? Because I'm looking right here, I'm seeing a strong buy and outperform, strong buy, outperform.
Yeah, like what we did is we definitely cut 2Q to 3Q in a big way. 4Q, we were assuming that given the fare increases and fuel probably improving, if assuming that the Strait opens at some point, that you're back to trend line by the fourth quarter for most airlines, and then 2027 looking a lot like what we were expecting even before. Clearly, there's a lot of volatility in there. It depends on the domestic demand environment and just general economy holding up. But we did cut 2026 quite a bit, just given how much fuel has moved.
All right. We got to talk about M&A and also the idea of the Spirit liquidation. What does that mean for this industry? What does it mean for investors into the stocks? Is a combination of American and United potentially? Obviously, it's not official. Our Phil LeBeau just kind of laid that out. Is that good for that combined company? Would it take market share? Would it be able to charge more for seats? What's the upside for investors?
Yeah, so that was a lot there, Frank, but if I start with Spirit, like they've been struggling for a while, and it looked like just to start the year, demand was so strong that they could probably survive through the summer, but it was still precarious. Their product changes are taking some, having some fruition there, but just a lot to try and come back from. And now with higher fuel, it looked pretty, it looked imminent that Spirit would be shutting down here. Now with fuel pulling back, we'll see if that gives them a little respite, but most likely it's going to be hard for them to kind of get past that real tough May trough period, especially given some of the operational issues that you've been having there. On the M&A front, American United, like if they can pull it off, it's a coup. It would create a really big airline on the domestic side, almost twice as big on the domestic side as Delta or Southwest. It gives them a strong position in Chicago. So there's a lot to like. It gives United a position in the Southeast, which they do not have today. So there is a lot to like about that M&A from an investor perspective. And even, from a consumer perspective, there are some things that you to like there. It really creates kind of a one airline that can bring you and do a lot of things for you. From a kind of political perspective, I think it might have a harder time passing, just given, again, the size that you're creating with that M&A.
All right, we spent a lot of time talking about the housing affordability crisis. Could we be reaching an airline affordability crisis? Depending on what site you look at, airfares, they increased double digits in March, anywhere from 10 to 15%, depending on whose stats you want to use. How much more can the U.S. consumer pay?
So what I would say is just airline costs have gone up a lot, Frank, and airlines were still just working their way to recouping all the damage done during COVID in terms of how much costs have gone up. Labor costs have gone up 30 to 40%. Engine costs are going up 12% a year. Fuel, depending on what year you're looking at, definitely now just significantly higher. So airlines, what they're trying to do is recoup those costs that have gone up. Last year, unfortunately, you saw demand impacted by all the various policy uncertainties, and you finally started seeing demand coming back. And that was what airlines were trying to do this year. And when half the industry is not making money, clearly this is not price gouging. This is airlines trying to get the fare that covers their cost. And so it was looking like we were heading in the right direction this year, but unfortunately now with fuel doubling, you have seen some fare increases, as you point out, over the last month. But I think that covers fuel getting to maybe in the low $3s per gallon versus in the low $2s at the beginning of the year, but not the $4 to $5 fuel per gallon that you're seeing today. So even at today's fuel prices, this is not enough fare increase, and we're hoping that as the strait traffic eases and as the fuel complex kind of normalizes again, slowly over time, but normalizes, that maybe some of the fare increases that you've seen today will help airlines kind of get a strong footing.
Savi, these fare increases have been pretty extreme. Anybody who's looked up a flight has seen the big moves to the upside. Savi Sith, great to see you. Thank you very much. All right, still ahead, 5-star stock advice. Capital Wealth Planning's Kevin Simpson. He's standing by with his latest trades. Closing bell. We'll be right back. And welcome back to Closing Bell. Stocks are rallying to close out the week of trading with the S&P and the NASDAQ hitting new all-time intraday highs. My next guest says while the market could take a leg higher, this is not an all-clear moment for stocks. Joining me now is Kevin Simpson of Capital Wealth Planning. Kevin, good to see you. What do you mean? Why is this the all-clear? I mean, everybody seems to think it is today at least. We're getting a lot of news that seems like we're leaning towards the Strait of Hormuz officially opening. Why isn't it the all-clear?
All right, well, let's lean into that. Who wants to be the bearer of bad news on a Friday, especially after a great day like we saw today, Frank? And what I like most about it is the breadth of this market. Today specifically, it's not just the Mag 7, it's not just tech. You've got the S&P, you've got the Dow, the NASDAQ, heck, even the Russell's moving higher. So to your point, it was almost like a sigh of relief. We had that all clear signal with respect to the straits. But again, is it an all clear for real? I think we need to get through a little bit more time to see if that's actually the case. But there's enough of a foundation, Frank, for this market to move higher. I'm just looking at it from the standpoint of, boy, it's come really far, really fast. And where do we go from here?
I mean, I think that's the question a lot of people are trying to figure out. Again, we have Jonathan Krinsky coming up on the show in just a bit. He says he wouldn't chase today's rally. We could see a bit of a pullback in the major indices. Are there any moments coming up next week that make you concerned? Because so far, earnings season's off to a great start. Earnings up 14%. We do have some economic reports like retail sales. Could that be something that could change investor sentiment? What are you seeing on the horizon that could change the direction that we're going in?
Well, I think oil is the real linchpin that it continues to be, and as we're seeing today, down oil.
But I thought we were assuming that things are going to stay on this path when it comes to the Strait of Hormuz, at least in the near term. We're just kind of playing that game today with the markets up. Besides oil, is there something else that you think could derail this rally?
No, I don't, Frank, and that's and I think that's strong to your point, because if you look at earnings, even what we've gotten so far, it's almost like a smorgasbord of good news. You had Taiwan Semi saying that the AI trade is intact. You had Pepsi saying that the consumer is still spending. If you go back to the start of the week, you had the banks saying that, look, the economy is still decent. It's not cracking by any means. I expect next week that we're going to have solid earnings reports as well. It's just a question of what does that guidance look like? Has the higher energy prices trickled into those guides? Has it trickled into Q2, 3, and 4? And if not, then we've got a really good foundation here for the market to trend higher. I just never want to look at like a complete blind optimist.
All right, Kevin, we've been at lunch before. You know I like a smorgasbord, man. You know I love that. But when it comes to the markets, you're just kind of nibbling. I want to go to one of your moves. You initiated a new position in Tempus AI, precision medicine biotech. What made you nibble there?
All right, so this is in our growth portfolio, so tread lightly before you follow us into this one. This is an AI trade, but it's a biotech healthcare AI, and we really like that. We've been watching this stock since it went public in 2024, shot up over $100. Came back down into the mid-50s. So we started and initiated a little position at $55. Now, this isn't just speculative AI. It's really a database that has accumulated about 40 million data points. These are very private records, but when you have genomics and this type of clinical database at that level, I mean, it's legit. And the more data you have, the better your models and the more people you can save. Additionally, they've got earnings. They're guiding for $1.6 billion in revenue for 2026. That's some real money. And I think the catalyst or the final thing that we really like from a bullish standpoint is they announced earlier this month that they have a contract with Gilead, and it's for oncology for several years with a joint marketing venture. So this is a company that's got certainly a little bit of risk to it, but with this type of risk, we think it can be great reward. And AI within healthcare is one of the places where I think you can monetize it sooner rather than later.
All right, you also wrote some covered calls on American Express. Now, I'm looking at the numbers here. It looks like you're getting your cake and you're eating it too. So walk us through this one. You sold the calls at 360. Right now, the stock's trading at about 333, 334. Walk us through the whole move.
Yeah, you and I talked last Friday about if this market moves higher, we're going to start getting active in the call writing. We've been super patient, and fortunately we have been because the market moved higher. The mechanics of this trade, we love American Express. Stock's trading around 333, as you mentioned. This gives us the ability to participate in the growth up to 360. So we've got another, 10, 20 points to move higher. But the idea is that this is expiring in only 1 month. So it's a 1 month covered call. It brought in $2.20 a share. When you annualize that, it comes out to like an 8% annualized premium. Now, granted, we're not doing it on a rolling cycle, but if you can enhance it from a cash flow perspective by 8% annualized, You can hedge it a little bit, and we still love the name. They report earnings next week. I think if you're from your mouth to God's ears, if we can get the best of both worlds on that one.
I mean, it would take a big upside move for this to be in the money. Kevin Simpson, it is always good to see you. Thank you very much.
Thanks, Frank.
Coming up next, we're tracking the biggest movers as we head into the close. Our Pippa Stevens, she's back with that and much more. Pippa.
I'm back, Frank, because one fintech stock is getting the stamp of approval from Morgan Stanley, and we've got the name to watch coming up next.
And just about 13 minutes until the closing bell, let's get back to our Pippa Stevens with a look at the key stocks to watch. Pippa.
Hey, Frank, Netflix is one of the worst performers on the S&P today, down nearly 10%, as the streaming giant's current quarter guidance came in below expectations in its first report since the Warner Brothers deal split. Co-CEO Ted Sarandos emphasized on the call that the deal was a nice to have, not a need to have. In a big governance change, co-founder Reed Hastings also announced that he would leave his role as chair of Netflix's board. Meantime, Alcoa is also falling after earnings. The aluminum producer missed expectations across the board as alumina production fell 5%. The company did maintain its production and shipment guidance for alumina and aluminum in the full year. And Affirm is getting a nice boost from Morgan Stanley today, who named the stock a top pick. Analysts there are bullish on the firm's ability to grow its total transactions and call fears around its links to private credit overblown. That stock here up 7%. Frank?
All right, Pippa, thank you very much. Our Pippa Stevens. We are also getting some news on Meta. Our Seema Modi has that for us. Seema.
Frank, Meta is planning a round of layoffs, according to a report from Reuters, quoting sources. The report suggests that the first wave of cuts from Meta, around 10% of Meta's workforce, that's about 8,000 employees. Further layoffs are planned for latest this year. We are reaching out to Meta. We'll get back to you with the latest. For now, I'll send it back to you.
All right, Seema Modi with the very latest on Meta. Those shares up about 1.75% right now. Coming up next, we got BTIG's Jonathan Krinsky. He is standing by to wrap up a busy week on Wall Street. You can also see the Dow right now up about 860 points. Plus, we'll tell you what's been driving the big bounce in Bitcoin, the market zone. Coming up next. We are now in the closing bell market zone. Mike Santoli and BTIG's Jonathan Krinsky. They're here to break down these crucial moments of the trading day. Plus, Seema Modi tracking the moves in crypto and the big bounce in strategy stock. Also, Pippa Stevens standing by with the very latest on oil. Mike, let's start off with you. What do you make of the action that we're seeing in the markets today? We've been hitting this all day long. The NASDAQ 13-day win streak. It looks like that's all but certain at this point.
For sure, and as a broad principle, if you have the S&P up 4.5%, we have had this historic streak across the indexes, you have to respect the strength and persistence of that kind of move. A market that can go from, kind of on its heels and oversold, surging to overbought and having people forced to participate. And of course, it's accompanied on a day like today with easing financial conditions, a lot of the news flow supporting this rebound rally. I do wonder if we're crossing over from that point when just less bad news is good enough to keep us going higher. I would note we've sort of moderated the gains throughout the day. Some of the stuff that was first to bounce most aggressively, like SanDisk and Micron and Oracle, are actually down on the day. So part of that is a rational rotation. Part of it might be that we're getting a little bit winded in the near term.
All right, Mike, what do you got coming up on OT?
Well, we're going to try to get at that question about the risk reward for the market from a couple of angles. You got Keith Lerner, who says, this is actually reaffirming the bull market. Charlie Babrinskoy wonders if we're already fully valued. So that's the key debate. We're also going to look at Microsoft as an interesting representative of this tech comeback trade.
All right, Mike Santoli, we'll see you in just a few minutes coming up on OT with Melissa Lee. Thank you very much. Want to send things over to Seema for a quick look at crypto. Seema, what are you seeing?
Hey, Frank, optimism around a ceasefire in Iran has boosted equities, and crypto is not far behind, with Bitcoin back over 77,000, its highest level since February of this year. So a significant rebound. The outperformance in crypto sending MicroStrategy shares higher. Whenever Bitcoin jumps, its holdings become more valuable. That's why it is outperforming today. Strategy owns billions in Bitcoin with the average price of just over 76,000. So their massive investment is back in the green with the recent price action that we're seeing today, Frank.
All right, our Seema Modi. Seema, thank you very much. Now let's get over to our Pippa Stevens for a look at the big moves in oil. Pippa, what do you see?
Well, Frank, oil is dropping amid optimism that ship traffic through the Strait of Hormuz could begin to normalize. U.S. oil trading as low as $80.56 today, just about $13 above where prices were prior to the war. And today dropping below its 50-day moving average for the first time since January. Now, CIBC Private Wealth's Rebecca Babin saying the market is repricing the idea of reopening faster than the reality of it, and that until we see actual vessel counts move, this is still a headline-driven repricing, not a confirmed shift in physical flows. Now, in the coming days, we will see if ship owners are willing to send their crews through the waterway, but for the time being, nothing has meaningfully changed. And once traffic does resume, many are saying it will take weeks, if not months, for flows to become fully functional. Frank?
All right, our Pippa Stevens. Pippa, thank you very much. And as we head towards the bells, let's bring in BTIG's Jonathan Krinsky. Jonathan, good to see you. Your ears must have been burned. I've been talking about your note all day today, looking at the rally. You said don't chase it. Why not? Why wouldn't you chase this rally? We seem to see a lot of tailwinds and a lot of good news that could play out over the weekend and actually make things, when it comes to oil and also geopolitical tensions, seem a lot better for investors.
Hey, Frank. So I think it ultimately comes down to time frame, and we got a lot of signals in the last couple weeks that suggest that it is a durable rally and should have sustained legs beyond the 7,000 level for the S&P 500. We still think that's the case, right? So let's call it the medium-term outlook still looks pretty good. I think it's a function of, are you going to get a better chance, a better entry point after 13 straight up days in the Nasdaq, 15, 16% rally there, and we think the answer is probably yes. But again, I think a lot of it comes down to which parts of the market you're talking about. We do still think software has legs, but if you look at the semis, which have certainly been leadership throughout this year, they are now 17% above their 50-day moving average, which is about as extreme as you've seen over the last couple decades. So they're just parts of the market that I think are showing a little bit too much here and are likely to see some pullback in the near term.
All right, just to be clear, you don't think this is the ultimate top when it comes to the Nasdaq. You see more upside, but you're saying this isn't the best entry point after 13 higher days. You also say strength begets strength. So if you're not looking to play the strength in the Nasdaq, is there some other area of the market where you see a more attractive entry point?
It's tough right now. Again, I think outside of energy, obviously, which has been inverse to the market, there's not much that is not super extended. And I think that's the issue. Is we like to find entry points that are a little more, give a little better risk reward rate in the near term. Maybe you could look at some of the quasi-defensive areas like consumer staples or healthcare that certainly have not seen a bounce. And along those lines, we also think bonds are interesting because as crude rallied, as the escalation increased, bonds sold off kind of in tandem. And then since we've seen crude pull back over the last couple of weeks and stocks rally, bonds really haven't participated. So we think there's probably upside for bonds, and maybe that could support some of those more defensive areas of the market as well in the near term.
All right, so we got some news about the Strait of Hormuz that a lot of investors wanted to hear. It's also options expiration day. How do those two things kind of come together in the action that we saw in the market today?
Yeah, I mean, so options expiration does historically often mark some sort of inflection points, especially when you see strong moves, whether it's advances or declines into the expiration. And then you combine that with the fact, to your point, that there was a news-related gap up. And so there's a lot of optimism on that into this options expiration that lends itself to a potential hangover, we think, as we head into next week. And again, it's nothing serious at this point, but just, I think it'll consolidate the charts and make those entry points a little bit better as we head into the summer.
I just want to make sure I understand your point, Jonathan. Are you saying that this rally, it may have been a bit less if it wasn't for the fact that we saw options expirations? Was that one of the tailwinds that move a lot of these indices higher?
That's certainly possible, but I think more so the fact you get a lot of options expiring, and when you get on the other side of that expiration, you often can kind of go the opposite way that you moved into expiration. So yes, to your point, certainly options I do think played a part, and then you had the news kind of exasperating that as well.
All right, Jonathan Krinsky from BTIG, thank you very much. Great note. We're talking about it all day long. You have a great weekend.
Thanks, Frank. You too.
I want to take a quick look at the markets as we've been talking about all day long. The NASDAQ, more than likely, I don't want to say it's definite, but we're 45 seconds away from hitting a 13-day win streak. Longest win streak, or longest 13-day win streak, or best win streak since 1992. You guys know what I mean. We're also looking at the Dow right now. You can see it is up about 1 3/4%. The S&P up about 1 1/4%. The small caps, the best performer on a percentage basis, up over 2% as we go into the close right now. We've been also talking about oil all day long. Big pullback when it comes to oil. WTI pulling back more than 10%. Brent pulling back about 9%. That's been a big part of this rally. And that's going to do it for us in Closing Bell. Now it's time to send it into overtime with Melissa Lee and with Mike Santoli. Have a great weekend.
The bells bringing into the trading day at the NYSE, Pinnacle, West Capital, and at the NASDAQ, Alamar Biosciences. Welcome to Closing Bell Overtime. We're live from Studio B at the NASDAQ market site. I'm Melissa Lee along with Mike Santoli. Stocks soaring today, again, continuing one of the best stretches for the markets in recent years as Iran says the Strait of Hormuz can reopen. Today, the Dow was up 900 points, the S&P 500 up more than 1%, the NASDAQ extending its winning streak to 13 sessions, the Russell 2000, the best of the bunch, up 2%.
This wraps up the third straight winning week for the averages. The NASDAQ gaining more than 6%. Question we'll be asking our guests this hour, can this run continue? And I think it's pretty safe to say it will not continue at this particular angle in this uninterrupted way.
Straight up?
Straight up without a pause. Obviously, it's actually a positive. When we break out to new highs, 7,000 the S&P was a ceiling for this market for months. You have had confirmation from oil down, yields down, volatility down. Now, over the course of the day, oil is like $4 off its lows to the upside. WTI, it's still down a lot. You did also see some of the stocks that led us in this rally back away a little bit. And even the S&P just came off the boil just a touch. So I think you could say, the bull market has been kind of reasserted here, but it's not clear that we've kind of wiped away all the concerns, and you almost never do. But it sort of felt a little more all clear than maybe we're comfortable saying it is.
Especially when there's so many uncertainties still. In today's action, we saw a lot of reflexive trades. Rates down, home builders up, oil down, airlines up, that kind of action today. But for the week, we've seen some pretty extraordinary moves for sure.
There's no doubt about it. I mean, even coming into today, things like CoreWeave up 50% month to date, that whole food chain. And then today it was just the stuff that hadn't participated gets an extra little bit of a bid here. Let's get more on today's big market movers. Seema Modi tracking the action for us. Seema.
Hey, Mike, a strong rally in the NASDAQ, as you guys were just discussing. The breakout in tech was widespread, but some of the big winners like Oracle stalling today, still up about 25% for the week. Software stocks that did drive the IGV ETF higher today: AppLovin, Datadog, and Palantir. As investors get ready for tech earnings, we did see noteworthy gains for Tesla, which just broke an 8-week losing streak, and Microsoft, which just saw its best week since 2015. Now, cruise lines and airlines also rebounding thanks to a sizable drop in oil prices today, thanks to cooling geopolitical tensions. We also saw names outside of tech get a lift. Stocks like Sherwin-Williams, Caterpillar, and Home Depot. Netflix still unable to shake off its lackluster earnings performance last night, with guidance coming in short of expectations. That stock nearly down 10% on the day. Guys?
All right. Seema, thanks. Seema Modi. A huge move lower today in oil prices. Iran says the Strait of Hormuz is open. Let's get to Pippa Stevens for the latest and what the reality is. Pippa?
Well, Melissa, the reality is that there are conflicting reports from President Trump and Iran around what exactly is happening in the Strait. But the next 24 to 48 hours will be key to see if there is a meaningful uptick in traffic through Hormuz, because for the time being, ship owners are cautious. One industry official telling me just now that shipping companies are still scrambling for information and assessing the risks. Meantime, BIMCO's chief safety and security officer saying the status of mine threats in the Strait is unclear and that they believe shipping companies should consider avoiding the area because it is not declared safe for transit at this point. I also spoke to insurance broker Marsh, who told me they've seen a spike in inquiries following the announcement for those operating in the area, and that once there is an increase in successful transits, they anticipate underwriters' confidence strengthening. But that comes back to the issue of who will send their ships through first and by what route. WTI down 10.5% today, with Brent shedding 8% to about 91. Dated Brent, which is oil for delivery in the next roughly 10 to 30 days, also dropping to 99.26. That's according to S&P Global Energy. That was the first move under 100 since March 11th. Guys?
According to data, do we know if any ships have actually transited the Strait at this point?
Yeah, so we've seen a few. We saw that cruise ship actually getting through earlier today. Then I'm looking at the map right now, and there are some cargo ships that look like they have approached the Strait, but not going through just yet. So far, we're not really seeing, and then the map you're looking at there, I should say, is tankers. The one I have right here showing that approach. It also includes cargo carriers. But it seems that, Melissa, we're not seeing a meaningful uptick just yet. And the ones that have gone through in recent days have tended to hug the Iranian coast and once again speak to perhaps going through that toll route or being within Iranian water. So clearly a lot of, misinformation about what exactly this means and what it will take to get traffic resuming.
Yeah, it feels like we have the trust part. We got to verify that it's going to hold here. Pippa, thank you very much. It was a lightning fast recovery for markets, with the S&P 500 gaining 13% at today's high in just 13 trading days. The only other time this has happened was the peak of the bubble in March of 2000. Only one instance, maybe not statistically significant, but should you trust such a swift breakout? Joining us now is Truist Wealth's Chief Investment Officer, Keith Lerner. Keith, good to see you.
Yeah, great to be with you. Nice to see another week.
You were thinking about this setback as an opportunity to kind of reload and sort of stay exposed to some of the leading groups that you like here. Have we used up whatever we got in terms of evaluation and sentiment reset?
Yeah, well, I mean, we certainly have used up some of the fuel, no pun intended, on this move up. But I would say, Mike, and you know this too, is when you see a strong move off the lows like we've seen, I know you talked about the one example, but more broadly, when we look at this, it tends to bode well looking out 12 months. And we still think this bull market deserves the benefit of the doubt. You know, on the valuation side, I mean, we've got down to about a 19 multiple on the S&P. I think we could go a bit higher. You know, what's more interesting to me is on the technology sector. You know, this contraction that we saw was about 37% in the valuation. That is the most extreme PE contraction we've seen, even more than the COVID side. So I think that actually has more to go as well. But are we going to back and fill a little bit? Do we have a little bit of a kind of a consolidation period? Probably. But I would still say that primary trend is still higher.
And technology, do you think, is the thing that's going to be the engine for a bit? You know, I think it's been very fascinating to see how we went from everybody kind of celebrating a broader market that was everything but the mega cap tech group working in the early part of this year. Then we get the correction, and it's tech that leads us out. and the tape actually usually has a little more of a firmer and reliable tone when you do have that sponsorship.
Yeah, I do think that AI is coming back into the forefront. We have to remember it peaked in October of last year after a really strong outperformance cycle. We've talked about this in the past. Every bull market has a dominant theme. I think the dominant theme is still AI and tech, which got pushed to the background. Now it's coming up, and the earning trends are still the strongest. We're only at about a 23 multiple. I mean, we were at 32 at the highs in October. It doesn't mean we should go back there, but I think there's still more upside. But that said, Mike, I don't think it's just tech. Like today, as an example, small caps made a relative high to the S&P. So I just think this will be broader, but I think tech will play a larger part than earlier in the year where it was underperforming.
Yeah, and the Russell's up 12% this year. It's the best performing index, actually. Keith, in terms of the tech trade, it's interesting because if AI is the narrative here driving this tech trade off of the bottom, off of the V bottom, software shouldn't do well in theory. In the past, as AI wins to the detriment of software. And here we have the IGV actually making a go of it in terms of the gains, and some stunning gains we've seen from the likes of Oracle as well as Microsoft.
Yeah, I mean, on one side, though, I would say that the software names, as they became, the front and center of what everyone was talking about as far as the dislocations, they just got to an extreme oversold. And what you saw there is really an oversold market to have a balance. I still think the leadership is with the compute, with the semiconductors. Semiconductors made a new high today. But I think with software, at least now you've seen some of that bad news priced in. I don't think they're leadership, but I think they can participate in this move up. And I think also the market's starting to sniff out that not every software company is going to be displaced as well. So I think that's just going to be more a disparate group as opposed to this all kind of selling trade. And I think if they just stabilize, that's a positive for the tech trade overall.
I mean, the market, especially with some of the groups that were working today, is implicitly saying that the underlying economy, the consumer, is going to be able to absorb whatever has come along with the higher oil prices, even a little bit of a lift in Treasury yields. Maybe we get Fed rate cuts deferred. Does that make sense?
I think it does. And I think part of the reason why the market is giving this bull market the benefit of the doubt is it's earned it. If we go back the past 5 years, we've had a series of shocks, from COVID, supply side disruptions, really fast rate hike cycle, highest inflation since the 70s, the tariff shock from last year. And each time markets have bounced back, profit margins have moved to new all-time highs, and earnings have moved to all-time highs. So I think that's why we're seeing this, market give the benefit of the doubt. I want to be clear. I don't think it's going to be a straight move up. We are in a midterm election year. We'll have other curveballs that come out that we're going to have to deal with. But all in all, I still think this overall economy and market have proven that they deserve the benefit of the doubt.
Keith, great to speak with you on what has been an extraordinary week. Keith Lerner, Truist. With stocks having had such a fast move higher, are there areas that you can go hunting that are still cheap? Joining us now, Charlie Barinskoy. He's Vice Chairman at Ariel Investments. Charlie, great to have you with us.
Hi, Melissa.
We are just talking about small caps, and you also agree that small caps is an area that appear cheap. Make the case.
Really, small cap value. You got to add that value. The small cap value index is trading right now at about 13 times forward earnings. That is below historical average, while the S&P is at right after today's move at about 21 times. That's a big gap. And the market, you can't just talk about the market. You have to talk about individual stocks, individual sectors. And over the last 12 months, small cap value has benefited a lot from, in particular, a much better tariff situation. A year ago, we were staring at, nobody knew how high the tariffs were going to be. The smaller companies have a tougher time moving their supply chains around. And so those stocks got hit hard. They got very cheap, and they have done spectacularly over the last 12 months, returns of 45% plus for the index over that time. So there's still pockets there that are reasonable. Large cap and the S&P, I'm going to make an argument that it's at least modestly overpriced. 21 times the S&P is not attractive.
So would you advocate trimming some large cap exposure, or at least hedging what you have now?
So I tend to not want to time markets, but clearly if you have incremental money to put into this market, you should put in where there's a better opportunity. And there's definitely better opportunity in small cap value. I mean, I do still think that there's a lot of risk about AI. It's very hard to predict who's going to be a winner. It's like people always point to the railroads in the 1860s and 70s. It clearly changed the country, but a lot of companies went bankrupt trying to put that technology to work. Same thing in the internet bubble. The technology changed the world, but a lot of companies didn't make it. And I think that's what we're going to see in AI. Very hard at this point to pick the winners.
Charlie, I was interested to see that you've found some interest in some of the companies that were sort of dislocated by the idea of the AI threat, like Fiserv, like FactSet. They're not pure software, they're kind of data services, but they did get taken down on some of these fears about Claude code and things like that. So what are you seeing there?
Lots of opportunity. I absolutely pounding the table on FactSet. People are acting like it's a software company and it's going to be replaced by AI. There's no way a firm like mine is going to turn over data analysis to AI bots that often hallucinate. It's just not going to happen. That's not what FactSet is providing. When we put together models, we are drawing individual cells in that model from FactSet feeds. FactSet is just a very competitive company with competitive pricing, and it got taken down as if the world was coming to an end. So we love that name there. Fiserv had about 20 straight years of double-digit earnings per share growth, and they stumbled. They had some things they shouldn't have done, but that company now is trading below 10 times earnings and very attractive.
Mohawk is another one that you like, Charlie, and I'm wondering, how much does Mohawk need a healthy or decent housing market, and what sort of headwinds might they face because of higher input costs due to the war?
Yeah, they haven't had a decent housing market for a while, but what they have had is prices have gone up. And so people have equity built up in their house, and so they can afford to do repair and remodeling. So we are expecting people to remodel more of their existing homes. And then frankly, we're just not building enough homes in this country. Everybody knows it. We're building at about the rate we built in the 1960s when the population was 50% lower. So we need more houses. Mohawk has managed to keep earnings reasonable through this very tough time. And the stock got crushed because people were very worried about input costs for carpet of oil particularly. Now we've got some price relief, and Mohawk, we think earnings estimates are going to go higher.
Charlie, I know you're always, a little uncomfortable with sticky high inflation. I wonder if you think that, we can kind of sidestep a reacceleration in inflation if this, energy price surge is going to be able to kind of wash its way through without causing too much of a trend change.
There's just too many forces that are pushing the other way, Mike. We've got incredible deficits that are getting to the $1 trillion level. We have the Fed that is now re-easing, increasing the money